our workshop. To kick off today's discussion, it is my great honor to introduce the Governor of the National Bank of Ukraine, Andriy Pyshny, who will deliver the opening remarks. Please remember to activate the interpretation function for the English translation if needed. Андрію Григоровичу, дякую, будь ласка, дякую, що долучилися до нас.
Mr. Governor, thank you for joining us, and this is the floor to you. Good morning, dear colleagues. I am very glad to welcome you at the workshop of the NBU Monetary Policy in Emerging Markets. This year, we will focus our attention on inflation targeting, a monetary regime that has stood the test of time and extreme conditions. But before that, I would like to thank the Governor of the Swedish Central Bank, Erik Thedéen, for participation and for his consent to be a keynote speaker of our workshop. It's a great honor for us that it will be Erik who will be the keynote speaker, because Sweden and Riksbank were, at the very beginning of the inflation targeting and remain one of the most consistent followers. The world marks 35 years since inflation targeting was introduced. The National Bank of Ukraine is a relatively young inflation targeter. Recently, we celebrated our first decade operating in this mode. However, the experience we have accumulated over the years is unique. It is unique even on a global scale. The key stages of transformation of our monetary policy fell within the full-scale invasion. First, the hybrid war, and since 2022, full-scale war. The Ukraine has been shaping its policy principles at the same time fighting back hybrid attacks, information pressure, external shocks. Our inflation targeting regime became not only a development tool, but a pillar of stability in uncertain times. Since the start of the full-scale invasion, we are testing how resilient and flexible this regime can be in crisis conditions. Our experience shows convincingly that the monetary paradigm is shaped by challenges and that emergency conditions often accelerate its evolution. Today, I want to share our perspective on how inflation targeting in Ukraine has progressed and to outline the key directions for its further development. Stage 1. Making a strategic choice. The NBU introduced inflation targeting in 2015, when the inflation was more than 50% and key reforms were just kicking off. These transformations were taking place in a time of crisis that was aggravated by Russia's hybrid war against Ukraine and the annexation of part of our territory. At that time, many, both inside and outside the country, were saying that the NBU was unprepared to launch such a framework. We heard the words, "not during the war, the preparation should be more thorough." There were enough doubts, but doubt always accompanies a strategic choice. Poland adopted inflation targeting in the early 2000s in the environment of high inflation, low confidence, and profound shifts in the labor market and productivity. The Czech Republic made this choice in the late 1990s, while still uncertain that in a small open economy, a floating exchange rate could be a safeguard against crisis and not a source of them. Sweden introduced inflation targeting after the financial crunch in the early 1990s, where confidence in central banks was at all-time low. all-time low. None of these countries waited for ideal conditions to start, nor did Ukraine. The NBU made a strategic decision in exigent circumstances, and it was the right move to make. Inflation targeting became an important element of stabilization in times of turbulence, a tool that significantly fortified the resilience of our country's economy and financial system ahead of the full-scale invasion. Stage 2, winning trust. After the first years of stabilization, inflation targeting began to produce tangible results. Inflation went down. Inflation expectations became more stable and monetary policy more predictable. During that period, the NBU was often described as too tough or sometimes inflation nutter. But that was exactly the course of action that trust, our most valuable asset, called for. Other countries had gone through similar stages. The United States experienced a period dominated by inflation hawks in 1980s and 1990s, the period when the price of tight monetary policy was high, but that would not be able to achieve stability in the 2000s without it. The Czech Republic, Poland, and Sweden have all taken an almost textbook perfect approach to inflation targeting for many years, enabling them to eventually curb inflation. It's a good opportunity to quote the IMF European Department Director Alfred Kammer. He said, "In the fight against inflation, policymakers should show perseverance, avoid premature celebrations, demonstrate policy credibility and consistency, and keep an eye on the medium term." In each of these countries, perseverance and consistency were a necessary bridge to build up confidence. But trust is not a constant. It must be boosted on an ongoing basis. This is what we do even in the face of a full-scale war, and therefore stage 3, challenges to the foundational framework. Russia's full-scale invasion of Ukraine has created a monetary situation that is unprecedented anywhere in the world. We have found ourselves amid a perfect storm in which any textbook, any model, or any historical analogy could not provide a ready-made solution. In the first hours of the full-scale war, the NBU fixed the exchange rate and introduced tight FX restrictions in order to restrain panic and protect the financial system. Those measures did work, not only thanks to the NBU's professional action, but also thanks to credibility built over the years of inflation targeting. Without this credibility, the fixed exchange rate would become a trap. With this credibility, it has become a stabilizer. Indeed, during this period, we had to sacrifice the formal adherence to the inflation targeting regime. But without this, the first shock of the war would have had catastrophic consequences for the economy, which already suffered a devastating blow from Russia's full-scale aggression. However, we have never sacrificed our principles. Our goal to maintain price stability has become one of the elements of supporting the defense capability of the country. We have also added an important message to our strategy of the National Bank, stating that the central bank's mandate must be implemented under any circumstances. Stage 4. a test of flexibility. Anti-crisis measures taken at the start of the Russian invasion can be compared to applying a medical tourniquet, which is a tactical medicine mean. Today, the majority of Ukrainians know how to apply it. In an instant, the tourniquet saves lives. But if it's not removed in time, the risks are huge or even fatal. When in October 2022 I took charge of the NBU, my task was to professionally remove this tourniquet gradually, step by step, after a thorough preparation and calibration, and making sure proper preconditions had been met. We introduced a set of measures to restore monetary transmission. We established cooperation with the government, resuming the operation of the interdebt market. We also boosted our cooperation with partners. We refused from monetary finance and published some strategic documents in which we clearly described our logic for restoring the elements of normality. In 2023, we managed to switch from the exchange rate peg to the managed flexibility regime, and to start, which is important, the FX liberalization. In 2024, we introduced flexible inflation targeting. What were we told as we were preparing those changes? In fact, the same things we were told back in 2015. It's not the right time. It's different this time. No one has ever done this before during the war. Let's wait. But the strategic choice has already been made. For the NBU, the question was different. How exactly we need to adopt and adapt the policy to retain our most valuable asset, trust, and to ensure macro-financial stability. Today, greater flexibility of central banks is becoming a trend. The geopolitical turbulence after 2022 triggered the implementation of comprehensive integrated approaches to policy, using combination of interest rate, FX interventions, and capital flow restrictions. However, flexibility does not mean weakness. Flexibility means maturity. We have not abandoned the philosophy of inflation targeting. On the contrary, we have reached the new level where we combine our principles with adaptivity. Stage 5, normality. The war is going on. Although we are gradually resuming the elements of normality, a full return to classical inflation targeting is still ahead. According to our strategy and monetary policy guidelines, the return to classical inflation targeting with a floating exchange rate will be preceded by the normalization of the functioning of the Ukrainian economy across a wider range of indicators. We will continue combining our tough principle and flexibility in tactics. We will avoid responding to short-term shocks to support the economy, provided that expectations are stable. At the same time, we will respond decisively if the attainment of the inflation target is at stake. When proper preconditions are met, we will gradually return to normality. But it will be a completely different classical inflation targeting, the one that will include the experience of the wartime, the one that will integrate the experience of flexibility, and it will be the inflation targeting based on our experience of sometimes very difficult decision-making And these decisions do not always align with the model, but they save the stability. Our experience of inflation targeting is a decade that proves that monetary policy can withstand even when other frameworks collapse. I'm sure that the next decade will become a period of recovery, a period of development, European integration, and the period of deepening of trust. Thanks to our armed forces, our partners, and our devotions, it will be possible. I hope that this workshop will become a platform for an honest and profound discussion. I wish that our today's discussions bring not only powerful analytical points and arguments, but also new ideas and practical solutions to shape the policy in the future. Because in times of high uncertainty, it is important to find the right balance between restraint and reactivity, between trust and flexibility, between economic logic and the reality of wartime and a complex geopolitical environment. We want to hear different opinions, ask tough questions, and to find meaningful answers together. Thank you for your participation. Thank you for supporting Ukraine and for your efforts to develop the global monetary thought. Have a very good workshop and glory to Ukraine, and thank you for attention.
Dear colleagues, thank you, Governor Pyshney. Thank you for your historical context you highlighted during your speech. It was very interesting to went down to the historical moment of how the inflation targeting was introduced in Ukraine, because I was personally also engaged in that process. Your speech was, as always, very inspiring, and also I would like to thank you for deep engagement in academic activities at the National Bank of Ukraine. And also I would like to say that I want you to take my greetings related to successful negotiations with International Monetary Fund. Thank you very much. Let's switch to our session. Let's start our session, Building Resilience Policy Framework. So,
thank you for the congratulations. Indeed, your discussion is a source of really valuable information and valuable reflections. The historical context I recalled about, it's a mass of information and also proofs and evidence, and I hope that your scientific community will discuss it and analyze it in all details and will generate the vision we will take as an outcome and use in our policies, precision of calibrating, decision making precision, and this is a precondition for the success. And such communication for the National Bank of Ukraine is really, really valuable. Thank you for this.
So let's start. What we know from recent turmoils. First of all, is that central bank independence really support to maintain trust and credibility. Next is that how academic activities at central banks may help. Of course, academic activities substantially support the clear understanding of the nature of the shocks. And this helps to calibrate forecasting models and its effect, efficiency of current operational decisions. And also the operational frameworks are necessity to maintain macrofinancial stability. However, the time is changing and the world approaching to a new era of uncertainty and unpredictability of different kinds of shocks. So the central banks should be ready to uncertainty being new norm. On this session, we will reflect on the experience of inflation targeting, as well as discussion policy issues that quite relevant for today and of course for tomorrow. We have three distinct panelists: Kai Christopher from ECB, Magnus Jonsson from Riksbank, and Matthias Chavas from BIS. Now let's start from the Kai, please. I also would like to notice that each panelist have 20 minutes for presentation and a few minutes after presentation to answer the questions. So let's start from the Kai. Kai, please, the floor is yours.
Yes, thank you very much. Can you hear me and see the presentation?
Yeah.
Yes, okay. First, I want to thank you very much for giving me the possibility to present this paper here, because it also speaks a lot to the issues that had been mentioned by Governor Przesny before, when we think about inflation targeting and then the danger of inflation expectation becoming de-anchored. So let me start with the following graph, which gives the evolution of longer-term inflation expectations from the survey of professional forecasters. The survey of professional forecasters is something that the ECB is conducting regularly and asking people who are really doing this as their profession to give us their longer-term inflation expectations, and of course also other variables. And what you can see here is that on the one side there is a lot of heterogeneity within this group. You can see this by the different shadings of blue over different periods. For example, between 2019 and 21 Q3, you can see a lot of mass putting to the downward, being in line with the low inflation period in that time. And then you can see going into 2022 with inflation increasing, that the mass turned to the upside. So the important thing that we want to take from this is that there's some heterogeneity and also some time varyingness. And here I have added to the same graph a measure of average inflation over 6 years. And you can see that the moment that these average inflation, which is a backward-looking component in this setting, when it started to decrease, you could also see that the longer-term inflation expectation of the survey of professional forecasters went down. And then when we went into the inflation surge, which you can see by the red line going then to values above 3 and actual inflation going up to 10%. You can see that, and then also the survey of professional forecasters increased their longer-term inflation expectations, giving us somehow the motivation for the kind of model that we want to propose, which is a DSGE model, which is having two states. So it's a regime switching DSGE model. In one state, the agents take the unchanged central bank target of 2% for the case of ECB as given, and always take into consideration this as a medium-term anchor and driving their medium-term expectations. But then there's also another regime where agents still believe that the central bank is maintaining this inflation target, but they lose credibility or lose the trust that the central bank will be able to bring back inflation quick enough back to target. So instead of taking the actually announced target there for their own optimization, they are taking into account a time varying inflation target. And this is here what you can see here, the green line, which says model perceived inflation target, which is very close to the 6-year average inflation. And we are going to, I'm going to talk now about how we set up this model and how this model can then add to the discussion on the anchoring in the inflation targeting environment. So, as discussed already before, inflation expectation targeting central banks promise that inflation will be a target in the medium term on average. And we have also seen here in the previous chart that the longer term inflation expectations are time varying in those surveys. But for example, also if you look at consumer surveys, you see an even larger degree of time varyingness. And the question that is then coming to monetary policy is, when we see prolonged one-sided deviation of inflation from target, how much or in which way does this threaten credibility and may lead to de-anchoring of inflation expectations. And of course, the intuition to this is that when you have a perceived inflation target that is reacting to realized inflation and you have higher realized inflation, the target goes higher, and this leads to these endogenous propagation towards higher inflation. And then, of course, the same thing also applies to downward deviation from target. What we're doing in this paper is we are proposing a framework to model these risks of inflation de-anchoring derived from conditional stochastic simulations of a Markov switching DSGE around the baseline. In the paper, but I'm not going to talk about this in this presentation, we are also looking at the optimal policy implication in this regime switching environment, and especially when the actions of the central bank is having an impact on the probability of switching to a low credibility regime, the response of the central bank will be more aggressive than in usual cases. There's a lot of literature available in on the de-anchoring thing, but our paper is somehow different than most of the other ones. So we are not assuming a learning on the inflation target, but we assume that the households know the inflation target and they trust, but they just think that there are temporary deviations which might lead them to deviate from this target in their own optimization. The model that we are looking at is a standard policy model, is a DSGE model with around so pretty many states and around 20 observable variables. So it's a standard macro model that is used in central banks. And then we introduce two states into the models: the anchored regime, which is high credibility case, which is indicated by this H. And in this case, the agents base their decision on a constant inflation target, and they have also in their expectation formation process the expectation that they will come, that inflation will come back to the target in the medium term. But then there's also the other regime, the de-anchored regime, which is mentioned with the L, which goes for low credibility. And here the agents base their decision on the time varying inflation target. And if you look at these, this formula here, it shows that the perceived inflation target in the low credibility regime has an autoregressive component, but is then driven by past deviations of inflation from the perceived target. And this gives the intuition very clearly. If we have many observations of inflation above target, the perceived target goes up and then leads to this self-fulfilling higher inflation. But it's important that in this exercise, we always assume that the central bank reaction is based on the high credibility target in the policy rule, and the agents know this, but they don't trust that the central bank will be able to bring it back to this target in the medium term. And technically, we do this by running a Kalman filter learning. So there are certain probability that when we are in the high credibility regime, that we stay in the high credibility regime, which is PTH, and the probability that we are in the low regime, that we stay in the low credibility regime, which is the PTL. And we are then putting these additional state variables which give the weight on being in a specific regime or also then affecting the expectations. We put this as an additional state into the Kalman filter state space model, and we are then filtering the data in a way that the agents are also filtering for this weight that they put on each regime, and therefore we can over time track how large the weight is on the de-anchored regime in comparison to the well-anchored regime. More specifically, I'm going to talk here about an exercise we did, and we did this with the new area-wide model, which is a DSGE model that was used very heavily inside the projection exercises and the policy analysis at the ECB. And what we are doing is a real-time exercise that we go back through all projection exercises since 2010, and we are looking at the real-time data that the forecasters had at their disposal, and we combine this real-time data with the forecast they were giving at that specific period of time. This gives us a baseline, and then we do stochastic simulations around the baseline, and also in the stochastic simulation we also always filter for the regime probabilities, and then we are calculating the de-anchoring risk around this baseline based on the stochastic simulations. And there are two definitions which are important. When the weight on the de-anchored regime exceeds 50% or 0.5, then we call the regime to be de-anchored. In the same way, when we look at all the simulations path from the stochastic simulations, if we are getting into a situation where in the simulation we get into a de-anchored regime, we call this simulation path de-anchored, and then we simply calculate how many of these simulation paths around the forecast were going into the de-anchored regime, and this gives us the risk of de-anchoring over the projection horizon in that specific moment. It's also interesting to look at the confidence bands of the forecast around projection, and we do this with the two regimes of the model, the de-anchored regime and the credible regime. And the credible regime is given by the blue line and also the blue shades, while the de-anchored regime is given by the yellow or beige line and also the shades. And you can clearly see that for the case of a de-anchored, we have much more higher inflation realization and also lower inflation realization, because in the stochastic simulations there are repeated realizations of inflation above or below target, which leads to de-anchoring, and then we have this propagation which brings us to very low inflation but also very high inflation. But you can also see on the right side that the central bank is leaning against this de-anchoring, and implying that, of course, if inflation is very high, also the response of the central bank is a very high interest rate, and the same also applies to situation where inflation is going to very low values. This is the result of the exercise. So on the right side, you can see the bars, which gives the risk of the anchoring around the projections from June 21 to September 24. And the blue lines give the downward de-anchoring. So in those cases where inflation was really going to very low values, which was the case especially before the inflation surge. And the red bars give then the upward de-anchoring, which became more prominent during the inflation surge. So if we go back and put ourselves into the shoes of the forecasters in the second half of 21, this was a situation where the euro area had been in a low inflation environment for several years, which through the lens of the model implied that the agents already put a very high weight on the de-anchored regime, and also the perceived inflation target was very low. And then when you look at the forecast that was done in 21, no one was really expecting this inflation surge, and therefore the forecast was expecting inflation to remain rather flat. And this implied that in these vintages of the forecast, we see a lot of de-anchoring, and primarily down to the downside, which gives rise to the large blue bars that you can see on the right side. Then, as you might know, from 22 onwards, the euro area went into the inflation surge period, with inflation going up to 10%. And you can see that in this situation, the de-anchoring risks were going down. And why is this the case? The case for this is that this perceived target was really still driven by the low inflation environment, and the spell of high inflation was relatively short. This implies that the perceived inflation target over time was only going up gradually, which you can see on the left side, with the perceived inflation target over the different projection exercises going up stepwise. And of course, if you have very high inflation, but the perceived inflation target is lower or very close, even lower or below 2%, then this doesn't help you to do a better forecast. Therefore, agents were not leaning towards the de-anchored model, but stayed with a well-anchored model. And this you can see here on the left side, how this then is leading over time to relatively low de-anchoring risk, but predominantly on the upside, because inflation is still currently above 2%, but it's expected to come back to 2% very soon. To get a better idea on the drivers of the anchoring, we have done here a couple of counterfactual simulations. If you look at the bar on the left, this is the September 21 exercise, the same one that I've described before, with a very low inflation profile, and in the forecast giving then rise to high de-anchoring probabilities. If we then replace the data, which was forecast in the September 21, by the data that actually materialized then, which we call ex post, we can see then that the increase in inflation was reducing the de-anchoring risks considerably, and we have much lower risks than taking on board the actual forecast. And this is by the second to the left graph mentioned, named ex post. If we go one bar to the right, we still look at the ex post case, but then also look a little bit on the contribution that the hike in interest rates that were done by the ECB in view of the inflation surge had an impact on the anchoring. And you could see here that if we take the ex post data, but assume that the ECB had not reacted, but had kept interest rates at the very low profile that was expected in September 21, then the anchoring risk would have been higher, around 30%. If you go one bar to the right with a large red component, this is a counterfactual where we assumed what would have happened if the ECB went into this inflation surge period, but before have not experienced very low inflation, but very high inflation. So we put a lot of shocks on the realized data to bring inflation to around 2.9 prior to the surge. And if you then see, do the stochastic simulation there, you would see that the perceived inflation target is significantly above 2. And also the forecast is then giving us a high inflation path, and this gives rise to a lot of upside de-anchoring. The last point here is looking at the role of uncertainty. So we see, so when we do the stochastic simulation, we normally take the ergodic distribution of the variances and simulate with that. But here on this under counterfactual, which we call high uncertainty, we increased the variance, and then if you have more variance, the uncertainty increases, and with the increased uncertainty, you also have higher de-anchoring risks. So what we can see from this are several points that help us a little bit to decide in situation, for example, when we expect a temporary deviation of inflation from target, whether this is a situation that might be dangerous in terms of the anchoring, or a situation that is where it's a very good idea to look through the temporary reduction in inflation. This already brings me to the conclusions. So what we develop here is a monetary policy framework in which the central bank internalizes the risk of inflation expectations de-anchoring, and this is modeled via an endogenous regime switching in a medium scale DSGE model. We derive, which I haven't shown here, but in the paper, we derive also the optimum policy implications of this. And there we find that, especially in the case where the reaction of the central bank has an impact on the probability of getting into the anchored regime, this leads the central bank to become more aggressive, so react more strongly against deviation of inflation from target into both directions. And of course, if we just think about the anchoring, we could also be looking at survey results like the survey of professional forecasters, or also financial market-based indicators like the five-year inflation linked swaps. But what we see as the advantage of our approach is that it's a model-based approach, and we can also evaluate counterfactuals. For example, how the risk would change if the central bank took a different course of action with lower or higher interest rates, and also condition this on specific situations in a scenario kind of analysis. So this is
okay.
Thank you.
Okay. Thank you, Kai, for interesting presentation and for perfect timing. I would like to make a question. So, do source of the anchoring are important, and how such different sources or drivers of the anchoring interplay with different sources of shocks, different nature of shocks, and different models of expectations. I mean, rational, adaptive learning, adaptive or diagnostic expectations. How all of that interplay in your model, and what the policy relevant considerations?
Yes. So the implicit background of this analysis is the idea of looking through a supply shock, right? Because if you have a demand shock, you would have inflation and output going into the same direction with a very clear idea what the central bank should be doing by simply raising rates or putting rates into the opposite direction. Sorry, in the same direction, of course. But if you have a supply shock and possibly inflation increasing, but output decreasing for the case of a negative supply shock, as we had with before the inflation surge, much more difficult, and brings then the central bank to the situation to either look through let's say the primary impact of the supply shock and only target the second round effects that come from this, or whether it should fully behave as usual by following just the idea to bring inflation back. And then we could, for example, in this case, we have also brought this into the strategy review that we have recently reassessed. And there we have the exact notion that when we say we look through a supply shock, we do this via our medium-term orientation. But we say once we see the threat of or the risk of inflation becoming de-anchored, we say then we can no longer look through, but then we need to take into account proper action by leaning against this de-anchoring.
Okay, thank you. Please, audience, I propose to left the questions from audience in chat and Q&A, and now let's thank you to the Kai, and let's continue. And I would like to give a floor to the Matthew. Please, Matthew, are you ready?
Yes, I'm ready. Hi everyone. So let me try and share my screen. Okay, hopefully you can see my screen okay?
Yeah.
Let me make it full screen, probably even better.
I guess that's better.
Okay, excellent. Well, thank you so much, Victor, for the introduction, and thanks everyone for tuning in. It's a great pleasure. So this project, which is joined with Claudio Borio, has a relatively simple ambition. We really wanted to help central banks understand how their monetary policy frameworks compare to each other, and also how they have evolved over time. And unlike the paper by Kai that we have just seen, this is going to be a purely descriptive analysis. So we're not going to take a stance on which framework works better in theory or in practice. And partly that's because we think this answer is likely to depend quite a bit on countries, in particular in terms of their institutional context, their inflation history, and so on and so forth. So why were we interested in writing that paper? Well, major central banks like the Fed and the ECB were conducting reviews of their monetary policy frameworks. Turns out that NBU was as well. There were heated debate around some aspects like the relative importance of price stability versus full employment. And at the same time as the governor's remarks made clear today, inflation targeting was also turning 35 years old. And it's quite remarkable to see how long-lasting a regime it's turned out to be. Essentially, with one exception, once a central bank adopts inflation targeting, it basically never goes back, which is historically quite unusual. And maybe one reason for that is that inflation targeting really provides central banks with a form of constrained discretion in the pursuit of price stability. So yes, on the one hand, central banks are given an explicit numerical target for inflation, but then on the other hand, they can have quite a bit of discretion in terms of, for instance, when and how to achieve that target and whether they are also pursuing other objectives. But that also raises a tricky question, which is, what is the optimal balance of discretion versus constraint in the formulation of those inflation targeting frameworks? There's people in the academic debates who think that central banks have too much discretion. So think, for instance, of John Taylor. And then there's also people who worry that inflation targeting leaves too little flexibility. Think, for instance, of Alan Greenspan. So the question we want to ask to sort of frame this debate is, how and why has the flexibility of inflation targeting varied across time and also across jurisdictions? And our definition of flexibility will be the degree of tolerance that the central bank has for fluctuations in inflation and for pursuing other objectives, in particular objectives for employment. In the paper, we're also looking at objectives for financial stability, but I won't have too much time to get into this today. So to answer this question, we are going to look at 26 countries from advanced in emerging market economies. Unfortunately, Ukraine is not in the sample. We will include a central bank from the time it adopts inflation targeting. So that's 1990 for the first adopter, which is New Zealand, and 2016 for the most recent adopter, which is India. And then for each of these countries, we're going to construct a range of indicators of flexibility. And to be clear, what we're really interested in is de jure flexibility. So how much flexibility is provided by laws or by binding policy documents, rather than how much flexibility is exercised in practice, which we know can be quite different. And to assess de jure flexibility, we're looking at official source materials that tell us about the formulation of the inflation targeting framework in a given year. So that's going to be a yearly panel. And we're going to focus on 3 types of sources: central bank laws, official announcements about inflation targets, for instance, the yearly decision by the government about the level of the target, and then so-called strategy statements. So think, for instance, of the Federal Reserve's statement on the longer-term objectives of monetary policy, which is this 2-page document that gets updated whenever the Fed does a framework review. So let me say more about what we measure exactly. So the idea is to start from a hypothetical benchmark where a central bank has 0 flexibility. So think, for instance, of a central bank that has only one objective for price stability. And this objective is for the CPI, not for core inflation, for instance. And this objective must be achieved over a specific and short time horizon, let's say 1 or 2 years. Now, let's assume that there is an energy price shock that pushes the CPI above target. In that case, the central bank has basically no choice but to bring CPI back to target over that short period of time. The formulation of the target is such that there is no discretion for the central bank to deviate from the target. And then the central bank also has no formal mandate to consider any other objective, for instance, the cost to the real economy of a drastic response to inflation being above target. So that's the no flexibility benchmark. And then starting from that benchmark, we're going to think of different ways to add flexibility along two key dimensions. So one is the formulation of the inflation target itself. And two is the formulation of the set of objectives for the central banks. Now, let's decompose these two dimensions into four sub-dimensions. So for the flexibility of the inflation target on the left of my slide, we can distinguish between the formulation of the numerical target and the formulation of the time horizon over which this target must be met. And then for the set of objectives, which is on the right of my slide, we can distinguish between objectives for the real economy, as I said, and for financial stability. And then finally, we can break down each of these sub-dimensions into 9 individual indicators. So think of each indicator as one lever that can be adjusted to increase or decrease flexibility relative to the no flexibility benchmark. And to measure specifically how much flexibility is added, each indicator will go from 0, which is the least possible flexible option for a given indicator, to 1, which is the most flexible option. So that's quite a bit to absorb, but let's try and make things a bit more concrete by looking at this table. So each item in column 3 is basically one of these orange indicators that you've seen in the previous slide. And then the final column has all the possible options for this indicator and the corresponding score. So the first indicator we're looking at is the type of target. We have 3 main options: a point target with a tolerance interval, or equivalently a target range with a midpoint inside it, and then finally a range. So clearly the range is the option that gets the highest flexibility score, because it means that more inflation outcomes can fall within the targets, and that therefore can be tolerated. And instead, when there is a point, there is no tolerance at all, and therefore that option gets the lowest score. And then tolerance intervals are in between because they give more flexibility than points, but they still imply a bigger commitment to a specific inflation level compared to a range. So the next indicator is quite straightforward. Basically, the wider the target range or interval, where there is any, the highest the flexibility, or the higher the flexibility score. Indicator number 3 is about the price index, which I've already mentioned. So a CPI target gets a low score because it effectively forces the central bank to account for price changes across the entire consumption basket. Whereas when the target is for core inflation, then the central bank can ignore some of the more volatile components. And that's also the case when there are so-called escape clauses, which is a formal commitment to ignore specific items in the consumption basket, which was a fairly common approach in the 1990s. And then we have an indicator for the time horizon over which the inflation must be on target. So there is a low score when this horizon has a specific numerical value. So for instance, 1 or 2 years, for instance, the Central Bank of Chile. And then a high score when the horizon is only qualitative. So for instance, we've just heard from Kai that the ECB aims for inflation to be on target in the medium term. Now, let's move on to the set of objectives, namely for the real economy first. So for each objective, we're going to consider 2 aspects. One is what we call the status of the objective. So that's the standing of the objective relative to the objective for price stability. And the idea is that the higher the standing of an objective, the more strongly, the more clearly the central bank has a mandate to deviate from strict inflation targeting in the pursuit of that other objective. So the highest score is when the objective has the same status as price stability. So think, for instance, of the US or Australia, which have dual mandates for price stability and full employment. And then the second highest score is when there is an objective, but it's only a secondary objective. So think, for instance, of the UK. And then third option is cases like New Zealand, where there is no formal objective in the law for the real economy, but then the framework still commits the central bank to take some account for the real economy when they conduct monetary policy. So that's what we call the consideration rather than an objective. And then the second aspect we consider for each of the objectives is what we call the degree of ambition. And that accounts for the fact that objectives can be formulated quite differently. So for instance, the Fed must achieve full employment. So it must effectively achieve a given level of employment, which is a strong commitment, whereas other central banks, according to their laws, must only aim to, say, mitigate volatility in employment. So that's a lower degree of ambition in our scoring system. And again, the score assumes basically that when the formulation is stronger, then the central bank has a stronger mandate to deviate from strict inflation targeting. And then the logic for financial stability is similar in spirit, but I won't have the time to get into the details. Okay, now let's move on from methodology to results. I'll just highlight a couple of high-level results. There's obviously more in the full paper. So to get started, I want to compare how frameworks look like as of today across those 26 jurisdictions. And just to be synthetic, I won't show every indicator, but only averages of indicators for 4 sub-dimensions. So remember those blue boxes in my tree slides early on. And for each indicator average, I will compare the values as of today across advanced economies, which is on the left of my slides, and emerging markets on the right. And the red dots you can see on the charts, these are average indicator values, again, going from 0 being least flexible to 1 being most flexible. And then there are whisker boxes for you to get a sense of dispersion within central banks. So first interesting pattern, well, if you look at the size of these whiskers, you can see that there's more heterogeneity in emerging markets. So that probably, emerging markets themselves being more heterogeneous, for instance, in terms of their histories of inflation or their institutional contexts. Instead, it seems to be that advanced economies have converged to a relatively homogeneous approach to inflation targeting. So how do these approaches look like? Well, let's start with the formulation of the inflation target. So that's the first 2 columns on each graph, where you can see 2 striking patterns. One is that advanced economies tend to be stricter in how they formulate their numerical target for inflation. So for instance, they're more likely to use point targets rather than target ranges. But 2, advanced economies are more flexible in terms of the time horizon to meet that target. So they're less likely to commit to a short, well-defined target horizon. So how to make sense of that? Well, in emerging markets, inflation is typically more volatile, for instance, because of commodity and food prices being more important. So committing to a strict inflation target can be seen as more challenging. And then because of the history of typically higher inflation, it can also be harder to retain credibility over longer horizons. So that might effectively force emerging market central banks to commit to stricter target horizons, whereas advanced economies can afford to leave inflation above target for longer, at least in our interpretation, without fearing as much for credibility. So let's turn to objectives. There's another interesting bifurcation. Advanced economies generally put higher weight on real economy objectives. Around 2/3 of advanced economy central banks have formal objectives for the real economy versus only 1/3 among emerging markets. And that's also consistent with this credibility story I've mentioned, because when there is a longer record of low inflation, then having an objective that might, in some circumstances, be in conflict with price stability might be seen as a smaller threat to the credibility of the inflation target. And then financial stability has a lower weight in advanced economies than in emerging markets, which is probably consistent with the history of financial crisis in some emerging markets, and then the role of monetary policy in addressing those financial crises, for instance, when it's linked to sudden stops. So that brings me to my next theme, which is around how these frameworks have evolved over time since inflation targeting is first adopted. And to discuss this, I will keep the same 4 core indicators you've seen in the previous slides, but I will plot their average values since the 1990s. And here I'm starting with only advanced economies. So let's start with the specification of the inflation targets, where you can see 2 key trends. One is the red line, which says that over time, numerical targets for inflation have become stricter. And 2, if you look at the blue line, then over time, advanced economy central banks have become much less strict in terms of the horizon to meet their inflation target. Now, if we turn to objectives, again, there's 2 striking trends. One, so if you look at the yellow line, it goes from pretty much 0 in the 90s to 0.5, which means that the way that central banks put on real economy objectives has increased quite strikingly. And 2, if you look at the purple line, which is the weight on financial stability objectives, it also goes up, but only later and more weakly so. And then interestingly, it starts falling back from the late 2010s. The third interesting stylized fact is that if I now look at emerging markets, then all these trends I've just discussed are quite a bit weaker. So how can we make sense of these patterns? Well, there's really 2 key drivers that we emphasize in the paper. One factor is the likely increased confidence over time in central banks' ability to control inflation, and therefore in the credibility of the regime. And to see where that confidence comes from, you can look at the gray areas on these 2 slides, which are the interquartile ranges for inflation. And you can see that inflation falls back sharply in advanced economies already in the mid-1990s. It converges to around 2%, whereas in emerging markets, the average comes down later and by less, and then dispersion remains larger. So, sorry, I'm having issues with my mouse here on my screen. Okay, so to get a fuller picture, let's look at individual indicators separately. So the red lines on my slide are for advanced economies, and then the blue lines are for emerging markets. So what do we see? Well, by 2008, so within these yellow boxes I've drawn, well, almost all advanced economy inflation targets had already given up several levers of flexibility. Target ranges were largely gone. Instead, central banks were more likely to have point targets. That's the first panel. And then where there was still a target range, it had become much narrower. That's the second panel. And then targets for core inflation had also largely disappeared. That's panel C. And then the weight on the real economy, again, by 2008, had already increased quite a lot. And then all these trends are much weaker in emerging markets, which is in line with the confidence in the ability to hit targets not having grown by as much as in advanced economies. Now, the interesting question is, well, how can a central bank become significantly more ambitious for inflation and for the real economy at the same time? And well, one way to do that is to become less strict about the time horizon to meet the inflation target. So that would, for instance, allow the central bank to let inflation be above target for some time if bringing it back more rapidly is just too costly for the economy. And that's exactly what we see in this graph, which is by 2008, basically all advanced economy central banks had stopped committing to a specific horizon to meet the target. Now, the second key driver that we highlight in the paper, and which is quite straightforward, is the global financial crisis. So in advanced economies after the global financial crisis, the problem was inflation being too low rather than too high, and that led to fears of deflation, and therefore, as we also heard from Kai's presentation, to an even greater focus on managing expectations so that expectations would not fall below the target. And that effort is clearly visible on my slides through inflation targets getting even stricter after the financial crisis. Now, at the same time, it's also likely that low inflation gave central banks or governments the confidence that that central banks could afford being more ambitious about the real economy. And you can see this through the continued increase in the status of real economy objectives and the ambition for these objectives. And unusually, there is also a similar pattern in emerging markets. So that's the blue lines, although that happens quite a bit later. So let me leave it there and just offer a couple quick thoughts by way of conclusion. So yes, inflation targeting is a remarkably long-lasting regime, as the literature has highlighted. But then one thing that is less appreciated and that we hope to shed light on with this paper is that inflation targeting has evolved quite significantly. In emerging markets, inflation targeting is still quite a bit closer to how it initially looked like. But then in advanced economies, there has been significantly more ambition over time, both for inflation and for the real economy. And it's this increasing vagueness of time horizons to meet the inflation target that seem to have provided some of the flexibility to pursue these two objectives at the same time. So inflation targeting looks highly adaptable as a regime. That's probably one of the reasons why it's so ubiquitous internationally and so long-lasting. And then if we look at the COVID experience, it also seems to be the case that those frameworks did play their role in that, at least in advanced economies, central banks tolerated inflation being above target for quite long periods of time, without inflation expectations moving up by quite as much as realized inflation. Now, clearly, there is a need for more normative analysis of how these different shades of inflation targeting perform. But we really hope that the data set that we provide with this paper can be a useful starting point for researchers in that respect. So that's all I wanted to say, and I'm happy to take any question. Thank you.
Okay. Thank you, Mathieu. Very interesting presentation, very interesting paper. I should say that I have read it when it was published on the BIS website. Very interesting, very exciting. And I have a very small methodological question. Why do you avoid to pay attention to level of the target?
Right. So we do have a variable in our data set that records the level of the target, and as you allude to, there has been many changes over time. Now, the level of the target in and of itself, in our view, doesn't really affect flexibility, because for the important thing when it comes to flexibility is really how much discretion there is around the particular level that is being targeted. But whether this level is 3%, 1%, or 5%, in our view, does not affect flexibility as long as it's a point target. Obviously, if it's a range, then that's a different story, and that we're capturing in the data.
Okay, thank you. Due to time constraints, I invite audience to leave the questions and Q&A. And one more thank you, Matthew. Very exciting presentation, and it's a good example how empirical work support the intuition. Thank you very much. Now let's continue, and I would like to invite Magnus to join us. Please.
Yes, thank you. Can you hear me?
Yeah, we hear you. Okay.
As you perhaps know, we have a lot of problems actually connecting to this seminar. But I think the video does not seem to work, but at least you can hear me, and that should hopefully be enough. So let me first say that the work that I will present today is joint work with two economists from the National Bank of Ukraine, Olex and Nadia, as well as Ingvar from the Riksbank. And regarding this work, all four of us would like to express our gratitude to Jesper Lindé and to Marcin Kolosa from the IMF. As I will discuss later, we are using a model developed by them together with other economists at IMF. But this work would not have been possible without Jesper's and Matthias' great support. So we are very grateful to them. Okay, let me now move on to the presentation. So over the past decade, geopolitical tensions have increased all over the world. Wars, sanctions, and trade conflicts have changed international relations in ways that few could have anticipated. And the perhaps most important cause of rising geopolitical tension has been events in Eastern Europe. The Russian annexation of Crimea in 2014 marked a turning point, and then the full-scale invasion of Ukraine in 2022 pushed global tensions to even higher levels. Now, these events are very evident in the so-called Global Geopolitical Risk Index, an index that was developed by two economists, Dario Caldara and Matteo Iacovelli. So next slide, please. So this diagram shows the geopolitical risk index globally, which is the blue line, and for Ukraine, the red line from 2000 up until today. In this diagram, we have normalized the index by deducting the mean and dividing by the standard deviation. So the effect of the annexation of Crimea in 2014 and the full-scale invasion in 2022 are clearly visible in the diagram. And as expected, the effects of the full-scale invasion are significantly more pronounced than the annexation of Crimea in 2014. Note also that the increases in the Ukrainian risk index happens before the increase of the global index, which is of some importance when we will analyze international spillovers. So next diagram, please. Now, for analyzing geopolitical risk, we think Ukraine offers a unique case study. So let me give some example why this is the case. Now, inflation targeting is a different challenge under wartime conditions. The policy trade-offs can be much more difficult. We're likely to have very high inflation due to supply disruptions and sharp currency depreciation, which must be weighted against a large fall in output due to war-related destruction and maybe also migration. And Ukraine's experience also offers a rich case for policy analysis, not only because of the scale of the shocks, but also because of the fiscal responses. We have seen the use of capital controls, foreign exchange interventions, and other unconventional measures that go well beyond the standard inflation targeting framework. And Ukraine's experience also offers a possibility to study both domestic and global dimension of geopolitical risk shocks, as you could see in the previous diagram. And finally, there is an interaction between monetary and fiscal policy, and war financing adds another layer of complexity for the central bank. Next slide, please. So let me now say something about why geopolitical risk shocks matter for monetary policy. And since they propagate through many channels, they are likely to complicate monetary policy analysis. For example, they may create increased uncertainty about future economic conditions, which will affect investment and consumption decisions. We may also see capital outflows and currency depreciation as investors seek safe havens. This would typically be accompanied by come together with higher risk premia and the widening of credit spreads, making financial conditions tighter. And disruptions in energy and commodity markets lead to cost shocks and inflation, adding pressure on prices globally. At the same time, governments tend to increase spending, often financed by debt, to address security and humanitarian needs. So the combination of many different channels complicate monetary policy trade-off. And I think geopolitical risk shock would have a large scope for analyzing different policy interactions. So next slide, please. So the overall purpose of our study is to examine how geopolitical risk affects monetary policy trade-offs and how monetary policy should react to a geopolitical risk shock. And we will focus on Ukraine's geopolitical risk index as a unique case study, but as I mentioned, we also consider international spillovers. Next slide, please. So I will not say much about related literature in this presentation due to the time constraint that we have, but also because there are indeed few studies that have formally integrated geopolitical risk into monetary DSG models, perhaps because of the intrinsic complexity that I talked a little bit about of geopolitical risk. Although there have been a number of empirical studies, mainly BVAR studies, but I will not talk about them here. So next slide. So during the rest of the talk, I will discuss what we do, and I should emphasize that much of the things are stuff that we plan to do. So the results are very preliminary, and most of them are work in progress. Okay, next slide. So let me say what we are planning to do, and I have divided this into 3 steps. The first step is that we will estimate IMF's quantitative model for the integrated policy framework, or IPF for short. And then the estimation we will do with standard Bayesian methods. Now this model comes in many different variants with different features, actually more than I show on this slide. However, the model we are using is the empirical formulation developed by Chen, Colosa, Linde, Wang, Sapchik, and Xu from 2020, which you can find as a working paper from the IMF from 2023. Okay, next slide. So this is a 2-country new Keynesian model, which is similar in spirit to many of the types of DSG models that central banks are using. And some of the key features include nominal rigidities, of course, the imperfect exchange rate pass-through, and there are also a number of financial frictions, such as shallow foreign exchange markets and occasionally binding debt limits. So this feature implies that policymakers have a reason to use many tools jointly. It could be interest rate policy, foreign exchange interventions, and capital flow management. And we can also use this framework to analyze international policy spillover, since it is a 2-country model. So next slide, please. So in step 2, we will identify a geopolitical risk shock, which obviously will not be very easy to do, but and there might be different methods to do this. The approach we are starting with is to examine which innovations from the estimation are most closely associated with moments in the geopolitical risk index. And then we will focus on two key episodes that I mentioned: the annexation of Crimea in 2014 and the full-scale invasion in 2022. So the idea is to construct a composite geopolitical risk shock, which will be a combination of the most important innovations that are linked to the index in 2014 and 2022. And this means that we will have two case studies, which will enable us to actually assume or examine whether the nature and transmission of geopolitical risk in 2014 differs from what we observed in 2022. Okay, next slide, please. So in the third and final step, we plan to illustrate how different policy tools interact in response to the geopolitical risk shock that we have identified. So we will look at interest rate policy, foreign exchange interventions, and capital flow management, and perhaps also fiscal policy. And then we will also examine how monetary policy should react to the geopolitical risk shock. So this would be a more normative analysis. And as a first step, I think we will consider simple optimized policy rules and perhaps also optimal policy. So next, please. Okay, so let me now show some of the very preliminary results that we have from the estimation. So I will first show an impulse response to the monetary policy shock and an exchange shock. So here is this graph shows the effect of a monetary policy shock according to our estimation on Ukrainian data. So qualitatively, we get expected result, I think. An increase in the policy rate dampens both inflation and output, and we get an appreciation of the exchange rate. However, we are also planning to find different ways to examine if this impulse response to the monetary policy is also quantitatively reasonable for the Ukrainian economy. For example, we could compare this impulse response to those from NBU's QPM model, or there could be other ways that we could look at as well. So next slide, please. So this is the effect of an exchange rate shock, perhaps best thought of as an UIP shock. Also here, the qualitative effects appear reasonable. A depreciation of the exchange rate leads to higher inflation and a more contractionary monetary policy. Output first increases a little bit and then falls. And also for this shock, we will investigate if the quantitative effects are reasonable for the Ukrainian economy, perhaps also by looking at the QPM model. Next slide, please. Okay, so this diagram shows the geopolitical risk index globally and for Ukraine, as we have seen earlier. But now we have also added the three shocks that appear most associated with events in 2014 and 2022. I understand that it can be a bit difficult to actually see what is happening here, but I can tell you that innovations to the price markup shock, the export pricing markup, and the import consumption price markup shock are the three innovations that are most associated with the increase in the risk index in both 2014 and 2022, according to this very preliminary estimation we have. And the last two diagrams show the innovations to the policy rules, that is the interest rate rule and the foreign exchange intervention rule. So when we create the geopolitical risk shock, it makes sense not to include the innovations to policy in this geopolitical risk shock. However, when we show the effects of the geopolitical risk shock and judging its plausibility, it may make sense to actually include these two shocks. The argument is as follows. The interest rate rule and the foreign exchange intervention rule are expected to work well in normal times. But in extreme times, for example, in a financial crisis or a war, these rules should not be followed for good reasons. So the shocks and innovation to the policy rule would capture this change in behavior. That is, they should not be interpreted as error, but as appropriate deviations from the rule in a crisis situation. Okay, next slide, please. So in this diagram, we show the effects of this geopolitical risk shock that combines those three shocks that I just showed you. And the blue line is 2014 and the red line 2022. So the geopolitical risk shock leads to a sharp increase in inflation and a fall in output, as well as an appreciation of the exchange rate. Now note that these are responses when interest rate and foreign exchange intervention follows the normal behavior. Note also that there are perhaps important differences between the 2014 geopolitical risk shock and the one from 2022. But I should stress that this is very preliminary results and we need to further analyze these differences and also the result more generally, of course. Okay, next slide, please. So this is the final slide that I want to show, and this shows the effect of the geopolitical risk shock when we have added the two policy shocks. That is the policy rate and the foreign exchange intervention shock. Now, in this case, we get results that perhaps are more in line with the actual experiences in 2014 and also 2022, at least in the sense that we notice that the interest rate actually increased in this case, which I think was also the case the actual case. Now, I will not say much more about these results, I think, since they are just too preliminary to draw any real conclusions from. So I will stop here and thank you for listening. And all four of us are willing to answer any questions, or if you have any comments, they are, well, we look forward to them as well. Thank you.
Okay, thank you, Magnus. Unfortunately, we have no time for questions and for discussion. I hope all panelists will get questions in chat and may respond on them. And now one more thank you for our panelists, for Kai, Matthew, and Magnus for their participation and contribution and for very interesting presentations. So I would like to pass the floor to the Alexander for next announcements. Thank you. Alexander, please.
Yes, I'm very sorry. Since we do not have time for break now, I think we can start with the next session. I know Martin already is here. Martin, are you ready to start? Great. So the floor is yours, Martin.
Thank you. Thank you very much. And sorry to all the participants that will just skip this break, but we will, be efficient in this panel, and I'm sure you'll have a little bit of time afterwards to catch a breather or a cup of coffee or something. Well, thanks very much, Alexander. Thanks to the National Bank of Ukraine for having all of us. And we, of course, know that you work under difficult circumstances. So we're all the more grateful for you having us. I'm very pleased to be moderating this panel. My name's Martin Sandbu. I'm the European economics commentator at the Financial Times, so I'm calling in from London. The title of this panel is Monetary Policy Under Pressure and the Path Ahead. That, of course, is in the context of inflation targeting, the overall theme of the conference. And we have three very good speakers to join us to give their reflections on the way in which the monetary policy framework we have all been using for the last 30 years or more, to share those reflections with you, and I hope we can get a good discussion with everyone who participates. So we're going to have in this order Armen Nurbekian from the Central Bank of Armenia, Volodymyr Lepshinsky from the NBU, one of our hosts, and Boris Hoffman from the Bank for International Settlements. And I will ask them all to give their initial reflections in that order, which is the order you appear in the program. But let me just take 1 minute to set the scene a bit, because as I mentioned, intellectually, inflation targeting has kind of ruled the roost since the early 1990s, and it came out of the kind of economic challenges, monetary and overall macro policy faced in the 70s and 80s. And it's had a good record. It can probably be credited in the advanced countries for the great moderation in the early 2000s. But ever since the never-ending crises, starting with 2008 and the global financial crises, it has increasingly started to creak a bit at the seams. And I think there's a general sense that things aren't going as well as maybe we would like them to. And one way to put the challenge is that we are having a lot more supply shocks than we thought we would be having. Back in the day, monetary policy and this framework in particular was seen as dealing with the demand side, smoothing out, stabilizing demand shocks. And supply shocks have never really been the sort of thing that central banks are very good at addressing. But I think there's a good case now that the world is facing more frequent supply shocks than we expected. We've had a lot of them recently. I don't need to tell our friends in Ukraine who are facing, well, much more than a supply shock, but it's also the biggest of all supply shocks. A war is that. But everywhere we are facing both increasingly frequent national, but obviously global shocks, some of them policy induced. The quite concerted effort now to change the monetary and economic order that we had, that inflation targeting was the monetary complement of in the 1990s. So it's a challenging time. And I think one way I've framed the question for the panelists is inflation targeting still fit for purpose? Maybe it needs small tweaks. Maybe it still works more or less. Maybe it's the best we've got, or maybe it needs some big overhaul or radical change. That's the kind of challenge I've given the panelists in preparation. So I will now give the floor to them in the order I said and let them have initial reflections on how well they think inflation targeting is performing and what, if anything, we need to do about it, drawing on some national experiences as well. And then we will try to have a discussion in the panel before we open up to questions to all participants. Feel free to use the chat to put questions in underway, or you can raise your hand once we get to the Q&A session, and I will try to call on people. If you put questions in the chat, I will incorporate them in my own questions in the second half of the panel. Armen, I'm going to start with you. You're first in the program, and you'll be first on the floor, so please take it away.
Thanks very much, Martin, for the very eloquent introduction. And I'm really sorry that we are the reason that participants are not having their coffee, but we'll try to do our best to make it interesting. I think there is no question that overall the volatility around the world has increased, and I don't think there are signs that it's going to be reversed soon. So I think the question whether the inflation targeting is still intact in terms of its major principles is really central. But before that, I think we basically have to define what is it that we call inflation targeting, right? Because at the core of the inflation targeting frameworks, I think, looking at the innovation which really happened in New Zealand in the beginning of the 90s, is really having a very structured process around establishing a nominal anchor in the economy. And basically, it entailed having a clear inflation target, outlining what are the instruments that you are going to use in terms of bringing the inflation back to the target, and so on and so forth. So basically, in short, it is a structured process, which is actually triggering lots of transparency for the central banks to establish a nominal anchor in the economy. So in that sense, I think if you put it that way, the question if, during the more volatile times, is it more important or less important to have a nominal anchor and have a structured process around it? I would argue that it's
Have we lost Armin, or is it just me?
I think we lost him.
Okay, let's give Armin another 20, 30 seconds. If not, Volodymyr, you're next on the program, so get ready to stand in, and then we'll bring him back in later. But these are, told you, more frequent supply shocks. Okay, I think we've lost Armin temporarily. I'm sure that he will be reconnecting, and the NBU team will be in touch with him if he needs help. But instead of waiting, I think I'll just ask Volodymyr to step in. Is that okay, Volodymyr?
Yeah, sure.
Very good. Okay,
think,
I will. So we go to your initial reflections, and then whenever Armin comes back in, we will return to him.
Yeah,
but do your whole introductory remarks, please.
Yeah, thanks. So I think Armin already did quite good introduction, in a way of how we need to think about inflation targeting and how it could evolve and how it should evolve actually as a monetary policy regime. So of course, like if we go deeper into history, why actually inflation targeting emerged is because there are no viable alternative to that, because it's a regime which proved to be quite durable from medium to long run, and strategically it consists of several elements which are still in high demand for monetary policy. So it consists, in my view, like several elements. The most important one is the commitment of the central bank to its mandate of price stability. It's a clear nominal anchor. Prioritization of goals. It has a framework built inside the regime in terms of transparency and accountability. At the same time, inflation targeting gives quite honest degree of flexibility for the central bank and some room for maneuver to achieve its goals of price, financial stability, and supporting sustainable economic growth. So I see no alternative how these strategic elements could be combined to consist a durable and viable monetary policy strategy and framework. One could argue that in times of such unpredictability and predictable environment, it might be advisable for central bank to use some kind of eclectic regime. It could be for some very limited period of time serve as a temporary solution, but not the durable option. As central bank in such a regime, an eclectic one with multiple tasks without strong prioritization of them, it becoming both responsible for everything in the economy and for nothing at the same time. So that definitely hampers transparency and accountability of monetary policy. And without transparency and accountability, the central bank would face the risk to lose its independence. So strategically, inflation targeting remains a viable long-term practical solution. However, like as a framework, it needs to be adapted for challenges because like in our experience, we faced this unprecedented shock and actually introduced inflation targeting in 2015, where there was a war started. So, of course, it was adapted at that time. And during the times of full-scale invasion, we needed to elaborate further in terms of this regime, in terms of adapting the analytical framework, policy making, monetary policy toolkit, and definitely communications of monetary policy. So there are, like, for me, there are several dimensions how inflation targeting should evolve as a framework. So there should be more emphasis on scenario analysis for policy making reasons. So of course, there is like the need to produce alternative scenarios in addition to the baseline, communicate them, but we need to understand that the cost of producing alternative scenario and especially publishing them is you could lose the focus on the main scenario. So there should be some balance between them. And of course, the central bank should not create perceptions that is moving along several scenarios at the same time, because that will be a communication challenge created by the central bank itself. So the proper identification of baseline assumptions is needed even when you're producing alternative scenario. The second element is contingency planning. So proactive elaboration of plan B, plan C for relevant scenarios, it's vital. So even in the times of unprecedented shock, you need to have a plan and communicate it clearly to the public, because otherwise there will be no possibility to deliver nominal anchor and to guide expectations. We need to concentrate on mechanism to analyze the experience of past shocks, assess the effectiveness of policy decisions, and adjust the instruments. So that should be a regular review framework, what worked in the past crisis and what did not, to improve our readiness to respond to future shocks. I think in this quite uncertain environment, the public needs to clearly know the reaction function of the central bank. So if there is a shock, there should be a reaction. And but at the same time, the parameters of such reaction could be calibrated over time. And the aggressiveness of monetary policy reaction, it needs to be calibrated on the stock of accumulated credibility. And these parameters could change over time. But I don't think there is much room to look through the shocks in this environment. Of course, there could be the cases when it could be a solution, but I think we'll be facing less of such instances in the future. And consistent communication. So central bank needs to be humble. So the main goal in communications and not to convince the public of the baseline forecast and policy scenario, but to make sure that reaction function is understandable and known, and that is a gentle balancing act, not to be overconfident as a central bank, but to preserve the consistency of a policy. And in this actually, in reacting to the shocks, it's better to have policy mix instead of single instrument. So where currently we use a strategy of inflation targeting, but we have mix of policy instruments instead of single one key policy rate. But of course, it's a challenge to calibrate these instruments and to have proper combination of them. It's a challenge in terms of policy making and in terms of communication. But it makes monetary policy adaptable and able to deliver its final goal in terms of price stability and managing inflation expectations. So thank you. That's mainly what I wanted to say.
Thank you very much, Volodymyr. That was excellent, and thanks for stepping in when we lost Armen. Armen, welcome back, and thank you for proving my point that we have ever more frequent supply shocks.
You read my mind. That's what I wanted to say, that the shocks are there. Sorry, I'll finish in 3 minutes, but I had a last glance at what Volodymyr was saying. But I think
take the time you need, Armen, if you need to kind of restart.
No worries.
Don't sell yourself short.
No worries. So basically what I was saying, that I think what Volodymyr has reiterated, is that it is indeed even more important right now to have a nominal anchor. Now, I think, so in that sense, my answer is, in short, that the core principles are still very important and even more important. I think where we need a very big change is the way that the central banks are practicing inflation targeting. And this is the reason that Central Bank of Romania has actually made a big pivot 2 years ago, and we changed fully our framework, the way we operate it and the way we communicate with the market. And the main argument, the central argument, is that if you look at what's happening around the world, in our opinion, the central banking and monetary policy has become too much about forecasting, too much about the accuracy of the baselines, 0.1 here, 0.2 there, rather than fundamentally a risk management exercise. And what we think is really that monetary policy is a risk management exercise. And it is important because if you look at the policy from the risk management perspective, and if you look at the policy from the sort of a hitting the baseline forecast perspective, you actually have a very different policy action, and you actually have a very different.
I hope we haven't lost him again, but we will wait and see. I feel we have. Boris, if he's not back in 15-20 seconds, are you I trust that you switched on your camera, so I take it you're ready.
Yes.
But let's give him a little bit of time. We will end up having his contribution in 3 pieces, but I'm sure he will be back. No, he's off. And if I don't see him back on in 5 seconds or so, I think, Boris, we just go ahead with you, and I'm sure Armen will be back and he will put the pieces together for us. Boris, why don't you go ahead?
Yeah, thanks a lot, Martin. Yeah, first, thanks a lot to the organizers for including me in this very interesting panel. Actually, I have prepared some slides, so if it's okay, I'm just going ahead and share them just to spice up a little bit the points I'm going to make. So obviously
we
important
can see them, so that's good.
Thank you. So important, of course, everything I'm going to say reflects my own views, not necessarily those of the BIS, so standard disclaimer applies. So what I was planning to do was actually to go into 3 points. So first I wanted to discuss the challenges for monetary policy from supply-driven inflation, which is a point Martin had emphasized and highlighted. So we'll mainly talk about that, but I will also briefly discuss the challenges that come from fiscally driven inflation. and actually highlight some interesting parallels to the channels that arise from supply-driven inflation. And then finally, I want to briefly talk about what is now frequently discussed as the affordability crisis, which is essentially referring to the difficulties of increasing number of households to essentially cover the basic costs of living as a factor, as I think that could greatly magnify the challenges that inflation targeting frameworks and central banks more generally might be facing going forward. Now, first on the challenges from supply-driven inflation. So obviously, in the inflation surge, we saw, if you want, a spectacular comeback of supply-driven inflation. So here I have just plotted the standard series of two series that disentangle demand and supply-driven inflation for the United States. This is from Adam Shapiro, which is a frequently used decomposition used in the debate. And this basically shows the red line here, supply-driven inflation, the blue demand-driven inflation. And that shows that in the inflation surge, there was a very considerable supply-driven component to it, which was actually similar to what we experienced in the great inflation of the 70s. Although here the chart also shows, of course, that there was also a considerable demand-driven component to it, reflecting in part the fiscal challenges that I will briefly discuss later. Now, so that means supply-driven inflation was a major challenge for central banks in the inflation surge. And I think there are reasons to believe that it will remain a challenge going forward for several reasons. On the one hand, there's the risk of more frequent adverse supply shocks, obviously in the wake of geopolitical tensions, but also due to climate change and the green transition. And then more generally, supply may become less elastic due to deglobalization and shrinking labor forces, which would mean that all shocks might have larger effects on inflation. And at the same time, there might be potentially greater underlying inflationary pressures in our economies. Now, when you look at the literature, it's interesting to recap what actually the literature prescribes in terms of how monetary policy should respond, and also how central banks talk about it, how they respond to supply-driven inflation. And here, there's quite clearly the notion of if you want, the paradigm of a looking through approach to supply-driven inflation. So essentially that central banks should not respond to supply-driven inflation as strongly as it does to demand-driven inflation for various reasons. From a theoretical point of view, on the one hand, there's the transitory nature of many supply shocks, such as commodity shocks, which means that by the time monetary policy responds to it, the effect might already be fading out, so that essentially the monetary policy response might actually have a destabilizing effect. Then there's, of course, also the trade-off between inflation and output stability in the case of supply shock. And also supply shock pushing inflation output in opposite directions, thereby raising a stabilization trade-off, something that central banks do not face when there's a demand shock, which pushes these two variables in the same direction. Now, of course, important to note is that this prescription of looking through supply shocks very much depends on the precondition of inflation expectations remaining firmly anchored. Yeah? So, of course, if there would be signs of an anchoring of inflation expectations, then central banks would need to step in and tighten monetary policy. And I think this is essentially also what we saw in the recent inflation surge. And of course, these basic theoretical considerations are also reflected in central bank doctrine. When you look at their speeches and official communications, here just put two prominent references from Brainard and from Chairman Powell of the Fed, essentially reiterating this prescription of monetary policy to look through supply type shocks when they're facing these challenges. And what is interesting is that, in fact, when you look at the actual conduct of monetary policy, you can actually see this paradigm of looking through reflected in estimates of Taylor rules. So here I show a chart that I took from a recent quarterly bulletin co-authored with my colleague Christina Manet and Benoit Maujean, where we essentially revisit standard monetary policy reaction functions in the form of conventional Taylor rules for a set of inflation targeting economies. And what we find is essentially when we decompose inflation into its demand and supply driven component, then we in fact find that there's a much stronger reaction to demand driven inflation than to supply driven inflation. This is what you see here in the right panel, where the light green bar shows the reaction coefficient to demand driven inflation, and the dark green one is the supply driven inflation to the reaction to supply driven inflation. And you see that the reaction to demand driven inflation is more than 3 times stronger. So this essentially suggests that central banks need to follow this approach effectively in their conduct of monetary policy, and this is also what we can glean from looking at the actual monetary policy response during the inflation surge. So here you have on the left the headline inflation, core inflation rates in red and blue, and then the policy rate in yellow for a group of advanced economies on the left, and on the right for emerging market economies. And there we can see in a way that that there was obviously a delay in the response or in the tightening after the inflation surge, most likely reflecting these considerations of looking through supply-driven inflation, and then essentially central banks pivoted and tightened very, very drastically when they saw that this inflationary shock was more persistent than initially anticipated. What is interesting to also take away from this chart is that emerging market economies, that they tightened actually faster than advanced economies. So they reacted more quickly to the inflation surge, probably reflecting the fact that inflation expectations are less well anchored there, right, which is one of the preconditions of the ability to look through supply-driven inflation. So this is essentially, I think, reflected in this faster reaction of emerging market economies to the inflation surge than what we saw in advanced economies. Now, very briefly on the challenges coming from fiscally driven inflation. So when we look at the fiscal outlook, we see that not only is public debt levels in both advanced and emerging market economies already at or near historical record levels, but when you look at projections of debt levels into the future, then we see that actually these debt levels are projected to rise even further. In fact, very significantly, also depending on what you're factoring in. So this is here a baseline. The red dot, the broken line, is the baseline based on the current deficits, and then the blue one is if you add age-related spending, and then the purple one if you then add additional 2% as an approximation of additional spending pressures coming from, say, a climate change or additional military spending in response to geopolitical tensions. And so the bottom line is that there seems to be a greater risk of fiscal pressure on central banks going forward. And interesting, when you look at the literature there's again, if you want, looking through a prescription, which essentially says that monetary policy should actually accommodate what is called unfunded fiscal shocks, which essentially refers to fiscal shocks that are not backed by correcting fiscal adjustments in the future. So this is the central result of the literature, which in a way, interestingly, mirrors the prescription of the literature for the response to supply-driven inflation shocks. And of course, when we just saw this the chart with the fiscal projections, obviously going forward, there's the risk that we may have more of such unfunded shocks going forward, which then would mean, okay, there's a prescription central banks to look through them, thereby allowing for more frequent deviations of inflation from target. Now, one factor that might greatly magnify these challenges is what is discussed currently as the affordability crisis, which is essentially the increasing problems of many households to cover the basic expenses for their living. And here, essentially, the point is that what we saw during the inflation surge was not only a major surge in inflation, but in fact a major surge price levels, both in advanced economies and also in emerging market economies, which I show here in this chart. So since over the past 5 years, price levels have risen on average across AEs and EMEs by more than 20%, but at the same time, wages have not really kept up with this increase, as you see here. So real wages, they have started to catch up, but they are in both advanced economies and particularly in emerging market economies well below the extrapolated trend from before 2020. Now, what does that mean for central banks? Obviously, the price level surge may be a factor that might have dented trust in money and in central banks, which may be an issue going forward when the central bank again faces inflationary shocks, as it could mean that there might be less tolerance by households to on their side to look through these inflationary shocks. So there's a greater risk of potentially the anchoring of inflation expectations, which is in fact something that Kolbion and Yuri Gorotnichenko in their work have pointed out, that household expectations are actually intrinsically not anchored, which then further reinforces that risk. And of course, it's further reinforced by the observation that actually households often prefer lower inflation rates than central banks actually target. And now, of course, central banks have for an extended period gotten a much larger inflation rate. So this, in a way, is probably a factor that central banks need to take into account. And in fact, they are doing that as reflected, I think, in recent monetary policy reviews by major central banks, so by the Fed and also by the ECB and others, which essentially had as one key element a removing of the loosening bias in the formulation of strategies that was added after the impressions of the ZLB period post great financial crisis and aimed at addressing the limitations. So essentially in these recent reviews, many of the key changes actually removed these previous changes in order to establish more symmetry in monetary policy, obviously under the impression of this significant increase in inflation and in price levels that economies experienced over the past couple of years. Now, what this means for inflation targeting, to come back to the question that Martin asked. So I think I would definitely agree with the previous interventions that inflation targeting remains the right strategy for central banks, so as it provides a nominal anchor and it provides flexibility to respond to shocks. But I think it's also important to bear in mind that inflation targeting regimes are ultimately a means to deliver on the mandate of achieving price stability, which means that probably central banks should not overdo it with reacting flexibly to shocks and essentially allowing for deviations of inflation from target, in particular upward deviations. Thank you very much.
Thank you so much, Boris. Lots to chew on there that we will get back to. Armin, you are back. We're going to give it a third try. You were at a really interesting place when you got cut off, because you were just pointing out the distinction between central banking as aiming for accurate forecasting versus risk management, and saying that which perspective you take leads to quite different ways of doing policy. And I think you were just about to give some examples to elucidate that. So please do, and we're just keeping our fingers crossed that
really sorry. I'm really sorry. I'm hoping this time I can finish it. But basically, this is exactly my point, that in fact, if you look at so fundamentally, if we're talking about the supply shocks later on during the reactions, I'll talk about fiscal policy as well, because I think this is by far more important. But supply shocks basically mean there is more inherent volatility in the system. And there is nothing that the central banks can do. So the question is, if you have this inherent volatility, what do you do? How do you react? And how do you shape your monetary policy framework around it, right? Because this is uncertainty that you cannot rule out in any way. So in this particular case, the example that I mentioned that actually everybody was trying to hit a nice baseline, it's actually a recipe for disaster when you have an increase by volatility, because definition is that volatility is actually making forecasting. Sorry for just to over dramatize a bit. It's actually a very bad idea to mix the policy making with forecasting. Fundamentally, the central banks have to do two things. One, they have to acknowledge what are the risks which are relevant for the policy in a very fair and open way, and then explain exactly to the market, like Volodymyr was saying in terms of the reaction function. I don't really like the word reaction function a lot, but I think in terms of the spirit of it, but basically to explain what would you do if a certain scenario is happening, because the fundamental role of the monetary policy right now in this world is really to steer the economy off the cliff, where the dark corners, like the Olivier Blanchard was saying. Now, if you think about it, you look at how the Fed speaks during the last year, how do they actually make their decisions? They basically call it a risk management step. You look at the Bank of England, Ben Bernanke's report, it is all about scenarios and risk management. And here, what I was mentioning before, scenarios should not be just marginal changes of the baseline, like we see in the 95% of the central banks around the world. Because if you the alternative scenarios really have to be something which boards have discussed, which boards thought this is really important in terms of the decision making, and they have to transparently communicate with the market. This is, for example, what the Central Bank of Armenia did, where now each of the board members, we have a board decision making. Now, after the meeting, they publish one-page review of what are the main risks and scenarios that they have been thinking in terms of the decision making and explaining their decision making. So this is important because in this way, you are actually much more transparent about what you know, what you don't know, and you explain the market. In case of the risks that the board thinks are relevant, what would be the thinking? So in my opinion, this is the way to go forward. In my opinion, if you look back, I think too much blames were for some reason made on the models or technical aspects of the things around the world. I can see many central banks are saying, "Oh, our models have not been taking account of this thing or that thing." I think models are complicated enough. That's not the issue. I think the real reason is that decision making has to shift from this forecasting head to real risk manager as a central bank. This is not a new idea. Alan Greenspan, I think, had a speech about this in 2003. I think the fundamental job of the central bank is really to operationalize it, which we are now doing at the Central Bank of Armenia. So I'll stop here, and I hopefully, I can react to the other things later on. Thank you very much.
Fantastic. Now, thank you so much. And there are some clear connections between the themes that the three of you have pulled together. Let me just again tell the audience that you can put questions into the chat, or gradually raise your hand. Let me take a small round of just discussion with the panel. But if you do put anything in the chat, I will monitor it. Let's pick up where on the last bit on scenarios, because I think Volodymyr also talked about scenarios, and I was very pleased to hear about it, because it must have been more than 10 years ago I was writing about why don't central banks do scenarios, and when you were saying Alan Greenspan had already talked about something like this a long time back. Now, Volodymyr, I think you warned a bit about scenarios, about how one shouldn't sort of arbitrarily glide between scenarios, which of course everyone agrees with. But how do we communicate this then? Or how do central banks communicate this? At least my understanding of scenarios is that you have quite distinct descriptions of how the economy could develop that are more than marginal changes, more than, moving along a normal distribution. It's two different normal distribution, perhaps, or more than two. And they are kind of narratives that make sense both to economists and to the public. But presumably you do have to have some technique for saying that, well, we now think we're in a different scenario than we thought we were before. So yes, you have a main scenario, but I mean, the reason to have multiple ones is that you could, in some situation, move. So how do you manage that? To what extent is this something you prepare the public for? You kind of say regularly, here are the 2 or 3 different ways we could see the economy developing. this is where we think we are and we'll do this. If we are in the other world, we will do that. How public is this? Is this more for internal planning and risk management? Is it an actual communications technique? If it's a communications technique, how do you avoid adding to volatility when markets start speculating about how likely you are to be close to a flip, right? Okay, they don't seem to believe, take advanced central banks in 2020, late 2022, early 2023. That you could sort of describe that as flipping from the transitory scenario to the entrenched scenario. And that in itself can be destabilizing. So I'd like to hear your thoughts about how you manage this. Boris, I'd like to hear from you too, if you sort of agree with this introduction of multiple scenarios in the way we both think and communicate. But all three of you, how do you think about the challenges that brings? Anyone wants to start?
Yeah, sure. Thanks.
Go for it.
Relevant question, actually, because we have some experience in producing these alternative scenarios, but I separate here like scenarios for policy making reasons, and definitely if you are producing like scenario for the monetary policy committee, you want like prepare policymakers for the decisions that they need to vote in the future probably, and you're like preparing them, preparing yourself, and preparing like all the like policy responses and communications for the future developments, which are quite likely but not a baseline. And in this regard, of course, none of them should be made public, because if it's really contingent scenario, you don't want to be ahead with your communications when it's tail risks. Maybe it will not be realized, so there is no much sense to actually scare the public by publishing that. But definitely you need to have such scenarios. And actually we were quite lucky that we had one produced for the scenario full-scale war, and we actually implemented very quickly. So that's how this contingent scenario should be done. They should be put somewhere on the shelf, and they are just taking it and publishing all the measures that you're introducing from now. In case of communications, you need to understand as well, like what is the final outcome of publishing this scenario? What are you expecting from public? Like we have one example when we published like alternative scenario with how we call it longer period of high security risks. So in other words, it means more intense war. So we were like more optimistic and more pessimistic scenario, but in these both scenarios we had quite close outcomes in terms of inflation and key policy rate forecast. So the reason to publish it was for public to understand that despite
I think we've lost your sound, Volodymyr. Is it just me? Yeah. You're not. Oh yeah, now we can hear you again, I think. No, it's not that you're muted. It's sounds like okay. Now you're back. Go ahead.
So the reason to publish these scenarios like with quite similar outcome in terms of inflation and key policy rate, even if optimistic scenario realizes, probably like borrowing cost will remain high for long. So you need to be prepared, despite of the whether you're pessimistic or optimistic, that you will be like having this high borrowing costs for longer. And that's how we like produce the honestly communicating to the public that it's really will be the challenge, even if things will go in more optimistic way.
That's, I mean, those are both very sensible points, that there are some scenarios you don't want to be talking about, and we can all imagine what is politically difficult or self-fulfilling or harmful. and also that if the scenarios actually lead to the same policies, then it's advantageous. That helps you actually center expectations. I mean, that of course leaves a possibility that there are scenarios that are not controversial in that first sense, but that actually do call for different policies. Do you communicate them? Do you not communicate them? I mean, I got the sense from you that your thinking about scenarios is a bit more public facing than what Volodymyr was talking about. Is that right?
No, we are actually, you are right. So we are actually implementing for 2 years. So what we did was a bit very dramatic in that sense. So for 2 years now, we completely abolished the baseline scenario. The board, and there's one thing that I want to mention here. Inflation targeting, I think the fundamental thing besides the structured approach that it did, it really allowed the central banks and actually showed that it is necessary to become transparent. This is the big difference between the world of monetary policy after inflation targeting and before inflation targeting. And there is a good reason for it, because you cannot be transparent if your policy making and decision making is fundamentally, non-transparent and non-structured, because, you need to have a structured process in order to be transparent. So this is why what I was saying in terms of the board, if a central bank board makes a decision making based on the scenarios and really talking about the risks, then they should be transparent about it. If any central bank is really making the monetary policy because they believe there is a 95% probability that this baseline, is gonna be the case, then they should actually talk about it. In the central banks that I know, nobody, makes decisions because they believe that the central scenario is such a high probability event. So there is this fundamental thing there. So that's why what we did, we completely abolished the baseline. We always publish, and in the beginning, everybody was saying it's not going to work. You're going to introduce lots of volatility in the markets, and but that was not our belief. So for 2 years now, every time we have a very structured process within the board of the central bank to have a taxonomy of the scenarios, to underline, so the board actually structurally can talk to the market, okay, what are the key parameters and the risks that we think are there, and how are we going to approach it? And we publish these 2 scenarios. I can discuss it, in more details if time allows. And then there is attributed minutes, which is coming immediately the day that we make the decision. And each board member publishes 1 page, talking about the relevance of the risks that they have. So we have been practicing this now more than a year. And what we saw that actually there is much more organic discussion between the market, and there is more actually content discussed in the market in terms of the policy making. So this is very important that I wanted to mention the transparency, and we're actually doing it because you never want to basically look like you actually want to shrug off the responsibility from you, because it's actually difficult to do. The approach that we are advocating is really, okay, the central banks in this world are really risk managers. That's how they're making the decisions in their boards. So that is why they have to transparently communicate with the market, rather than you talk completely about different risks, in the board, and then you go and tell the market, okay, we think this is going to be the baseline, and that's our decision. And I think if you look at the transitory versus permanent story in case of the US, there's one important thing. Actually, in the beginning of the high inflation, if you looked at the markets in the US, there were lots of commentators that were saying that this is not going to be transitory. So in fact, Fed's insistence on this transitory shock had muted this belief in the market. And afterwards, once it was clear it's not transitory, the Fed had actually to fight itself back because it made so much, it bet so much on the transitory. So I think what we're arguing is basically risk management is a good way, is the way that the central banks are doing. They should be transparent, and they should publish actually what is really in the real life is the input for their decision.
That's really interesting, Armin. What I hear you saying, if I understood you correctly, is that your central bank have chosen a fairly bold way to address the problem everyone has, that of course the models are always wrong and forecasts will be missed and so on, and take a different approach to how to make that understandable and palatable to both markets and the public. Boris, do you want to comment on this scenario debate, on what you've heard or your own thoughts?
Yes, yeah, thanks a lot. Yeah, I think it's very interesting the discussion, in particular what Armin said, abolishing completely the baseline scenario. So I think this is really a very interesting to hear. I mean, yeah, of course, we have also been discussing a lot about this here at the BIS because scenario analysis is a key topic for central banks around the world at the moment. So from my point of view, scenario analysis in a way serves, I think, three purposes. On the one hand, it obviously serves the purpose of conveying the uncertainty that monetary policy faces, yeah, so to basically avoid excessive focus on the baseline scenario. I think another key motivation is also to actually flesh out the central bank's reaction function, right? So in order to convey the reaction function by showing how the central bank reacts to different realizations of the world. And here, of course, then an important question is what is actually the conditioning assumption about monetary policy in different scenarios, right? So it would, I guess, to convey the reaction function, it would somehow need to have a reaction function at work in the background that then also means different policy rate path under different scenarios, as opposed to a conditioning on, say, the one market path as it is. As it's observable at a given point in time, and then I think the third purpose, obviously, the contingency planning. Central bank wants to be prepared for also for extreme outcomes. But there, I would actually agree that these cases are probably more for internal use and not for external use. Yeah, because obviously there's always the risk that you might upset the public coming out to say with a very extreme scenario, and this is obviously not something that the central bank wants. But then, of course, there's nevertheless still also a little bit the issue that so in order to enhance the efficiency of monetary policy and to best ensure transmission of the intended monetary policy stance at this current period T, I think the central bank may still want that, in a way, the market and the public gets the message of what the central bank actually thinks is something like the central scenario, right? Because otherwise, I think the transmission might not be as effective as it would otherwise be. So it may be interesting to hear from Armin what he thinks about this consideration.
Armin, why don't you answer that? And I also wanted to throw in, I guess it's a version of the same question. Do you, in your scenarios, do you also make very clear what your reaction or your actions would be in those scenarios?
Yes, so actually publish both interest rates and exchange rates on the scenarios. And this is really important. Boris brings a very good point, because, again, this is not meant to avoid the responsibility, because forecasting is difficult. This is not the point. The point is forecasting is not the central input for monetary policy making. So that is why we publish the interest rate paths and exchange rate paths in this scenario. And for small open economy, if you don't do it this way, publishing exchange rate path, only Czech Republic or maybe a couple of other countries as well, as far as I know, have been publishing forward-looking paths for the exchange rates. But for countries like Armenia, it would be unimaginable. But when we did it, we actually, published the exchange rate paths under these scenarios as well. What we thought that actually generated lots of good analysis. So in fact, it actually necessitates to make it much more transparent, including, exactly as Boris said, explaining the thinking of the central bank or the so-called reaction function. So yes, we do publish it. We find that the market actually starts to talk about it, interpret it, much better questions. And we are actually communicating much more with the market in terms of the underlying narratives. The one thing I wanted to also discuss on this, I think, in real life, how the boards make decisions is really important. It depends on the decision-making way of the governance of the bank, of course. But see, in real life, at least this is the thing that I saw in many central banks, 8 people or 7 people who are on the board, they never agree on the single baseline. So the question is, who owns that baseline? If the 8 people, they don't, in all the cases that I know, or most of the cases, what happens, because the baseline is so powerful, most of the discussions within the boards are happening because board members, again, to make it more dramatic, they fight to put their views in the baseline because they think this is the most important way to affect decision making. So it creates a game where you actually compete to put your views in the baseline rather than a co-creation exercise where you can actually talk about the risks. So this is, in my experience, a very, very powerful thing in terms of the creating a board dynamics and making a good decision, which is, not just a tunnel thinking or just everybody talking about the same thing. So I think these internal things are very, very important. But short answer to Boris, yes, of course, we publish the interest rates, exchange rates, inflation, output gap in these scenarios to make sure that everybody understands what's the underlying narrative.
I suspect the exact decision-making procedures will also matter. Is it a vote? Is it a consensus-based mechanism, and so on? And you're all very polite not to complain about the financial press that will obviously take any extreme scenario and blow it up on the front pages the central bank warns against. But this panel is not about that. I wanted to pick up on this communication. Volodymyr, you were talking about adapting communication strategies, and it's been in the remarks of you other two as well. Boris, you talked about expectation formations. I mean, it seems to me that over the 30 years or so that inflation targeting has been the leading framework. We've had an evolution from a sort of more kind of mechanical view of it, sort of Taylor rule based. We pull an interest rate lever and inflation reacts, to one where expectations have a much bigger place as a sort of intermediate instrument, almost, right? That central bankers think about and talk about shaping people's expectations, because in the model, obviously, that's there as an anchor. So we got forward guidance in the 2010s and so on. And I just wonder if the kind of changes, the pressure we've been talking about, increasing supply shocks, and everyone seems to agree that we are getting more volatility. So what does that do to the usefulness of communication as that kind of tool? Because if there's more volatility, we are simply just going to see more frequent occurrences where the central bank is seen as having got it wrong, right? It says one thing and didn't achieve it, or that's easily how the public and markets can end up thinking. So do you agree that the use of communication just is becoming more challenging, and there may not be much we can do about it, although I will ask you what should we do about it? And if so, does that also increase the cost of monetary policy, in that if the grip central banks can have on people's expectations because they'll get it wrong more often, if that grip weakens, then outcomes will be more volatile because we can't look through as much as before. Several of you have made this point. And so you'll get a reactive monetary policy, and the disruption to the economy will just be greater, and sort of over time the trade-off is worse, the output to inflation trade-off. So I'm painting a bit of a sort of pessimistic picture here, saying that it may well be that inflation targeting remains the best we've got, but it's not as good as it used to be. Is that a fair worry to have? What do you guys think, and what do we do about it if it is? Who wants to come in?
If I may.
Please.
So, of course, it's becoming more and more challenging when you have this kind of environment with very frequent shocks, and like communicating in this kind of environment becomes more and more complicated. But at the same time, central banks are trying to be as much transparent as they could, and to speak in a plain language with the public, so for public to hear it. So probably it's the best way to be honest, because sometimes shock happens from supply side, and you shouldn't look like helpless in this situation. So guys, we understand what happened. Inflation for time being is high. We're gonna have such high inflation for particular time. We are reacting to that. We have a plan, and that is what public needs to hear. So you have an expertise to make an analysis. You have an expertise to produce the scenario with the best possible result, you are reacting, and you have a plan. So, and sometimes when there's like extreme events like we had, so and you don't have actually enough capacity to make a credible forecast, probably you need to just to communicate the scale of possible outcomes. So at the beginning of full-scale invasion, we didn't produce a full forecast. We just produced some summary that inflation will be above 20%, and economy will be shrinking like by 1/3. And when you like prevent the speculations that it will be like some unimaginable figures, and you're like honestly saying that we are in that situation, but we know the scale of the possible how situation could evolve in a baseline, and we have a plan how to react. So that's the main issue the public needs to hear from you. Because if you're looking helpless, you have no plan, you have no understanding of what is going on, so that's a bad way of doing monetary policy.
It is inherently difficult, though, isn't it? Because basically you say there's a part of inflation that the central bank can do something about, and you want to transmit that you're doing everything to deal with that. But you also want people to hear that there's a part you can't do anything about and don't blame us for it. So, I mean, it's a sophisticated view to get people to believe.
Yeah, sure. And that's why you need to have a framework for communications and to be quite open, but not to speculate about things that you don't know. So,
Boris, Armin? Do you want to, yeah, either of you?
So okay. So first of all, I think at the end of the day, people will judge by the results. The smaller economy you are, the more emerging country you are, that is, even more true, right? So basically, you don't have that credibility stock that will allow you somehow to make things wrong for several years. It's going to be basically very costly for the central bank to allow the inflation to be above the target or below the target, for too long of a time. What we learned that even in the US, credibility is endogenous, that it can go down pretty quickly. So I think at the end of the day, it's all about consistency. Yes, we can play the games about the communication in a short run. I agree with Volodymyr that the one thing is important, which to explain, what are your policy actions. But I think at the end of the day, the important thing is that if you achieve your results or no. Now, in that sense, actually, one thing which I wanted to pick up on Boris's point, which I liked a lot about the affordability crisis, this is my personal opinion, not the central bank's view. But if you ask me what's the real alternative for the inflation targeting, then I'll say it's a price level targeting. I think that is something that we have to seriously consider, because what I see around the world that basically the affordability crisis, which is fundamentally about the price level, it is actually affecting a very big time the credibility of the central banks as well. So strictly speaking, inflation targeting means if you had a high inflation last year, it doesn't mean that you have to have low inflation next year. You basically have to just bring the target back, right? Which means that the price level will be permanently higher. Now, that is a very serious problem. So that is why I think it is a very interesting discussion if we want to go to the price level targeting. I personally believe this is the place where the central bank should go. Politically, in the current environment where you have the fiscal such a big problem, I don't think it's going to be easy. But I think that is something which is really a real alternative for the inflation targeting, because other than that, I don't see any real alternative.
I would really like the other two to respond to that, but just before that, Armin, why price level targeting rather than nominal GDP targeting, if you were going to change the target?
Well, nominal GDP targeting, in fact, it is in some way a similar idea, because it basically say when you have lots of supply shocks, rather than taking the hit with the real GDP, you can sometimes take the hit with the prices. But I think it's first too complicated. And the second, it is very, it's not straightforward to get from there to this nominal anchor point. So I think this is why, whereas in the price level targeting, it is actually very clear that there is an anchor, which is the price level, and price level targeting means, you can have the 2% or 3% and go around it. So I think nominal GDP targeting is just very hard to implement, in my opinion, in real life. I think it lacks it is actually difficult to get from there to the nominal anchor, whereas the price level targeting, even theoretically, if you look at the literature, price level targeting is actually by far more optimal than inflation targeting.
Boris, Volodymyr, some reactions to this?
Yeah, maybe just briefly also related to the previous point. So I very much like the point that Armin made on that ultimately results matter for central banks. So I think that also affects the discussion about communication. Yeah? So I think there's a lot of discussion at the moment about communicating or enhancing communication with the general public, which I think is a good way to go. But I think ultimately the general public maybe doesn't want to communicate a lot with the central bank, right? So I mean, I don't think general public would like visit a lot the central bank's Instagram account. So this is not, I think, what's going to happen. So ultimately, what the general public wants is that central bank makes sure inflation is low, they have price stability, so gets the job done. But obviously the environment that we are in is more complicated, so it raises communication challenges. So with the general public, and then there, for example, what I think is a very good approach is, for example, at the Federal Reserve, the Fed Listens events. So basically trying to get input from the general public to hear what's on the mind of people, what they actually want and expect from the central bank. But then, of course, also the usual communication with the financial markets. Right? So I think in the current environment, it's very important that the communication is very clear, and also to avoid, like, if you may call it cacophony. So in this sense, maybe like too many speeches by too many central bankers in a situation when there's already high volatility and uncertainty. So I'm not sure it would actually improve the situation. And on the question of price level targeting, so I mean, as I mentioned, so I think these concerns by the general public about the cost of living, I think this is a real concern. I think central banks really need to take it seriously. So what that means in terms of monetary policy strategy. So I would still think that inflation targeting is, I think, a good approach overall, even if, as you said, Martin, maybe it's doesn't work as great anymore as it did before. Now that we have more supply-driven shocks, but I think it's really important to keep in mind that, as I said, it's a means to deliver price stability. Yeah, and in this sense, I think maybe there are too many prescriptions from the academic literature also. Okay, when inflation is very low, or no, then it's a big problem. You need to push it up. But when there's inflation is above target because there's a supply shock or there's fiscal inflation, oh no, then you can look through. Yeah, so in this sense, I think there's a little bit a drift in these recommendations, which then ultimately lead to price levels ending up higher than they're actually supposed to be, which may ultimately undermine central banks' credibility. So in this sense, I think inflation targeting, but really implemented in a symmetric way, and really keeping in mind that the ultimate goal is ensuring price stability, which means really low inflation.
Yeah. Volodymyr, quickly, so we have time for one more question.
Yeah, but on the issue of price level targeting, actually, I like the idea. In theory, it could work, but for me, it's not really a viable option in this environment when you have high fiscal deficit, which are caused by defense spending, aging of population, you have deglobalization, you have green transition, and all these things are costly. So probably there will be no much room for the central bank to react to that, and probably the cost of such reaction to try to target the price level, it will be high.
And that brings me perfectly to the last question, because they may not say it, but a lot of governments and finance ministers probably quite like price levels going up because it does help with public debt. And I was struck by Boris's chart showing that the possible kind of negative scenario or dangerous scenario forecast for public debt are pretty much as bad in emerging markets as in advanced economies when you add in aging and demands for spending and so on. There's a question from Alexander in the chat. In a period of exceptionally high global uncertainty, central banks are facing growing political pressure, whereas inflation targeting relies on operational independence. So Alexander is asking about what shields central bank credibility and independence have and which ones are hardest to preserve. I'll just elaborate a bit on the question because I think the fiscal side is one of the bigger threats there, where this pressure for more spending is going to create incentives for fiscal dominance. And I think that may be one of the most concrete threats to independence, or certainly independent inflation targeting in the way it's been practiced. So I'd like to hear your thoughts on that, and what are the sorts of ways central banks should address this? I mean, if the pressure is there, ultimately you want monetary policy to be democratically anchored. But is one way to think about this some more formalized fiscal monetary cooperation so that we sort of renew a bit the social contract about who's responsible for what? Because in the current system, it's clear that you guys are vulnerable to being pressured. That pressure will be there and not go away. So I'd really be keen to hear your thoughts about this and what to do about it. And after that, we'll have to wrap up. So you have about 2 minutes each. So it's not very much time for a big question, but please give it your best shot. Maybe we can go in the opposite direction. Although I don't know, Armin, in the end, you spoke at 3 different points, but let's go the opposite of the original. So Boris, Volodymyr, and then Armin, please.
Yes, thanks a lot. No, I think it's definitely the case that central banks are facing more pressure, and I think that certainly pressures is probably coming in particular from the fiscal side, given the fiscal outlook. So I mean, in the end, obviously, the question is, okay, what can central banks do about it themselves? So I think probably here it's really important to actually communicate very clearly also on the side of central banks that actually precondition for central banks to be able to fulfill their mandates is actually that there is fiscal backing, in the sense of there being sustainable fiscal positions. And I think this is certainly something that central banks need to highlight, and I think this is also something that they are actually already doing. So, for example, we had BIS a chapter in the annual economic report on that issue, and I think also many other central banks are writing about that. So in the end, I think on the side of central bank, this is the main thing that they can do in this respect. And I think maybe another aspect here that's something a little bit overlooked in the discussion. So it's not so fiscal sustainability obviously is key. But another important aspect here is the composition of public spending. For example, when you look at the evolution of debt over the past decades, so essentially every surge in the public debt was essentially driven by a surge in the social security spending, right? Which has then not been reversed. So basically, it was often related, obviously, to recessions, to major adverse developments. And then you see there was this ratcheting up in social security spending, but then rather than coming back to its previous level, it stayed there. Right. So in the end, now, of course, there's a situation of very high social security spending, which is baked into the government spending together with high debt. And now, of course, come these additional demands on the government. And now it becomes clear, oh, we need more investment, we need more military spending, and so forth. And of course, then the risk is in the end that the funds will still be blocked by consumption expenditure, by social security expenditure, rather than being activated for investment expenditure. I think this is something that we are actually seeing in many countries at the moment.
So if it could be productivity enhancing spending, that obviously makes things easier for everyone.
Exactly.
Volodymyr.
Yeah, I think there is only one solution for that, like how to resist political pressure is central bank transparent communication. So I think after the periods of high inflation, in societies, there is a demand for price stability, so from the public. So they understand that the inflation is harmful for the well-being, and they want actually the price stability to have price stability. So by like explaining in plain language how sound economic policy overall is contributing to the price stability is a way how the central bank needs to communicate to the public in honest way, because otherwise, like they just need to understand the clear link of some probably initiatives which are aimed at actually at promoting some benefits for the public, but they need to understand the cost in terms of inflation of this initiative. So I think that the transparent communication is the main tool for the central bank to avoid pressure.
Thanks very much. Armin.
I think there is no question that the fiscal policy is going to be by far, and high debt is going to be by far the most important challenge. There is no question that it is going to create big problem for the central banks because I don't think, as much as the central banks like to talk about inflation targeting and the magic that we have around it, I think we have to acknowledge that in the 90s, one of the major reasons that the inflation, expectations around the world were actually anchored is because fiscal policy around the world, debt levels have been actually going down. So there was so the fiscal house was in order. And so I don't think central banks should get, too cocky about, bringing inflation back without the fiscal policy doing its job. I don't think there's a magic there. It's going to be very difficult. I fully agree with Volodymyr. The only thing that can basically defend the central banks in this world is really the society should value the price stability. And I think we saw it after the COVID, even in the most advanced countries where we had, everybody was worried about the low inflation and all that before. We saw that actually the affordability and the price stability issue had very big political costs for ruling governments at that point. So I think in that sense, it is the most important thing. And obviously, central banks have to pick their battles in terms of understanding what is important and not. But fundamentally, I think there is no magic way to solve the problem if fiscal policy is just if public debt is going to high and high and it's on unsustainable path. The only solution to that is higher interest rates, and there is no way unless, of course, as Boris said, there is really productivity and potential output enhancing spending when you don't really have inflation as a problem.
Thank you so much. Thank you, everyone. We're out of time. I think that was a splendid discussion. I think we ended up in a reasonably hopeful place in that you've all expressed that inflation targeting can work, but one important ingredient is to be anchored in popular support, and I think that's a pretty good place from which to go forward and face all these challenges. So thanks to all of you. Thanks for everyone who listened. I will pass it back to Alexander. I think we're now set for a break, but I'll let the NBU Ukrainian team let us know. Thank you so much, everyone.
Thanks very much.
Thank you.
Yes, thank you very much, everyone. Thank you, Martin. We are now having time for a 10-minute break, and then we'll come back for the second research session. Thank you.
Good afternoon, colleagues. My name is Maxim Sodorenko. I'm from the National Bank of Ukraine and the Kyiv School of Economics. It is my pleasure to welcome you to research session 2 of our workshop. So let's do a tiny bit of introduction. So today's workshop explored, earlier today we've already explored how emerging market central banks adopt their frameworks to persistent shocks to improve the resilience of policy frameworks, and how inflation targeting regimes have evolved over time. Our session today will continue this conversation by shifting attention to the real part of the economy and real economy dimension of monetary policies. Because understanding how policy affects activity, labor markets, and behavior is essential, and to be frank, it's quite relevant for Ukraine today, right? For the National Bank of Ukraine, right, as Governor Pishny has already mentioned, the past years have tested every component of the monetary policy toolkit. So operating under such wartime conditions, it has highlighted how important it is for us to understand the transmission channels beyond the textbook level of understanding, right? It's important to know how households and firms react, how expectations adjust, and how labor markets absorb these shocks. So the session like this one today should help us refine our analytical tools and improve the base for more effective policy decision. So we're very fortunate to welcome 3 excellent speakers who bring quite a diverse institutional perspective and research approaches. So we will have Tim Williams from Bank of England, we'll have Claude Pham from University of York, and we'll wrap up with Malgorzata Valerik from Narodowy Bank Polski. Their work should hopefully give us quite a bit of insight into the topics that I mentioned today. So I would like to thank them for being part of today's program. A few reminders before we begin. So each speaker will have 20 minutes for the presentation, which will then be followed by 5 minutes of Q&A. For those who are not currently speaker, please try to keep your microphones muted unless you're actually speaking. And if you have any questions, feel free to submit them through the Q&A box in Zoom. With that, let us begin the session. So it's my pleasure to welcome Tim Williams to actually start our session. Tim, feel free to share your slides, and the floor is yours.
Yeah, thank you very much. Let me just see whether seem to have some issues in somehow finding my. Why do my slides not show up here? I think there seems to be. How is this? Can you see my slides now?
We're now seeing your email account.
Okay, that's not good.
Yeah.
Let's see. Because somehow it doesn't allow me to share my. Let's see. Does this do the trick?
That shows your browser.
Okay, so still not.
Tim, hi, it's Alexander. If you're okay, I can share slides for you. So you sent me the slides.
Yeah. Okay. Let's do that because it somehow won't let me. But yeah, thank you very much for having me here. Great pleasure to be here. Sadly, not in person, but yeah, hopefully I'll be able to come back at some point soon in the future. So this is joint work with Paul Beaudry, who's at UBC, Paolo Cavallino at the BIS, and myself at the Bank of England. So the usual disclaimer applies. So if we could move on to the introductory slide. Yes. So with this paper, we sort of try to ask, what impact do long-term real rates have on aggregate demand in the present? And what does that imply for the determination of those long-term real rates? So the standard idea is, of course, that if you talk about real interest rates, particularly real interest rates at the long end of the spectrum, they must be driven by real factors, be they productivity, growth, or demographics, the supply and demand for safe assets. But one thing that is quickly dismissed is that it can't possibly be monetary policy that moves this, because monetary policy prices are only sticky for a short while. So monetary policy can't be driving these very long-term dynamics in long-run real rates. But somewhat puzzlingly for this perspective, it has been observed already for quite a while by a variety of authors and a variety of methods that monetary policy decisions have very strong effects on long-term interest rates. And perhaps the most striking finding there is a recent finding by Sebastian Hillenbrand. I'm not citing that here, but he basically showed that the entire secular decline in 10-year real rates that occurred since the late 1980s basically happened in very short windows around FOMC decisions. So that really suggests that monetary policy might be driving more of those dynamics than our standard way of thinking would lead us to believe. And recently, as shown by this recent paper by Bolhuis and co-authors at the IMF, also in emerging markets, it appears to be the case that central bank decisions have surprisingly strong effects on the long end of the yield curve. So this is, if we go on to the next slide, this is somewhat puzzling from a standard perspective, because if you think about the standard New Keynesian model, there the central bank has no power to move long-term real rates. And to sort of understand why, if you take a standard New Keynesian model and solve the Euler sort of equation forward that tends to underpin that model, then you basically get that output today, or the output gap today, is going to be a present discounted sum of future real interest rate gaps. So where the policy rate is relative to the famous R star, the neutral rate of interest. And in the standard New Keynesian model, it is the case that all these sort of psi j's that you see here in the equation, those loading coefficients on those future interest rate gaps, they are all equal to -1 over sigma. So where -1 over sigma is going to be the negative of the elasticity of intertemporal substitution. So in that case, you're in a situation where, irrespective of the horizon, irrespective of whether you're talking about the 1-year rate or the 5-year rate or the 50-year rate or the 500-year rate, it is always going to be the case that having your policy rate below the neutral rate R star at that point in the yield curve is going to have the exact same expansionary effect, and vice versa if you have it above the neutral rate. The isolated impact on that point of the yield curve is always going to be minus the elasticity of intertemporal substitution, -1 over sigma. So if you then keep R away from R star for a persistent period of time, you keep on adding -1 over sigma to it. So in that sense, the potency of monetary policy is going to become unboundedly is going to accumulate unboundedly with persistence. So more persistent monetary policy in the standard New Keynesian model is always going to be more potent. So if we go on to the next slide, you can then see that if you then were to approach this type of economy with enter a central bank that is going to conduct monetary policy with an interest rate rule that has an intercept equal to, call it RL, which is the central bank's long-run goal for where it wants the policy rate to get at once all shocks have died out and when inflation goes back to target, then you can basically rewrite that Euler equation and you can decompose it into a temporary deviation of the policy rate from the central bank's long-run goal RL. But it's also possible that RL, the central bank's terminal rate, is not equal to the true R star, which is of course unobserved. Now, in the standard model, if you try to conduct monetary policy with quote unquote the wrong intercept, so a value of RL, a terminal rate that is different from the true R star, the loading coefficient on that sort of policy mistake is going to be, well, it's going to be the sum of all these little psi's that I introduced in on the previous slide. So let's call it big psi of 1. And for the standard New Keynesian model, because you keep on adding -1 over sigma, that is going to sum to minus infinity because it's an infinite sum. So in the standard New Keynesian model, it is absolutely crucial that a central bank conducts monetary policy with the right view of R star in mind, because if it doesn't, it will try to steer the economy towards a terminal rate RL that is different from R star. So it's going to try and drive a permanent wedge in the long-term real rate. And if it is true that it is different from the true R star, that will show up in an output gap, positive or negative, depending on which side you are on. And that, of course, will then also be inconsistent with inflation being a target. So in that sense, for an inflation targeting central bank, R star is really going to be a constraint, because it basically tells you in the long run, if you're an inflation targeting central bank and you want inflation at target in sort of the medium run, you need to steer interest rates towards the true R star, because if you don't, then you sort of blow up the economy in either direction. Now, what we're going to advance in this paper is the possibility is that kind of at the other extreme, the standard New Keynesian model is very extreme in that it has this big psi of 1 coefficient equal to minus infinity. We're instead going to argue that this coefficient in reality might actually be much closer to 0. So in that case, very persistent rate changes are going to have only very weak effects on economic activity. And if that is the case, then the long run R star might not be a very constraining object for inflation targeting central banks. And we're going to end up with a system that is going to be very forgiving to a central bank that misperceives the true R star, so conducts monetary policy with sort of the wrong view of the intercept. And in that case, long-term interest rates are not going to be very firmly pinned down, meaning that they can very easily become subject to kind of self-fulfilling dynamics, which then might lead to this excess sensitivity of the long end of the yield curve to very short-end monetary policy decisions. So if we go to the next slide, what is the mechanism? Well, the mechanism is basically moving away from the standard New Keynesian model, the representative agent model, which is solely driven by intertemporal substitution, because that has the problem from our perspective that more persistent rate changes are always going to be more potent. And so in the long run, it has to be the case that you're going to converge to the true R star, or you will blow up the economy. What we're going to do instead is we're going to build an overlapping generations New Keynesian model where we take retirement forces seriously. And then you're suddenly in a world where the potency of interest rate changes starts to vary with persistence, because then if you're going to lower interest rates, particularly if you're going to lower interest rates for long, that might actually increase the desire to save, because people who are now trying to save for retirement now realize that they will need to enter retirement with a greater stock of savings in order to compensate for the fact that the rate of return on that stock is now going to be lower. So the ultimate reason for that is that if you think about your own situation, that we're all, when we're born, we're all basically saddled naturally with a negative duration gap. So we expect to maybe work when we become economically active for 40 or 45 years, then we retire, which means that we still have, if we're lucky, another 15, 20, 25 or so years to finance in consumption, but not from labor income, but rather from interest income, so rates of return on our past savings. So to sort of formalize that, what we're going to do, if we move to the next slide, we're going to build a finitely lived agent New Keynesian model. We abbreviate that to FLANK in keeping with the literature. And at its core, it's going to have this Blanchard-Yari overlapping generation structure augmented with a retirement state, which is the extension that Mark Gertler brought to this literature. So what we're going to do is we're going to start out with a measure one of households who then retire with probability, with a constant Poisson probability delta 1. And once they are retired, they are going to retire, they're going to leave the model and die with a constant Poisson probability delta 2. So this is the demographic structure. So if we move on to the next slide, we are going to have households in there who have a constant relative risk aversion utility function, where from consumption, but with working households also receiving this utility from labor. Now, the crucial difference is that whereas working households enjoy labor income whilst they're working, but then once the retirement shock hits, then they retire. And then the only income that the household is going to be left with is the interest income on their accumulated stock of past savings. So if we move to the next slide, when it comes to the supply side of the model, we're just going to stick with the standard New Keynesian setup. So we're going to have monopolistically competitive firms who are subject to price adjustment costs. So the supply side of the model will just be summarized by a standard New Keynesian Phillips curve. And then finally, if we move to the next slide, we're also going to have in there long-term bonds. You can also think of it as equity, which are real in nature, and they have positive duration governed by this parameter mu. So actually, if mu is equal to 0, then we just have a 1-period bond. So not much duration. If we set mu, that is for mu equal to 1, then we have a 1-period bond. If we set mu equal to 0, then we maximize duration, and you have an infinitely lived perpetuity, the value of which is very sensitive to interest rates. So this is going to capture asset valuation effects in our model. And then finally, we're going to have a monetary authority in there, a central bank, who's going to set monetary policy according to a familiar Taylor type rule. And there are going to be some monetary policy shocks. So this model, thank you, once you log linearize it, can be summarized by these set of equations. So this is our equivalent of the 3-equation sort of New Keynesian model. So it's not exactly 3 equations, but it's also not much more difficult, even though we think that this model is quite a bit richer in what is in there. Because if you look at the first equation for Q, that is the price of the long-term bond, or the price of equity, if you like it. And you see it's negatively related to the interest rate. So when interest rates go up, asset prices fall, and that all else equal is going to be contractionary. Secondly, we have this capital gamma in there, and capital gamma, if you look at the differential equation and sort of solve it forward, it's going to be a positive function of expected future interest rates. So it's basically going to be a summary statistic of the entire future path of interest rates. So you can think of it as either a summary statistic for forward guidance, where do people expect interest rates to go in the future. And what it's also going to be, and that's what's captured in the third equation, it's always also going to be the retiree's marginal propensity to consume out of wealth. So if you look at retiree consumption, consists of 2 components. One is the value of your assets, Q in blue, but then secondly, it's not just the value of your assets that determines how much you're going to consume. It's also how willing you are to consume out of your wealth. And that willingness to consume out of wealth is going to be an increasing function of interest rates, because that captures the notion that if you're retired and you live off interest income, higher interest rates are going to be positive for you, because you then get to enjoy a greater interest income going forward. Now, the fourth equation here is consumption of the workers. So that consists on the one hand of the Standard Euler equation, but that is kind of discounted by, that only applies if you survive in your working states, if you don't retire. So that has a coefficient 1 minus delta 1. But with probability delta 1, you move to the retirement state. So then your consumption is again going to be the consumption of the retiree. So in round brackets there at the end, you see exactly the consumption of the retiree. And that already is on the worker's mind, because they realize that every period they have a constant probability delta 1 of moving into the retirement state. Then there's the standard Phillips curve. There is the aggregate sort of output gap Y, which is just a sum of demand coming from workers and retirees appropriately weighted. And there's the central bank's interest rate rule, the final equation. So if you move to the next slide, you see that in this type of model with retirement preoccupations, the monetary transmission mechanism is going to move away from intertemporal substitution. So that is the first term that now only gets a weight of 1 minus delta rather than the standard weight of 1 in the standard New Keynesian model. But with probability delta 1, you're going to have this, your consumption demand is going to be the consumption demand of a retiree. And there we see that there are now additional channels. On the one hand, there is an asset valuation channel. As interest rates go up, the value of your past savings in assets with positive duration, equity, bonds, that goes down. So all else equal, that's going to depress consumption. But then there's also this other channel, which is about asset demand, and that is related to the interest income that savings are expected to generate going forward. So there we see that as the interest rate goes up, that means greater interest income for retirees once they have retired. So that lowers their demand for assets, that lowers their need to save. So all else equal, that is actually going to be expansionary. So that's going to work in the dissonant direction, whereby higher interest rates purely from this partial effect are going to be somewhat stimulative. Now, if we move to the next slide, we can see how this sort of plays out. So if you repeat it, if you work on the Euler equation and do repeated substitution, and you recognize that Q and the gamma that feature in there are functions of the interest rate, you can write the Euler equation, you can write aggregate demand in the present Y, again, as a function of future interest rate gaps, which you also saw on one of my first slides, with these loading coefficients psi j. But rather than psi j being constant at -1 over sigma now, minus the elasticity of intertemporal substitution, it's actually now going to, the psi j's are going to vary with the horizon that we talk about. So short-term interest rates are going to have a very different effect on economic activity than rates further out into the yield curve. So if we move to the next slide, we see that whereas in the standard New Keynesian model, which you see in the dashed line for different values of the intertemporal elasticity of substitution, the dashed lines are flat in the standard New Keynesian model, because that is this notion that no matter what interest rate, what point in the yield curve you talk about, it always has the same contractionary element. But in our model, which is the solid line, you see that the effect of each point in the yield curve now varies with what part of the yield curve we're talking about. So at the very front end of the yield curve, things work in the conventional way, because that's the part of the yield curve where intertemporal substitution is important. But when you move to the right of the figure, when you talk about the 30-year rate or the 40-year rate, well, the 40-year rate is not a rate that is relevant for intertemporal substitution. The only reason why I or many of you should care about the 40-year rate is that is the rate at which my current savings for future retirement are expected to accumulate. So from that perspective, higher interest rates far into the future are good news for me in the present, because it means that I don't have to save as much. I don't have to enter retirement with as many assets, because each unit of asset will now yield more. So if we move out to the next slide, actually, let's skip this one because it's easier to see from the next slide here, because this shows you that whereas in the standard New Keynesian model, more persistent monetary policy shocks, that is what we're varying here on the horizontal axis. As we move on the left-hand side of this figure, we have a very transitory monetary policy shock. On the right-hand side, we have a very persistent monetary policy shock. And you see by the red line that in the standard New Keynesian model, the rank model, more persistent monetary policy is always more potent. If you consider the blue line, which is our overlapping generations model, you see that, yes, for very transitory shocks, our model and the standard New Keynesian model work very similarly. But whereas monetary policy always becomes more potent as the shock becomes more persistent in the standard model, in our model, it's actually the opposite. And at some point, making monetary policy more potent, so saying we're going to do low for long, is actually going to be counterproductive, and may at some point even a low for long policy might actually end up holding the economy back, because by saying we're going to do low for long, you really complicate the job for people who are trying to save for retirement. So their savings might actually go up as you keep interest rates persistently low, and that might contribute to prolonging a recession. Now, if we move to the next slide, and actually again one forward, I'll illustrate it graphically. What we basically show is that if we move one more forward, yeah. So what we show is that for a large combination of parameters, so here we show different values of the elasticity of intertemporal substitution and different values of duration in the household's asset portfolio, you see that for a wide range of parameter combinations, you actually see that the impact of saying we're going to lower interest rates for essentially we're going to keep interest rates permanently higher or permanently lower away from R star. Whereas in the standard New Keynesian model, remember, that's going to be a very explosive policy. So saying I'm going to permanently keep interest rates away from R star is going to create this incredible boom or incredible recession. You see then in our model, the red and the blue area are about as big. So in blue, that is the area where the model responds in the conventional way. So where higher interest rates are indeed going to create a moderate recession. But you see that for another reasonable part of the parameter space in red, you see that a low for long type policy might actually create a mild recession. That is what that red part of the figure shows. And for a very broad range of parameters, actually the impact of sort of a low for long policy is going to be pretty modest, which basically means that the central bank is not really constrained by R star. If the central bank says, oh, I'm going to steer towards a long-term interest rate that is different from R star, rather than blowing up the economy, the impact of it might actually be very sort of minor, meaning that we end up with like an economic system that is relatively forgiving to a central bank that gets R star wrong, so that tries to steer interest rates in the long run towards a different level than the true R star, meaning that central banks in our type of model, in our type of environment, might have much more control over where interest rates are going in the long run than in the standard New Keynesian model. So let me conclude. Let's skip some slides now and go to the concluding slide because I'm running out of time. So what we basically argue that taking life cycle forces might matter for monetary policy because monetary policy can have very qualitatively different effects across the yield curve. If you want to stimulate economic activity, saying I'm going to do low for long might not actually be such a good idea because you might only encourage people to start saving more for retirement. So instead, if you want to give a short run sort of boost to the economy, you might be better off saying I'm going to be doing a low interest rate policy, but for a limited amount of time, because then you really encourage people to go out and spend while those low interest rates last, rather than making them worried about their retirement savings. So let me end it there. Thank you very much for having me, and happy to take any questions if there's still time.
Thank you very much, Tim. That's a fascinating research with a very interesting result. I'm actually interested in sort of what are the consequences for communication policy for the national bank, right? Because your analysis suggests that when this psi1 is very close to zero, that means that the pull from this true natural real rate becomes really weak. So that means that it's less constraining, right, for inflation targeting. So then what is the role of this R star? Should central banks just ignore this? Like how do they should work this result in the communication strategy?
Yeah, indeed, our model sort of suggests that R star, the role of R star might be a little bit overplayed in central bank communications, because at the end of the day, I think we all have to recognize that R star is hugely uncertain. And in the standard New Keynesian model, if you don't know R star, that is very problematic because it's going to lead to deviations in inflation from target. But B, in the standard New Keynesian model, it should also be very easy to learn R star because the model gives so much feedback, and the model will really tell you if you get your idea of R star wrong. In our model, indeed, we sort of embrace the uncertainty about R star and kind of also say, well, maybe it's not for central banks that important that they know it up to the second digit. Rather, They just need to get sort of the ballpark right. And if you then want to think about, is monetary policy currently tight or loose, comparing it to market implied rates of what they think is the terminal rate might actually be a more relevant metric than assessing it relative to this unknowable R star. So saying, okay, interest rates are now high relative to where we think, or where the market thinks they will be in 3 years' time, that is then a characteristic of tight monetary policy. Because again, if you think about intertemporal substitution, that's really going to be important when you tell people interest rates are going to be low for the next 3 years, but after that we're going to increase them again. And that's really that is really the time limitation on that sort of forward guidance. That is really what is going to encourage people to consume now rather than in the future. If I tell you, if I go out and communicate and say, oh, interest rates are going to be low for the next 10 years, well, why would I buy now if I can also postpone and wait and see until year 9 if interest rates are still going to be low then? So in our model, it is really, to communicate it effectively, you really want to communicate about, okay, interest rates from where they are today relative to where they're going to be in the medium term, say 2-3 years out.
Fair. Thank you very much, Tim, for that. Alexander, you have your hand raised.
Yeah, I have one question. So you basically say that you study this through the persistence of monetary policy shock, right? But what is the role of expectations here? So if you study the inflation shock itself, the households are still rational and they still understand that kind of nothing is, so they know what the model is doing, right? What is the role of expectations if actually the shock is can trigger the increase in expectation and the anchoring of expectations? Would it be the same, or do you have any concerns about that?
Yeah, no, that's a good question. So in our model, the central bank satisfies the Taylor principle, and we don't allow, in contrast to papers that we saw earlier, or in contrast to some work done by my co-author on this, Paul Berdery, who has like a separate line of papers where he does allow for expectations de-anchoring. That is not something that we address in this particular paper. It's not super clear to think through how this might affect things, but yeah, in the analysis we've done so far, we've limited ourselves to the central bank satisfying the Taylor principle. So in that sense, agents are assured that ultimately inflation will come back to target. But yeah, I agree, it would be a very interesting and relevant extension to see what if it wasn't the case. Yeah.
Right. Thank you very much, Tim, for your presentation. And let's now move on with our second presentation.
Thank you very much.
Let me invite Tho Pham from the University of York. Tho, the floor is yours.
Yes. Let me share my screen first. Can you hear me?
Of course. Yes, we can hear you.
Just 1 second. Can you see my screen?
Yes, we can.
Okay, perfect.
Right. Try to stick to your 20 minutes. Thank you.
Yes. Right. Thanks everyone for being here, and thanks for having me. This is a joint work with Sasha from National Bank Ukraine and Alexandra Talavera from Birmingham. Let me say that this work is pretty much in the early stage. So whatever I'm presenting today to you is very like early stage kind of results. And of course, we're gonna work on this much more. And I will talk about like our plan to work on this in the future in the last slide. So, well, the paper started because we see some challenges in terms of like statistics collection, and as I will explain later, this will have the implication for monetary policy in Ukraine as well. So as we all know, since the start of the full-scale invasion in 2002, there have been a collapse of official statistics in the sense that the statistics office, they was not able to continue collecting many types of surveys, including labor force and business type of surveys. Of course, there have been some attempts to conduct the alternative surveys like by phone, by online surveys, and so on, but these data are still very sparse and irregular. They're not regularly updated. And in some of the existing studies on the impact of this full-scale invasion on the Ukrainian labor market, we also see a shift in like the composition of occupations and changes in the kind of occupation that survive and stay thriving during the wartime. So this poses the question of whether we can resort to the alternate kind of data, and in this particular case, we resort to online vacancies, and we want to see whether online vacancies could come in rescues in this particular situation where it is very difficult to collect official statistics, and hopefully we can generate some meaningful signals, some meaningful statistics using online vacancies for monetary policy. Right, so what are some, let's just say, potential implications that we want to generate from using online vacancies and statistics based on online vacancies? Well, first of all, of course, labor market development are very important for understanding inflation dynamics. And this is even more important during wartime because there is kind of coexistence of high employment. On the one hand, there's a high employment, we know that. But on the other hand, there are also labor shortage in certain occupations in certain kind of sectors. So it leads to the challenge of like how we can understand the impacts of this coexistence of high employment and labor shortages in certain sectors, in certain occupations on wage and price dynamics. At the same time, recent studies on the non-linear Phillips curve have also shown that traditionally we have kind of underestimated the role of labor markets and labor market developments for inflation. And with the new studies on the non-linear Phillips curve, they show that, well, actually, as the market tightness crossed certain thresholds that could have influence on the slope of the Phillips curve that make the slope of the Phillips curve even steeper than we could have thought. So given all these, let's just say, potential implications for monetary policy making in Ukraine, and the fact that we do have access to a good source of online vacancies, we started working on these papers that trying to find how we can take advantage of the data source that we have to complement what have already been done at the bank. So in the following, what I will talk about is I will give you an overview of the data that we have. And of course, we will talk about what are the advantages and also the limitations of the data. I also will talk about how we process the data and what are the challenges here that we have to make our, let's just say, our own decision of how we're gonna proceed with the data. And I will show you some trends in demand and labor demand and supply since January 2000, since the start of the full-scale invasion. And I will also show you some estimations, just very simple post-stage type of estimations on the wage and labor markets supply demand kind of benefits. Right, so the data that we have access to and that we use for this research is from Jubilee, which is a job search aggregator. So it is not like where companies have to sign up and post their vacancies. It is literally the data aggregator where they spread online vacancies from other job board websites, from the company websites, from like the recruitment agencies, and so on. So they pull data from a lot of sources on the internet. And they also do some data duplications because, of course, one vacancy can be posted on multiple platforms. So the Jubilee team, they do have their own algorithm to remove the duplications of job posting as well. This platform, they operate in over 70 countries, and it is headquartered in Ukraine. And obviously, it is one of the largest job search platforms in Ukraine. And that's why the amount of data that we got from the platform is huge. In this, for this particular project, we have used data that we got from the platform since January 2002, and the data has been continuously updated until now. But for the analysis, the earlier stage of that analysis, we only keep data from January 2022 until August 2024. In this data, we observe a lot of different data fields, including the job identifier. So each job is given a unique identifier. We also have the data on the job titles, on the job description, the location of the job, the minimum salary that the firm offers, if they ever disclose the salary. And of course, if there is information about minimum salary, then we also have information about the currency of the salary. What is the salary rate, whether it's monthly or yearly or hourly. And when the job was created, when the job was first posted on the internet. Now, one interesting thing, or let's just say one interesting variable that we do observe in our data from August 2022 is the number of clicks on the daily basis. That for every single vacancies, we can check on each day how many clicks that the vacancy received until it disappears from the job board. So obviously the amount of data is huge. The information is really rich, but there are known limitations of the data, both in terms of online vacancies limitation in general and also limitation of this particular type of platform. So the first one is obviously the data that we have is not representative of the whole labor market because it tends to overrepresent certain sectors like IT jobs or white-collar jobs, jobs in urban areas, in bigger cities, and those that require higher education, whereas it tends to underrepresent jobs in public and informal sectors. Now, the wage data, the wage information that we have in the data is, of course, the posted wage, which is totally different from transacted wage, where transacted wage would also include bonuses and premium and so on that we cannot observe with the posted wage. So that's one thing that we have to keep in mind as well. And many ads actually do not disclose wage. As I will show you in figure later, this trend of ads over time, whether or not they disclose the minimum wage. But regardless, we still think that using this kind of alternative data during the difficult time is still very beneficial for policy making because it provides very broad coverage and it has rich metadata that we can utilize to extract the real time and what we call here surviving signals, which during the time where the official data collapsed. Right, so a little bit about the data processing that we do. To process the data, we first only keep jobs of which location is in Ukraine. And even though the disclosed location is Ukraine, it could be remote or it could be hybrid job. So it doesn't need to be like in-person working in the office type of jobs. When it comes to posted wage, we have to make decisions whether we only keep monthly wage or whether we also need to keep other type of wage like annual wage or hourly or weekly and convert them back to monthly. We do both and our results are actually robust to both way of treatment of wage in our estimation method. And in the data that we observe, many ads are of course have the wage listed in UHA, but which we refer to as domestic wage. But there are many others that are also listed in foreign currencies, most likely USD or euros, which we refer to even to as international wage. And again, we have to decide how we're going to treat the international wage in our analysis. And then for the first step, which takes a lot of time of what we do for this for this paper, we have to process the title because we want to map the titles of the to the occupation or standardized occupations. And here we use a two-step process. So in the first step, we map each raw job title to an actual occupation using ChatGPT. And then in the second step, we try to normalize the output from ChatGPT to remove some noise and to make sure that we have a clean, standardized list of occupations to do the analysis later. So we normalize by using this JobBot, which is an LLM that was trained on English job titles and job descriptions. So as I'm showing you here, we see that the number of vacancies posted on this platform has dropped significantly since August 2022, which, if you think about it, it is like the start of this stabilized stage of the war. So there was about 6-7 months for the onset, the initial stage, and then starting from August 2022, the war became kind of staggered and kind of stalemate kind of situation, and it is reflected in the number of vacancies that we can observe over time as well. Another interesting thing that I want to point out is before August 2022, we see at least 50% of us that had vacancy that had wage information listed in the domestic wage, so UAH. Whereas since August 2022, when Ukrainian firm posted online to look for employees, they tend to not disclose wages anymore. Opposite of that is the rise in the number of ads since August 2022 that posted with international wages like USD or euros job wages. I will quickly skip through these figures where I just wanted to show you exactly how the distributions of these vacancies change over time across regions. And obviously, over time, we see a lot of vacancy disappear, especially in the kind of frontline kind of areas. Up to the point that when we look at only the vacancies that had wages listed in the domestic currency, there's almost zero in many regions by August 2024. When we look at the trends across occupations, we can see that compared to the first 6 months of the full-scale invasion, we see that the jobs in like engineering or IT sectors, they still survive. They are still among the top occupations on this platform. Whereas some other type of jobs, especially laborers type of jobs, disappeared from the top 10 occupations, and we see the emergence of new type of occupations since the onset of the war, like the social and religious professionals. We also looked at the number of clicks per apps and the number of clicks per month and plotted this figure here. And again, we can see that since August 2022 or the end of 2022, we see a declining trend in the number of clicks per month and the number of clicks per app, indicating kind of labor shortage. Because if you think about clicks, it is kind of a proxy, very noisy proxy for labor supply. And clearly we see a declining trend in this kind of labor supply on this online platform. We also look at the duration trend, and here duration is again a noisy measure of duration, where we look at from the time when the vacancy was posted until the last day when it received a click from the job seekers. On average, one vacancy is active on the platform for about 50 days, and then the vacancy would disappear afterwards. Right, I think I'm running out of time, so I will just quickly go through some very basic estimations that we have for now, and then spend a few more minutes on on the plan of what we want to do after this. So in the first table here, what we want to look at is simply whether this traditional kind of relationship between wage and the demand for labor would exist. And here we can see that as the number of vacancies is higher, it is positively related to the number, to the posted wage in the following month, which in line with what we could expect, because firms have to compete for the talents for the workers, so they have incentives to post higher wage to attract more applicants for their vacancies. Then we now add in our estimation not only the labor demand proxy, but also labor supply proxy, which is the number of clicks in the previous month. And again, we see a very kind of consistent and expected relationship here, that as the number of clicks is higher, we also we see a decrease or a reduction in the offer wage that firm is willing to offer to the job seekers, which tell us this consistent story that as the labor supply is higher, that there are many more seekers who are looking for the same kind of job, then they lose their bargaining power, and when they lose their bargaining power, firms can set wage lower in the following month. We also added the interactions between the log of clicks and the log of work events, as well as the log of vacancies, the interaction between the log of vacancies and the log of work events. And in both cases, we see that the war actually amplifies this existing underlying relationship between labor demand, labor supplies, and wage. Right, so the key takeaways that I want to tell you at this stage of the paper is, it seems to us that online vacancies are a good source of data as well. It cannot replace the official data, but in the absence of good official data, it could be very useful to extract signals about demand and supply pressures and the impact of these pressures on posted wage. And that even with the noisy data that we have, we still see some signals that are very consistent with the labor market theory. And what we can do with these signals is we can say that these vacancies and click dynamics can give us some sort of early warning indicators about the wage pressures and labor market slack. And there are some regional variations in these kind of signals that are important for us, or for the policymakers who think about targeted support for all the reconstruction policies. Like I mentioned, this is a very early stage of our study, and in the next stage, what we want to do is we want to leverage the rich job description, because so far we have only processed the job titles, but of course a lot more information content in the job description that we haven't processed. So we want to extract like skills, tasks, sectoral, and contract type information from the job descriptions, which will help us with occupation mapping to help us to detect emerging demand for certain skills for certain jobs in some sectors, and it can also help us with our estimation. And given the limited posted wage that we have in the data, we also want to extrapolate the posted wage information by combining the indicators that we obtain from text analysis and location to impute the missing wages, which will allow us to track the wage growth on the longer kind of time span kind of basis. And we also want to extend the data set to the before full-scale inflation period as well, to be a baseline for comparisons. And I think that's it for me.
Thank you very much. Thank you very much, though. I'll ask a couple of questions. I think the The first question that I would like to ask is, you've already mentioned that posted wages are not the same as transacted wages. So, and in your results, you have shown that there are lots of interesting patterns that affect posted wages, meaning like a higher employer demand, right, pressure, and the job seeker pressure, and on top of it, we also have wartime events, right, that amplify this effect. So, how should we interpret those patterns? Is it more of a leading indicator for like future wage and its dynamics, or is it more about the further divergence of posted wages from the actual transaction wages?
Right. So I think we can interpret as some sort of early warning kind of indicators of what might have been happening or what might happen to the labor market, because when it comes to comparing the posted wage and the contracted wage, what we also did, of course, with a very limited data availability, we also created our own wage growth kind of indicators and correlated with the wage growth indicator that we could find from official statistics source. And the correlation is about 40–50%. So it's not like amazingly in terms of correlation coefficient, but it's reasonable. So there are some kind of moderate correlation going on between posted wage and contracted wage. And I think in the context of like the war, this correlation could be even slightly higher because of the war impact.
Got it. We have one more question from the Q&A box from Marco. Have you considered estimation of wage price pass-through, for instance, through real wage gap? If yes, what was your approach?
Sorry, so can you repeat the question?
Yes, it is. Have you considered estimation of wage price pass-through, for instance, through real wage gap? Or what indicators may show a magnitude of labor market tightness?
That's a very good question. We haven't considered that, but definitely, like I said, it is an early stage kind of analysis. So that is something that we could think about whether we can incorporate this in the next analysis as well.
Perfect. Thank you. Thank you very much, though. Thank you for the presentation and for your work. So now we'll move on to our final speaker for this session. I would like to invite Malgorzata Valerich from Narodowy Bank Polski. So once again, share your slides and
yeah. Can you hear me? Yeah?
Yes, we can.
Okay. And now can you see my slides?
Yes, we do.
Okay, perfect. Let me make a full screen. Oh, okay. Can you see the full screen? Yeah.
Yes, okay. we can see the full screen, but I'm not sure whether we're seeing your slides.
Oh, okay. So let me do it again. Because where is it? Okay. Sorry for that. Because where is it?
Now we can see your slides. Yes.
I need to make the full screen. Oh, now it's okay, right?
Now it's perfect.
Okay, perfect.
Right.
Okay, so hello everyone. It's a great pleasure to be here and to be able to talk to you today about the project, which is the joint work with my colleague from NBP, Paweł Kopiec, and which was aimed to investigate whether monetary policy in Poland works differently in periods of high and low unemployment. Okay, and as is usually the case, let me start with a brief motivation behind our study. So, according to the standard textbook intuition, when the amount of either resource in the economy is substantial, for example, where unemployment rate is high, adjustments to demand shocks are more quantitative in nature. So, for example, in response to a positive demand shock, companies can easily hire new workers, increase employment, and consequently output. At the same time, the corresponding impact of demand shifts on prices is rather minimal. On the other hand, when unemployment is low and the either resources are scarce, then the adjustments are more price-based. companies cannot easily hire new workers due to lack of labor, so higher demand results in a rise in prices rather than an increase in production. And this intuition has important implications for the predictions about the effectiveness of monetary policy shocks, depending on the amount of idle resources. So it suggests that monetary policy shocks, which can be classified as the demand shocks, lead to larger adjustments in quantities when unemployment is high than during the periods of low unemployment. And the opposite can be expected for price adjustments, which are more likely to be substantial when resources in the economy are scarce. And our aim in this study was to check whether this intuition works for the Polish economy. So importantly, over the past 20 years, Poland has transformed from having one of the highest unemployment rates in Europe to boasting some of the lowest, making it a perfect environment for this kind of analysis. So what exactly do we do in this study? So we study the effects of monetary policy shocks on unemployment and prices, that is two endogenous variables, using non-linear panel local projections that feature a state-dependent impact of the unemployment level on the dynamics of the dependent variables. And this analysis is based on the quarterly data from Polish voivodeships, which are the highest level administrative units in Poland. So we have 16 voivodeships in our country. And the baseline estimation uses data from the period 2001-2019. So we deliberately end our sample before the outbreak of COVID-19 pandemic, because, this was an exceptionally extraordinary period and modeling it poses some challenges. However, in the robustness analysis, we also extend our sample to include those more recent periods. And we use the exogenous measure of monetary policy shocks. This is the series calculated by our colleague from NBP, Mariusz Kapuściński, and he used high-frequency data and used the methodology developed and applied to the US by Eric Swanson. And this is our baseline analysis. And in addition, we conduct several supplementary exercises to further support our findings and to rule out some potential explanation that could also drive our results. So first, we compare the distributions of monetary policy shocks under high and low unemployment to see whether the potential difference in the distributions affect our results. Second, we look at the responses of employment in tradable and non-tradable sectors to monetary policy shocks, depending on the level of unemployment. And later during my talk, I will try to explain the rationale behind this type of exercise. And third, we modify the measure of economic slack by replacing the unemployment rate with the retail sales. Okay, so let me skip the literature and let me go straight to the model. So the tool we use is extremely simple. The equation we estimate, you can see it at the top of the slide, and this is a standard panel local projection with fixed effects with only one difference. So on the one hand, right-hand side, we have the sum of two components, the part indexed with letter H, which refers to the high unemployment regime, and the part indexed with letter L, which corresponds to the low unemployment regime. And we estimate this equation for various horizons J, where J takes values from 0 to 8. And on the left-hand side of this equation, we have the change of the endogenous variable. In our case, this is either the registered unemployment rate or log of the CPI index in voivodeship I. And we calculate this change between period T plus J and T minus 1. And a key component of this equation is function f. It is a smooth increasing function that takes values from the range between 0 and 1, and its value depends on the level of the on the variable capturing the state of the economy. So here in our case, it is the lagged unemployment rate. And we use the lagged unemployment rate instead of the current one to avoid endogeneity problems. But since unemployment moves relatively slowly, the unemployment rate from previous periods can be considered as a good proxy for the current unemployment level. And this equation, variable epsilon, denotes our monetary policy shock. As I said, this is the exogenous measure calculated using high-frequency data. And the parameters attached to this variable, that is beta H and beta L, are the key coefficient of interest. So we use them later to plot our impulse responses in the low and high unemployment regimes. And matrix X, this is the matrix of controls, and the set of controls includes lags of unemployment rate, lags of inflation, lags of short-term interest rate, as well as some foreign economy variables, which are typically used in the estimations of Phillips curve for small open economies. Okay, so following the literature, we assume that our f function takes the form of the logistic function, and in this function, parameter theta governs the pace at which the unit switches from high to low unemployment, and the higher the value of theta, the steeper the transition between two unemployment regimes. So in particular, as theta approaches infinity, the model transitions into a discrete regime switching setup, that is function f takes only two values, either 0 or 1. And parameter c determines the location of the function, and parameter sigma u denotes the standard deviation of the unemployment rate in our sample, and this used purely for standardization purposes. Okay, so in practice, estimating parameters of the f function is not straightforward. So therefore, we follow the literature and we calibrate them, and we set parameter theta equal to 3 in our Bayesian analysis, and the parameter c equal to the median unemployment rate in our sample. So this latter choice implies that for half of the observations in our sample, our function f takes values smaller than 0.5. That is, it provides relatively more information about the behavior in the low unemployment regime. And here you can see our transition function f. It is shown by the yellow line, and it is plotted together with the kernel density of voivodeship unemployment rates, depicted by the red line. And the gray line, this vertical line, indicates the median of the voivodeship unemployment rates. And for this value, our function f takes the value equal to 0.5. Okay, and now let me turn to our results from the baseline model. So the first row in this figure shows the impulse responses of the unemployment rate to an accommodative monetary policy shock that lowers the interest rate by 1 percentage point on impact. And these responses are shown for the high unemployment regime in the first column and the low unemployment regime in the second column of our figure. So technically, these impulse responses reflect the parameters beta H and beta L from the equation I showed you earlier, rescaled so that the monetary policy shock corresponds to 1 percentage point drop in the policy rate. So to carry out the standardization, we first estimated separate local projections for interest rate to measure how strongly this variable responds to monetary policy shock. Okay, so after the monetary accommodation, unemployment decreases much more strongly in the high unemployment regime by about 2.5 percentage point after 7 quarters, whereas in the low unemployment regime, the decline is much milder, around 0.6 percentage points after 6 quarters. And let me also notice that most of the 90% confidence intervals in the high unemployment regime exclude 0, whereas it is not the case in the low unemployment regime. So this indicates that monetary policy is more powerful when economic slack is high. So it is in line with the idea that policy works more effectively when plenty of idle resources are available. But we also wanted to test more formally whether the responses of unemployment in both unemployment regimes are, the same or different. So we conducted the F-test and tested whether parameter beta are equal across regimes. And the results of this test are presented in the third column of our figure, and they indicate that for most periods we cannot reject equality. So the difference in responses of unemployment between two unemployment regimes should be interpreted with some caution. And now let me turn to the price responses. So they are shown in the second row of this figure. So a 1 percentage point monetary accommodation raises the price level by about 1.5% in the high unemployment regime, compared with roughly 4.5% in the low unemployment regime. And importantly, while the price responses in the high unemployment regime are generally not statistically significant, the response in the low unemployment regime is significant across most horizons. And also the results of the F-tests indicate that the responses of prices into the two unemployment regimes are not the same, at least for some horizons. So all in all, our findings align with the initial intuition behind our study. So according to which, when idle resources are scarce, firms respond to a positive shocks primarily by raising prices. And moreover, taken together, the results show that the contrast in price adjustments across the two unemployment regimes is sharper than the contrast in quantitative adjustments. Okay, and to see whether our results hold up, we performed a number of robustness checks, and some of them were pretty standard, like changing the number of lags or modifying the trending methods or modifying the set of controls, and others were more tailored to the specific context. So, for example, we extended our sample to include those more recent periods, and we used the methods proposed in the paper by Lenz and Primicherry to account for the extreme outliers occurring in this period, or we also tried to estimate the parameters of the F function instead of calibrating them as is usually done in the literature. But all these robustness checks confirm the results from our baseline analysis, indicating that price adjustments are more pronounced in low unemployment regime, while quantity adjustments are more pronounced in the high unemployment regime. Okay, so this is our baseline analysis, and let me move to some additional exercises we conducted. So the first one is about the comparison of the distributions of monetary policy shocks. So far, our main message has been that monetary transmission in Poland depends on the level of unemployment. However, one could argue that the observed differences in how the economy responds to monetary disturbances may not reflect the state of the economy itself. Instead, they could arise from the difference in the distributions of shocks across unemployment regimes and from asymmetric responses to specific types of monetary shocks. So, for example, if positive shocks occur more frequently when unemployment is low, and if they tend to have stronger effects on prices but weaker effects on quantities compared to the negative shocks, then such asymmetry could mechanically generate the results we observed. And to address this concern, we used the Kolmogorov-Smirnov test to compare the distributions of monetary policy shocks across the two unemployment regimes. And the results of the test indicated that we cannot reject the hypothesis that these distributions are the same. Therefore, we conclude that our main findings are not driven by any regime-dependent pattern in monetary policy shocks themselves. Okay, and here you can see also the CDFs of monetary policy shocks across two unemployment regimes, and it is quite clear that they are pretty similar. Okay, and now let me move to our second exercise. So to provide further support for our main result, we conducted an additional experiment based on 4 premises. So first, monetary policy shocks can be classified as demand shocks. Second, the reactions of unemployment and employment to monetary disturbances are closely related. That is, unemployment negatively commoves with employment. Third, employment in sectors producing non-tradable goods is heavily influenced by local demand, while employment in sectors producing non-tradable goods relies more on country level or foreign demand. And fourth, the local unemployment level is an important factor influencing household demand at the voivodeship level, both through unemployment fears and differences in consumption patterns between employed and unemployed. So given these 4 premises, one could expect that if our main result holds, then the difference in the response of non-tradable employment to monetary policy shocks between periods of high and low unemployment should be larger than the corresponding difference for tradable employment. And to verify this claim, we estimate a model which was very similar to our baseline panel local projection, but with the dependent variable being the change in the log of unemployment in the enterprise sector. And we classify industry as the tradable sector, and for the non-tradable sector, we include construction of buildings, specialized construction activities, retail sales, accommodation and food service activities, retail, real estate activities, and administrative and support service activities. And first, I will show you the responses of total employment, and then we will look at the comparison between the responses of employment in tradable and non-tradable sectors. So following the drop in interest rates, employment in the high unemployment regime rises more strongly, reaching a peak of around 4.5%, while in the low unemployment regime, the increase is much more moderate, peaking at around 2.5%. And similar to our baseline unemployment model, the F-tests results show that we cannot reject the hypothesis that the response of total employment across both regimes are the same. And now let me move to the comparison of the responses of employment in tradable sector, which is presented in the first row of this figure, and non-tradable employment presented in the second row of our figure. So after the decrease in interest rate, employment rises in both sectors, both tradable and non-tradable, and this increase is stronger in the high unemployment regime. However, according to our F-test results, the responses in both unemployment regimes are not statistically different for tradable employment, while the differences in non-tradable employment between low and high unemployment regimes are statistically significant for most horizons. So this supports our earlier intuition, according to which changes in non-tradable employment, which are heavily influenced by local demand driven by monetary policy, are significantly affected by the unit level unemployment rate. And since this classification of sectors as non-tradable was somewhat discretionary, we also conducted additional estimations in which we excluded certain sectors from the non-tradable group, but these changes in classification didn't alter the results we obtained. And now let me move to the last exercise. So while using unemployment as the measure of the economic slack, and the argument of the F function seems to be well grounded in economic theory, it is natural to ask whether our results hold up with alternative measures of economic slack. And to explore this, we replaced regional lag unemployment rate with lag HP filtered retail sales as the argument of our regime switching function F. And here we can see the impulse responses from this kind of estimation. So the results show the unemployment tends to decline more strongly in response to monetary easing when retail sales are low than when they are high, although this difference is not statistically significant. In contrast, price responses, the difference between price responses across two across two states, across high and low, in times of high and low retail sales is statistically significant, and the increase in CPI following the reduction in interest rate is larger when retail sales are high. So overall, using retail sales as instead of unemployment as the argument of our F function doesn't change our main conclusions about the state-dependent effects of monetary policy under conditions of high versus low economic slack. And now let me very, very briefly recap. So in this paper, we provide empirical evidence that monetary transmission in Poland depends on the level of unemployment. And we show this by estimating nonlinear smooth transition panel local projections using Polish regional data. And our findings confirm the intuition that monetary policy shocks lead to stronger adjustment in unemployment when labor market slack is high, and to more pronounced price adjustments when slack is low. And the statistical significance is particularly clear for prices, and the results are robust across different model specifications and a variety of robustness checks. And that's it. Thank you very much.
Thank you very much, Malgorzata. That was an excellent presentation, quite an interesting topic. So we don't have a lot of time for Q&A, so I'll ask just one question. So your results have reported that there's an asymmetry in the reaction, there is asymmetry in the effect of monetary policy shock. Do you think that a standard Taylor rule can reproduce this asymmetry, or would it require some like augmented rule with more specific slack contingent parameters?
Yeah, I think like that there's like the whole literature on this non-linearities in the Taylor rules, and I think it's like more our results like indicate that it would be like more appropriate, right?
More non-linear. Okay, thank you. Thank you very much, Malgorzata. That concludes our research session. Thanks to all of our speakers, Tim Williams, Thor Pham, and Malgorzata Valerich, for their contributions as well, for all of you to listening to our speakers. Now let's move on to the scheduled break before the keynote lecture by Erik Thedéen from the Sveriges Riksbank on lessons and challenges on inflation targeting in Sweden. So please stay connected, and see you in 10 minutes.
Dear colleagues, that's my honor to present, to introduce our keynote speaker of today's event, Governor of Swedish Riksbank, Erik Thedéen. I don't think that Erik requires a lot of introduction. Actually, I would like to highlight that Governor Thedéen is a good friend of the National Bank of Ukraine and Ukraine in general. Governor Thedéen was the first central bank governor who visited the National Bank of Ukraine in person during the full-scale invasion, and we definitely appreciate that a lot. So without additional introduction, Erik, please, the floor is yours.
So thank you very much, Sergey. And you reminds me of that trip I took to Kiev back in 2023, and for sure it was a very important trip for me as well, for the Central Bank of Sweden, the Riksbank, but also for me personally, and of course strengthen my and this institution's, the Central Bank of Sweden's engagement and support to Ukraine. As I always say, this was kind of started as a way of us supporting you, but you have supported us to a large extent. Let me also say to start with that we do have a close cooperation. And as a matter of fact, actually today I had lunch with your new ambassador to Sweden here at the Riksbank and explained to her our close relations. So with that, I will start my speech about the inflation target in Sweden, lessons and challenges. And again, thank you for having me. And the Riksbank, we have these very important ties. And we also, apart from me traveling there back in 23, Governor Pyshny and you as well, Sergey, was here in Stockholm like a half year or a year later and visited us and actually took part in one of our monetary policy meetings for you to understand how we work when it comes to monetary policy, transparency, and the whole process leading to a decision. On Wednesday, the 16th of September in 1992, that was a dramatic day in the Riksbank's long history and for sure also in Swedish economic history. In an attempt to defend the krona fixed exchange rate against the ecu, which was the forerunner of the euro, the Riksbank decided to raise its policy rate to 500%. Yes, you heard me correctly, 500%. But this extreme rate hike was not enough, and just a few weeks later, the exchange rate target was abandoned, and the krona started to float freely. The Riksbank suddenly found itself without a clear strategy for conducting monetary policy, but soon settled on a new target to keep inflation around 2% a year. In the 30 years since then, the new monetary policy strategy has remained largely unchanged and has made an important contribution to the economic stability in Sweden. At the same time, it has often encountered new challenges that have taught us important lessons and encourage us to adapt. Today, I will briefly describe various periods during the Swedish monetary policy history and what challenges we have faced. I would like to highlight a number of challenges that we are still grappling with and to which there is not necessarily a clear answer. Monetary policy can never run on autopilot, nor on AI. Central banks must make a number of choices and dare to change their minds when conditions change. However, I will start by explaining why the inflation target was introduced in Sweden. After the collapse of the Bretton Woods system, Swedish monetary policy still had an exchange rate target in relation to currencies of our main trading partners. But economic policies were not designed to be consistent with the exchange rate target. The stabilization policy agenda was set by fiscal policy, which by and large aimed to keep unemployment low. The tools used to achieve this goal contributed to recurrent budget deficits that fueled demand, inflation, and wages. Inflation was often higher than in the rest of the world, and repeated devaluations became necessary in the 1970s and 1980s. During the 1980s, it became increasingly clear that the trend was not sustainable. Inflation reached 15%, the current account was mostly in deficit, and the government debt to GDP had tripled in 10 years. Several Swedish economists began to highlight the need for a new stabilization policy regime with a focus on price stability. Some steps in that direction were actually taken, but the process was affected by the outbreak of the big banking and currency crisis in the early 1990s. The price level had once again been rising faster in Sweden than in the rest of the world, and the krona was considered to be overvalued and became subject to speculative attacks, hence the 500% rate that I talked about. The Riksbank was forced to try to defend the exchange rate, again with these high interest rates, which exaggerated the banking crisis and contributed to the further devaluation speculation. Eventually, the Riksbank was forced to abandon the exchange rate target and formulate a new target. As price stability has already begun to be increasingly emphasized, the Riksbank and the Parliament soon decided that an inflation target should replace the exchange rate target. After the crisis, several other reforms were also launched in the Swedish economy that was crucial, and I underline that's crucial, for achieving the new current. The social partners agreed on a new wage formation structure that reduced the risk of price and wage spirals. The Parliament agreed on a fiscal framework to strengthen public finances. The budget process adopted both a top-down and a bottom-up perspective. Government expenditure was regulated and surpluses target was introduced for net government lending. The main objective of this reform was not to achieve the inflation target, but to create stability in wage formation and to counteract the tendencies toward increasing public debt. The change in the economic policy, more coherent than under previous regime, put the inflation target in a much better position. The inflation target was thus born out of the crisis in the Swedish economy, where inflation had reached double-digit numbers. And monetary policy was therefore initially characterized by the challenges of creating credibility for the target. The Riksbank gradually developed three important tools. First, clear communication became a way of signaling that the Riksbank intended to meet the target. The executive board therefore placed great emphasis on inflation in its speeches and little or no emphasis on stabilizing the economy. The inflation was the prime target. Second, new analytical and forecasting methods became important for the Riksbank to fulfill and instill confidence in the target, not least because a target placed higher demands on the ability to be forward-looking. Finally, the Riksbank also endeavored to increase its transparency in its decision-making and forecasting. This was needed, among other things, to explain how the Riksbank would actually reach its target, which in turn will help to maintain confidence even if the target was missed. I will return later to the tools we use today to be as transparent. Until the end of the 2000s, inflation target, other reforms in the Swedish economy, and a calmer global economy, so-called greater moderation, then contributed to generally greater macroeconomic stability in Sweden and abroad. Inflation and inflation expectations declined and stabilized. Real economy picked up and government debt fell from its peak around 80% to only 37% in 2008. The positive developments, particularly in inflation expectations, enabled the Riksbank to conduct a more flexible monetary policy that also took in the business cycle and the real economy into account. The period of macroeconomic stability then became to an abrupt end with the global financial crisis outbreak in 2007 and 2008. For the first time since the inflation target was introduced, the Riksbank was forced to make rapid and substantial shifts in monetary policy. But the real challenge was that the bank's tools for achieving the target were insufficient. Until now, the Riksbank had only used the policy rate to stabilize inflation and output. However, due to the financial instability, the normal challenges of monetary policy, the so-called transmission mechanism, no longer functioned as required for the monetary policy. The Riksbank therefore chose to dramatically increase its lending to banks to stabilize the economy again, i.e. we provided liquidity. After the global financial crisis, the next big challenge for inflation target, not only in Sweden, was that inflation consistently fell below our target. This was not expected when inflation target was introduced after a couple of decades of extremely high inflation. The fact that inflation was lower than target could in some ways be perceived as something of a luxury problem in the then historical perspective. On the other hand, the problem of below target inflation persisted despite steady reductions of the policy rate, even which eventually approached zero. Confidence in the inflation target thus became a cause of concern again, but this time on the downside. The Riksbank, as well as many other central banks, then started so-called unconventional measures by introducing negative interest rates and asset purchases. The Riksbank used both tools between 2015 and 19, while inflation slowly returned to target and continued with extensive asset purchases during the pandemic, then of slightly different reasons, i.e. financial stability. These unconventional measures have become subject to discussions in Sweden and in many other countries. There has been criticism. This is perhaps particularly true of the securities purchases, the bonds that we bought. Criticism of them was also later intensified by the fact that the Riksbank, like many other central banks, made large losses on the purchases when interest rates rose sharply after the pandemic. We actually asked for capital injection from the parliament and eventually got 25 billion Swedish, which is about 0.4% of GDP. When financial markets were functioning normally, the effects of these purchases are more uncertain, and they also risk disrupting the functioning of the market. This applies in particular to the purchases of private securities, i.e. mortgage bonds and corporate bonds. Large-scale purchases of securities to safeguard the inflation target may, in extreme circumstances, be justified, but the threshold should be, in my view, high, and the Riksbank should then primarily buy government securities. Another important lesson is that the Riksbank should report the potential costs of bond purchases, financial risk and side effects more clearly than we did in this period. The Riksbank's most recent challenges face has, of course, been fighting, again, the high inflation after the pandemic. It is the first time that the inflation target has seriously been tested on the upside, and hence it was introduced in the 1990s. So there are many lessons to be learned from this period. I think in particularly important observation is that the rise in inflation could be reversed relatively quickly from extremely low inflation to very high inflation. An inflation target is an important part of the reason why we were able to handle it. Inflation expectation in Sweden remains stable, and the social partners, the employers and the employees, the trade unions and the employers, have avoided entering into price and wage spiral, which is good news for the regime and a big difference from the geopolitical factors created the inflationary outbreak in the 1970s. So let me now turn to the challenges we face when it comes to inflation targeting. Although the recent rise in inflation could be reversed relatively quickly, does not mean that we should take a low and stable inflation for granted. Inflation target is constantly exposed to new challenges that can result in either higher or lower inflation, and that the central bank must address. There are also many challenges for monetary policy that central banks have to face on a regular basis. I would like to highlight three of these that I have experienced myself and often think about. First, what considerations should monetary policy give to financial stability? Of course, monetary policy has a direct impact on financial stability, and that is impossible to ignore in policymaking. In addition, the Riksbank and many other central banks are required by law to contribute to financial stability. Although in the Riksbank case, it is the inflation target that guides monetary policy. However, since financial imbalances constitute a threat to price stability, the situation can arise where it's reasonable that monetary policy should attempt to counteract these within the bounds of inflation target. The central bank may then be forced to make a trade-off between attempting to achieve the inflation target in near term or the longer term. For example, the Riksbank faced such a trade-off in the years between the financial crisis and the pandemic, when low inflation required an increasingly expansionary monetary policy in a situation where private debt was already high and rising. The Riksbank initially chose not to cut the policy rate further, but later changed its strategy when inflation became too low and the confidence in the target was considered to be under threat. But it is not clear how we should act in a similar situation where to rise again. The first and most important line of defense, and an area which has been developed largely in recent years, is an effective macroprudential regulations, borrower-based measures on households, countercyclical buffers when it comes to capital. And in Sweden, that responsibility lies mainly with the Swedish FSA. I personally, however, do not dare to rule out that monetary policy may also need to counter out the risks in the future, and it remains a challenge in the inflation target framework. What consideration should monetary policy give to exchange rate? When you have an inflation target, the exchange rate should be allowed to float freely. In practice, however, it is so important to firms and households that central banks often find it hard to ignore. The Riksbank also sometimes chooses to comment on the development of the krona, usually in connection with its effect on import prices and hence on inflation, but also occasionally when its value has clearly deviated from what we consider to be reasonable level in the slightly longer term. Sometimes, however, inflation target in central banks go further, for example, by intervening in the foreign exchange market to counteract substantial changes in the exchange rate in the short term. The Riksbank also did this back in 2001. My position, my view is that such measure must be justified and done also only in exceptional circumstances. But in normal times, central banks should try not to worry too much about short-term fluctuations, partly because they are notoriously difficult to understand and forecast. That said, however, we must endeavor to understand these developments as far as possible to be able to understand whether and how they should be taken into account when it comes to monetary policy. Third challenge, central bank independence cannot be taken for granted. Central bank independence is an important part of inflation targeting. Delegating responsibility for monetary policy to independent officials makes it easier to take an unpopular but necessary decision and ultimately increase confidence in the inflation target. But of course, independence does not mean that the central bank is disconnected from politics and free to do what it wants. Monetary policy must be democratically anchored. So it is up to elected politicians to decide on the degree of independence of the central bank, what its mandate should be, who should lead it, and who it should be financed and how much. It also means that the independence cannot be taken for granted, but must constantly be earned. The central bank must consistently demonstrate that it has done what it could to fulfill its mandates. It must also begin taking action beyond it. It must also not begin to taking action beyond its mandate, the so-called mission creep, which is perhaps especially likely to happen when new economic and political issues turn up in the public debate and become very popular. Of course, in many cases, it's reasonable that the central bank should pay attention to some of these issues. But it's important that the central bank does not engage in all parts of various issues, but carefully consider which aspects that are connected to the mandate. And of course, climate change is a case in point. Climate change has and will have an effect, for example, on supply disruptions with hot weather and increasing prices on food and crops. But we should not, as a central bank, have strong views when it comes to energy composition in the country and so on. Personally, I think Swedish experience suggests that transparency is a necessary condition for credibility, which in turn is necessary for independence. I'm therefore proud that the Riksbank has been recognized as one of the most transparent central banks in the world on several occasions. We publish monetary policy report with detailed focused information, including focus on the policy rate, the so-called interest rate path. We publish minutes of monetary policy meetings in a personalized way, so actually you could read what I and my colleagues said in different meetings when it comes to monetary policy. We hold press briefing after our decisions that are taken 8 times a year. We report annually on monetary policy to the parliament, and are also called to account during parliamentary hearings, both on monetary policy but also on financial stability. We are regularly evaluated by independent experts to give we give over 100 presentations a year to stakeholders around the country and internationally. The work on transparency can of course be demanding, but it has served as well by maintaining strong support for our independence and for our inflation targeting policy as a whole in the parliament, and I would dare to say also among Swedish population. However, it's only natural and important that the forms of our communication and transparency change over time, and in this endeavor, central banks have much to learn from others' experience. And we have actually a new evaluation being presented in the near future by 2 academics on the Swedish monetary policy in the last 10 years. And that will, of course, put focus on issues like quantitative easing, negative interest rates, the fight of the latest upsurge in inflation, and other important policy areas. With that, Sergey, I'll stop.
Governor Dean, dear Eric, thank you very much for this insightful journey out the history of Swedish monetary policy, the achievements and challenges. Many of them are actually common for many central banks with the inflation targeting. And, in Ukrainian context, so it seems for me that we share not only the colors of our flags, which is actually quite, I would say, understandable from the background, from your background behind your back, but also from many features of the monetary policy regime. We just recently celebrated the 10th anniversary of the inflation targeting announcement in Ukraine, and I should say that we actually, in our experience, in our monetary policy implementations, actually learned a lot from Swedish experience, and we are very thankful for the technical assistance we received from the Riksbank other these years, and definitely so that helped us a lot. And it is, and saying this, let me actually ask the start on our Q&A session with my own question. So yes, we recognize that Sweden has one of the world's longest and most transparent experiences with inflation targeting, and as I said, so we learned a lot from you. And looking back, what do you consider as the most important institutional or operational reform that strengthened the credibility of the central bank in the monetary policy area? And if you would have such a possibility to design the inflation targeting framework today from scratch, what elements would you preserve and which would you change in light, especially in the light of the recent global shocks?
No, the first question was the most important. I think, of course, the legal backing for the independence, that's typically what people say. The kind of constitutional change, which was actually change of our constitution. So it's a very strong legal foundation of the independence. So that's the standard answer. But I will not take the standard answer. I would like to say that maybe the most important, I said a little bit about this in my speech, is the fact that we have been able to kind of make this idea of an independent central bank and then the idea of some institution actually keeping track on inflation as a good thing, and not only in the political circle, but I would say also generally when it comes to the Swedish population. So we measure our credibility on an ongoing basis. And of course, that went down slightly when we hiked the interest rate in recent years from 0 to 4%. So that was a big hit for high indebted Swedish households, but still on a fairly okay level. And now, as we have lowered rates, we are on very, very good level when it comes to the confidence or the credibility as what Swedes think about the central bank. And Swedes wouldn't think about our legal backing. They will think about how we communicate, what kind of transparency is, do we seem to be reasonable? So I think that's the biggest lesson, that don't only go for the legal mandate, which is important, but actually go for having the transparent communication. Be humble. I think that's also important, that we have made mistakes. We have made policy mistakes. And to be able to talk about that, say that we've learned, maybe we'll do a little bit different in the future. I think that also builds this credibility rather than to be stubborn and say that you're always right. I think also it's a balancing act, of course, but independence means that you can't take instructions from the political systems. That's said in the law. It also says in the law that I'm and my fellow board members are not allowed to take instructions from the political system. So that's fine, but it doesn't say that we can't have a dialogue with the political system. That goes back then to transparency. So I try to engage in an open dialogue with members of parliament, Minister of Finance, to build that trust. And sometimes we might agree to disagree, but we still have that open mind transparency. And I think that has helped us to build this credibility. So when what will I do differently? I think where we are now, it's a very hard question, because if you're basically starting from from zero, right? I think many economists say, and I tend to agree, maybe if we would start from zero, maybe a touch higher inflation target would be easier, given our experience on the zero lower band and the experience back in the end of the 2010, 2015, 16, 17. I don't think it's a major thing, but I think everything being equal, maybe that's been better to have, let's say, a 3%. Having said that, we are not considering to change our target, because as a small open economy, to have a different target than the rest of the world, the only thing that will raise is, credibility issues. So that's not a, so I think that might be one issue that you might discuss. Then it's an ongoing discussion in Sweden and other countries how to divide the responsibility. And I come a little bit from that background between financial stability and monetary policy. I'm pretty fine with the institutional setting that we have in Sweden, that we do financial stability oversight, but we don't do supervision. I think the risk with having too much supervision in the central bank is that, I sometimes say this is maybe kind of a wrong wording, but supervision sometimes could be a dirty business. you know, it's a lot of decisions. You might go wrong, you get criticized. It's very kind of intrusive in that way. And that might kind of put the position of the central bank a little bit more at risk, I think, than if you have a very clear focus on monetary policy. And I will stop after this, Sergey. And also financial stability or the supervision could not be, in my view, have the same independence as a central bank has when it comes to inflation targeted. So you need to have a little bit different organizational setup if you have a lot of supervisory mandates within the central bank.
Thank you very much for this comprehensive answer. For sure, it is impossible to disagree with you on the importance of the legal framework, credibility, and transparency. Actually, at the Central Bank of Ukraine, we often say that we don't, as the central bank, we don't live in vacuum. For sure, we have to communicate a lot with politicians, with different stakeholders, and with public in general, in order to perform our mandate effectively. Okay, saying that, let me pass the floor to Professor Kozyuk, a former member of NBU Council. Please, Victor, the floor is yours.
Thank you, Sergey. Thank you, dear Governor. It was very encouraging to listen to you, and also thank you to you personally for your contribution to this event. And also, I would like to be thankful for Riksbank for technical assistance and support for National Bank of Ukraine and for Sweden as a strong supporter to Ukraine in this tough time. I have a few questions to you. First of all, my first question. We live in the time of uncertainty. The strong structural changes are surrounding us. What does it mean to be data-driven central bank in this setup? What's the right measure between data-driven decision, model-driven decision, or something like that? What's the right balance between them? My second question is related to the deep discussion facilitated by BIS publication on the topic of distinction between two inflation regimes. As you know, ECB explicitly recognized that they take into account these two regimes of inflation in their strategy. What is empirical guide to distinguish between low and high level inflation regime, taking into account practice and your visions in Riksbank? And if you allow my third, a little bit provocative question. We know about strong and comprehensive discussion between Governor Ingves and Vice Governor Svensson about the role of interest rates in restraining financial cycle. That discussion went far beyond Riksbank and encouraged a lot of central bankers and monetary policy academicians. What's the legacy of that discussion for Riksbank? How do you see what Riksbank took from that discussion, and what do you advise for other central banks? Thank you very much.
No, thank you very much for really good questions. So, no, I think this. I think we are not the central bank that talks most about data-driven, meeting-by-meeting kind of rhetoric that you could find in some other central banks. So we have kept the interest rate path. We actually think it's important. We have changed it a little bit, and I'll come back to why I think it's important. So we used to have an interest rate path going that we also had in, let's say, in the main chapter in our inflation report going out 3 years in time. That ended up in discussions with journalists and the general public. The Riksbank is planning to raise rates in 2.5 years' time. And of course, we don't have a clue what we're going to do in 2.5 years' time. So that's more or less a projection slash assumption, what's going to happen in 2 years' time, right? So what we did with the fairly recently is we basically divided the interest rate path into short and long term. So long-term assumption just to show what our what kind of interest rate we have in our forecasting. The short term, which typically is less than a year, there we think we have some policy messaging in the interest rate path. And why do I talk about that? That's a way of coming away a little bit from the day-to-day data dependence, i.e., the latest CPI number, if you want, right? And to say, well, we are actually forecasting, we have some idea what we're heading. And that forces us also, I think, in the committee to discuss a little bit more longer term the inflation projections, because as you know, Professor, this monetary policy acts with a lag, right? So it would be ridiculous to act on data here on a daily basis. So having said that, you all know that forecasts go wrong. So if you only had a forecast and not really kind of considering the data that you get, that's also might lead to difficult or wrong decisions. I would say we are, of course, considering data. We are working a lot with models, but in the end, it's also a judgment call, right? But we try to communicate in a more forward, let's say, forward-leaning basis, not to be preoccupied by the recent data, but actually be able to say, and I think today's situation is a good example. We now have inflation, our target is running slightly above 3%, or not the target. The actual outcome is above 3%, the target is 2%. But we have a very, very clear forecast saying that inflation, due to some technical effect in the middle of next year, will go down to 1%. And excluding those, the VAT, cut of VAT effects is going down to the 2% target. That's a very strong conviction. Hence, we lowered rates as recently as in September. So I think that's a way of saying that if you compare to ECB, for example, we actually do talk about the forecast. We do have some kind of projections of our way forward, although being extremely humble and saying it's a super uncertain and it might change. But we dare to say something about the future. Hopefully that's partly an answer to your data-driven question. High and low inflation regimes, I think, also I think recent times, the good thing with a credible inflation target is that even when inflation goes up to clearly a high inflation regime, we don't need to react as aggressively because we have the inflation expectations anchored. And we saw that when inflation came up actually above 10%, still 5-year inflation expectations were at 2%. And more importantly, the wage negotiation agreements were about 3.8%, 3.9%. So, and of course, we talked to the trade unions and the employer organizations, and they said, well, we know that inflation is running at 10%, but when we go into the negotiations, we take the 2% inflation target as the baseline, and then, of course, adding potential productivity gains and ending up in a wage that is slightly around 4%. So I think the high and low inflation, I think if you have the credibility, you get the flexibility to handle that, I think, in a fairly good way. Well, the Ingvar Svensson kind of argument is kind of fascinating. I was not here then. I also read all the protocols at the time. They were longer than our protocols. I think, I will make this as a personal comment because I don't know if my board members have exactly the same view. But, I think a big change happened since, and that is that we now have a fairly credible macroprudential framework and actions. So in my previous role as heading up the Swedish Financial Stability Authority, I was extremely involved in setting amortization requirements, loan-to-value, loan-to-income requirements on borrowers, and also raising the countercyclical buffer to 2.5%. So we actually took a lot of actions when we saw the strong growth in private indebtedness. So in that sense, maybe, the Ingvar Svensson discussion would have looked a little bit differently now than then because we didn't have those messages. What I said in my speech where I guess I'm ending up maybe somewhere in between Ingves and Svensson here, to have the Svensson view that you should more or less you should be able to prove that it is a risk for financial stability. If you can't prove that, you can't kind of lean against the wind. I think, you know, to have a little bit more pragmatic view, I think is sensible, and hence, even if the inflation seemed to be ending up at 1.5% and you have a strong growth in credit, you have a decent economic development, maybe you could, again, lengthening a little bit the target horizon and be a little bit cautious. That would be my thinking. But so to totally exclude the possibility to involve risk of financial imbalances into the monetary policy setting, I think would be to go too far. But again, I think the main responsibility should be within the macroprudential framework and the tools that we have developed and probably need to develop further as we go along.
Thank you very much. Thank you very much for such encouraging and deep answers. Thank you.
Yeah, indeed, I would like to join this appreciation, and unfortunately we are running out of time, and well, but it was really a great pleasure and honor, Governor Thedéen and Erik, to have you with us today. So I suppose that all of us really enjoyed your lecture and this Q&A session, and thank you very much again, and looking forward to our next meetings.
Sergey, same to you, and my best to your Governor Prishny as well, and thank you very much for having me, and see you soon again.
And now let me pass the floor to Nathan Epstein from the International Monetary Fund, who will moderate the next policy panel. Nathan, please, the floor is yours.
Okay. Can you hear me okay? Excellent. Well, first of all, thank you, Sergey. This was an insightful lecture by Governor Thedéen. Certainly lots to think through about the messages. Some of these will surely come through this upcoming panel discussion. So first, good morning, good afternoon, I guess good evening to all of you joining us from around the world, and especially to those who are joining us from Kiev. My name is Nathan Epstein, and I'm joining you from the IMF Institute for Capacity Development in Washington, DC. Before we start with this important panel, let me take a moment to congratulate the National Bank of Ukraine and the government of Ukraine for reaching a staff-level agreement with the IMF on a new successor lending arrangement. As someone who was part of the IMF team that negotiated the previous program, I know very well how much work goes into achieving these SLAs, and so again, congratulations. Now turning to discussion, panel 2, entitled Policy Lessons and Challenges in Inflation Targeting. It is my pleasure to moderate this panel as part of this important annual workshop hosted by the NBU. This year's workshop, as mentioned, is especially meaningful as it marks the 10-year anniversary of inflation targeting in Ukraine, a milestone that highlights both the impressive progress made as well as the challenges still facing in adopting and sustaining this monetary policy regime. Over the past decade, emerging markets and Ukraine in particular have navigated an environment of profound uncertainty with successive shocks testing the resilience and adaptability of inflation targeting frameworks. In this session, we will reflect on the policy lessons learned from several decades of inflation targeting in emerging market countries. Among issues for consideration, we will discuss the practical challenges of preserving policy credibility, anchoring inflation expectations, adapting policy in the face of shocks, be they global or domestic. We will also consider the prospects for inflation targeting in a world characterized by heightened uncertainty shifting economic structures, and evolving policy tools. For this discussion, we are privileged to be joined by leading economists and policymakers. Our three distinguished panelists here bring together a wealth of experience, including in previous roles as central bank governors. And before I turn to them for the opening remarks, let me introduce them briefly in turn. Our first speaker is José de Gregorio, who is a full professor and dean of the School of Economics at Business at Universidad de Chile and a non-resident senior fellow at the Peterson Institute for International Economics. He brings a wealth of experience, having served as president of the Central Bank of Chile from 2007 to 2011, following roles as vice president and board member. He was also Chile's Minister of Economy, Mining and Energy, and is a prolific author, having published 4 books and over 100 articles on macroeconomics and international finance. Welcome. Our next panelist is going to be Dimitar Bogov, who is a regional lead economist for Eastern Europe at the EBRD. Mr. Bogov has over 25 years of senior experience across government, banking, and consultancy, including serving as governor of the National Bank of the Republic of Macedonia from 2011 to 2018. His expertise spans macroeconomic management, monetary policy, and banking regulation. And he also played key roles in international initiatives, including serving as the steering board member of Vienna Initiative 2. And last but certainly not least, our third speaker is Marco Schweb, who is an independent consultant with a distinguished career in academia, central banking, and international advisory roles. Mr. Schweb served as governor of the Croatian National Bank from 1996 to 2000. He was a recipient of the Central European Annual Award for Excellence as the best central bank governor, awarded by the Banker. And since his tenure as governor of the CNB, Mr. Schweb has consulted for the IMF and the World Bank and other organizations across Europe and Africa. And he has contributed to central bank reforms in numerous countries. He's also a prolific author on transition economies and monetary and exchange rate policy, especially in connection with financial sector issues. We are delighted to welcome all the 3 distinguished speakers. So with that, I encourage our panelists to share candid insights from their own experiences. Following the opening remarks, I invite everyone to participate, to actively engage, posing questions or sharing your own perspectives on which the panelists can respond. So thank you again, and I look forward to a stimulating and constructive discussion. And let me turn to Jose to start us off. Jose, over to you.
Thank you very much. I think that now you see what I have. Thanks very much. Thanks for the invitation. It is an honor and a pleasure to be here. And of course, I cannot start without expressing my solidarity to all people from Ukraine. And I hope next time we meet in Ukraine and not online in Kiev. So I'll talk about my main and pushing a little bit hard point will be 2 things in these introductory remarks. First, the world is quite resilient and emerging markets have been quite resilient, and an important factor is monetary policy. So I'll try to say that. So at the end, sort of one of my main lessons on this is that for the future, the first thing that we have to do is to keep doing what has been done quite successfully through the last 15 years. So let me show you. So I'll talk about the Great Depression compared with the global financial crisis. Then I'll mention about the Spanish flu and COVID-19, then more macro issues like financial integration and how this has affected the emerging market economies, the issues about liability dollarization and inflation. So these are 5 very quick things that I will mention. First, the Great Depression. It's quite interesting to see Dow Jones in the Great Depression and during the Great Recession. What we see is basically that at the beginning, day 0 until month 18, the evolution of stock prices was quite similar. And now what we see that there was a big divergence. So, but at the beginning, the size of the shock, especially a year after it started, was quite a year from October 2007. The Great Depression and the Great Recession were relatively similar. But what we see is that the output was quite different. Again, at the beginning, you see a contraction in output during the Great Depression and during the Great Recession. I have two lines for the Great Recession. The blue line is the same countries as the Great Depression. And the dashed line is expanded sample of world economy data from the WIO. Okay, and that's higher because it's China. China is not in the continuous line. So what we see at the beginning, similar evolution of output, a bit less in the global financial crisis, but we see a very rapid recovery. After 2 years, the economy was already recovered. So this is the same happened with the Spanish flu and COVID. With the death toll is very difficult to get data, but for the Spanish flu, death toll was between 50 and 100 million people, and during COVID-19 between 5 and 20 million, depending on how you measure, but was quite small in effect. The same happened with GDP growth during the Spanish flu, a decline of about 7% on world GDP. During COVID-19, just 3%. 3% with all what happened in terms of confinement around the world was quite successful. I always say that we were in lockdown 2, 3, 6 months, depending on the country, and output in the world economy just declined by 3%. What the other evidence that I think that is interesting, this is the case of Chile. You see, quite interesting, Chile in October 2019 had a very big social explosion. Then it came COVID. And what we see is that Chile, the red line, showed that the current account was in deficit and we should have been accumulating net international liabilities, or our net international investment position should have declined. But what's happened is that during this period, the net international investment position improved despite having a current account deficit. The reason is that there are wealth effects. And what are those wealth effects? Is that the world is long in Chilean stocks. So the stock market plummeted in Chile and in the US was going up, but the country was long in foreign stocks and short in domestic stocks. And the same happened with currencies. The country was short in pesos, so there was a sharp depreciation, and so the main thing, and there was like if you add, there was like a 20% transfer of GDP in terms of the net international investment position during during COVID and also the social explosion in Chile. So which means that the country, despite being very open financially, the country benefits from hedging. This is the same done for all emerging markets, for example, of emerging market. This is the financial weight. Between 1999 and 2006, the negative number means that a depreciation of the currency also deteriorates your financial account, your net international investment position. Why? Because you owe too many dollars. But when you are able for foreigners to hold your local bonds, what you have is that positive number. So a depreciation of the currency in emerging market after 2007, what we see is that a depreciation improves the net international investment position. Why? Because the foreigners hold a relevant fraction of domestic currency. This is another thing that I think that's quite important, and this happened in Latin America when currencies start to float. This was Argentina before the problems I had now. But after currencies float, what we saw is that the liability dollarization declined a lot. So one of the main reasons for not allowing the exchange rate to fluctuate was too much liability dollarization. What these figures show is that when you float, endogenously, liability dollarization declines. And finally, the inflation and COVID. This is absolutely abnormal in Latin America, we saw a sharp increase during COVID in 2021, 2022, a sharp increase in inflation. And for the first time, Latin America that has been used to have high inflation, this was the first experiment in which there was really an outburst of inflation around the world. In Chile and in all Latin America, inflation to 2-digit, and after a couple of years, inflation is returning to normal. And what central bankers did, subject to an inflation target, they start raising interest rate. And indeed, you have the gray line is the US. Latin American economies start raising interest rate about a year before the US start increasing interest rate. And it has been successful. There is one issue that I think that's important for central banks, and we can talk more about that, is that it has taken longer than expected or than announced to reach the target. In Chile, we have been 5 years out of the target. The idea was to restore inflation in 2 years. Inflation has declined, not still in target. So there is I think that the discussion or the horizon to reach the target, but I think that the disinflation has been quite successful, quite unusual, worldwide inflation and the right monetary policy. So let me just close saying resilience. Why there is resilience in the world? I think the world is quite resilient compared to 50 years ago, Latin America and emerging market. A strong macro policy. A strong macro policy is monetary policy with inflation targets, independent central banks, floating exchange rates, contracyclical fiscal policy, and a strong, well-regulated financial system. But there has been also a lot of technological development. We were able to go through COVID thanks to the smartphones, and there is globalization. Globalization, instead of making more vulnerable, it allowed the world to keep working, and the world is also richer and more careful about disaster. What are so the main lessons? And this is what I said to keep doing what we have been already doing. Excessive creativity may weaken the effectiveness and have costs for doing business. So keeping independent central banks, inflation targets, and flexible exchange rates are key, and there is a very important issue in securing financial stability. But I have to remind that except for emerging Europe, the rest of the emerging market economies, they have not had a crisis, and in particular a financial crisis, since the Asian crisis in 1997. Some countries in Europe during the global financial crisis, some emerging markets have problems mostly linked to the financial system and to a fixed exchange rate, but most of emerging markets, one could say, have been even more resilient than many advanced economies. It's important to secure financial stability, but already I think that the frameworks have been working very well. Risk, there are two risks that I want to mention from the macro point of view. First, interest rates. We will live in a world with somewhat higher interest rate, not huge interest rate. And this, of course, has a problem with public finance because after so many crises, the world is much more indebted and governments are much more indebted. And I think that there is another issue that we can talk more about it, is crypto in the financial system. And I think that that's also a risk for financial stability. If banks have excessive investment in crypto, we have seen what's going on now recently with crypto prices, and that's, of course, is a risk for the financial system. There is another issue that's very important, is money laundering and financing of terrorism, and all that also may be related to crypto, and we have to take care of that. Thank you very much.
Thank you very much, Jose. Insightful points, including important lessons learned from a central bank that has been on the early side of adopting inflation targeting. Thank you again. We're going to let Dimitar and Marco speak first before we're going to take some questions from everyone. So with that, let me turn the floor to Dimitar.
Thank you, Nathan. Thanks to National Bank of Ukraine for the invitation. It's a great honor to be here. And yes, NBU is doing a great job in very difficult situation. And actually, that could be a good lesson for the future, how inflation targeting could be flexible and could adjust to the circumstances. So let me share some observations from my experience. First, for many years being down to the on the pitch.
I think we might have lost Dimitar.
Inflation targeting in particular. It's a relatively new phenomenon, I would say. It exists 35 years, so drawing firm conclusions may be premature. However, some characteristics and benefits of the inflation targeting are clearly noticed, and certainly we could discuss them. So going first to the lessons that we could learn from these 35 years of inflation targeting, let's start with the fact that introduction of inflation targeting as a dominant monetary policy framework coincides with a long period of low inflation, which follows actually the inflationary troubles in the 70s and 80s. So bearing that in mind, it is tempting to associate such success with inflation targeting. However, the period since the beginning of 90s has been also a period of economic globalization that had positive impact on prices. At that period, producers from Central European countries were integrated into the European supply chains, and Asians, Chinese producers in the first place, entered global supply chains. So all that had a very positive impact on prices. When global pandemic temporarily disrupted these efficient global supply chains, inflation soared. And most likely pandemic fiscal and monetary stimulus also added some fuel, bearing in mind that inflation levels not seen for almost 40 years in developed economies and since the early 90s in most of the transition economies. Many developed and emerging economies are still struggling to return to the pre-pandemic average inflation. The current trend of supply chains fragmentation, also nearshoring, we hear friendshoring terms, plus tariff policies from this year, they may add pressure on inflation in the period ahead. So it will be interesting to see how inflation targeting will work in such an environment, which is much more complicated than one that we had before the pandemic. The acceptance of inflation targeting was going in parallel with rising independence of central banks. And that is not surprising because if you give central banks an explicit task to maintain low inflation, they have to be independent in the choice and timing of their policies. We have seen the same in Ukraine, where actually the transformation of NBU into a modern, independent and professional central bank went hand in hand with introduction of inflation targeting. As economists closely involved with monitoring and analyzing economies of Ukraine, Moldova, Caucasus, and Western Balkans, I noticed similar processes in other countries of these regions. So independence actually increased substantially in the last 15 years in these regions, and that coincides with inflation targeting. But if, let's say, we cannot draw firm conclusion about the association with low inflation, here we could certainly do, because as I mentioned, inflation targeting goes hand in hand with bigger independence of the central banks. Therefore, one can argue that the introduction of inflation targeted have supported independence of the central banks. The same goes for transparency and communication, which are important elements for a successful inflation targeting. And we heard already from many of the previous speakers talking about communication, transparency, which really flourished under the inflation targeting monetary policy framework. You have to be open with economic agents and develop skills to clearly communicate your goals and policies to the public. Another important ingredients are flexibility and adaptability. It was also mentioned in previous discussions, and I agree. There are another observed features of inflation targeting framework, which has proven to be adaptable to various economic conditions, succeeding in different national contexts. Looking at the economies of Eastern Europe, Caucasus, and Western Balkans, inflation targeting flexibility is crucial for those prone to frequent shocks and high volatility in balance of payments. Shocks are very common in these countries, and having a possibility to leave it to the exchange rate to absorb the pressure is quite helpful. However, they don't have the same luxury to disregard the exchange rate movement as the major developed economies have, and they do care about the excessive depreciation. One reason is that they're small and open economies with foreign trade share in GDP between 70 and 140%. And that causes high pass-through effect from exchange rate movement to inflation. Taking care about the exchange rate actually helps in achieving the inflation target. Another reason for the same is high dollarization or euroization, depending which currency is the main benchmark in which country. So this does not allow for complete indifference in regards to the exchange rate level. Excessive depreciation could deteriorate economic agents' balance sheets and pose threat to financial stability. So in general, inflation targeting helped in building central banks' credibility. They're perceived by the public, and I'm talking mostly for the countries and regions that I mentioned earlier, which I monitor on a regular basis, as reliable and professional institutions. So the trust built during a long period of low inflation will be certainly helpful asset in dealing with the challenges ahead. And those are quite formidable, I would say. We heard some of that from the previous speakers, but let me try to draw some of them here. So they have to central banks actually have to respond to more supply side shocks, geopolitical events, climate change, trade fragmentation. And central banks must determine if a shock is temporary, something to be looked through, or permanent, requiring a policy response. And that should be done in real time, which is a difficult task, as colleagues in the panel know. We are entering into a period of fiscal dominance, and that is a new environment for central bank with inflation targeting monetary policy framework. The massive public debt accumulated since the global financial crisis and the pandemic creates a risk of fiscal dominance, where pressure grows on the central bank to keep interest rates low, to manage the government's debt burden, potentially conflicting with the inflation target. Major central banks have increased their balance sheets a few-fold in the past 15 years. It was painless to do quantitative easing in a deflationary environment. Quantitative tightening, on the other hand, appeared to be challenging in an environment of high public debts and large fiscal deficits. Several early attempts that we already have seen caused market tensions. So can central banks end up with permanently inflated balance sheets? Apology. And what would mean for their independence in framing the monetary policy if they end up with such inflated balance sheets for a long time? So inflation is still above medium-term targets in many inflation targeting economies, a fourth year in a row. So it's a long period. Its reduction proved to be a challenging task also due to geopolitical challenges and fiscal deficits. The prolonged period of overshooting inflation target may hurt credibility of central banks. The challenge is to bring inflation back to target and re-anchor expectations without causing an excessive economic slowdown. And such task is even more difficult, bearing in mind the current structural economic shifts that we mentioned, like aging population, deglobalization, green transition. So they add new uncertainties to inflation dynamics and complicate the whole situation, the forecasting frameworks central banks rely on. So quite challenging tasks, and I don't know if the colleagues would agree, but maybe it's tempting to be down on the pitch and really deal with all these new challenges, but it's much safer to be on the sideline and just look at these developments. Thank you. I will stop here.
Great. Thank you, Dimitar, for this insightful set of comments and observations, including on the challenges that indeed many IT regimes face in the context of overshooting the target for a prolonged period. Let me turn to Marco before we open the floor for questions. Marco, over to you.
Thank you. Can you hear me well? Okay, great. First of all, I'm very proud and happy to be here. Let me use this opportunity, 30 seconds, to welcome and say hello to all my Ukrainian friends at the National Bank of Ukraine. I congratulate you on the 10 years of introducing inflation targeting. Actually, I was sitting at the National Bank of Ukraine in the 2015 when the first efforts were done. So it is wonderful to see the friends, how successful you became in an extremely difficult environment. In our discussion previously with Nathan, I understand that he is quite a tough moderator, so I have noted my time and will keep it within the 10 minutes. The good thing is that after basically all day, and I have been listening to almost all the contributions, there is not much to be added to what has already been said. So I will try from my notes that I prepared to extrapolate some of the things which could be controversial, could be a little bit provoke discussion. It's already afternoon, I guess. The 56 people that still listen to us may be a little bit tired. So I will focus my notes on 3 topics. The first is continued relevance, but as I put it here, not universality of inflation targeting regime. Second one will be focusing on communication, its importance, especially preconditions for inflation targeting. And the third one, which has been mentioned by Jose and some others, is that structural change in finance due to digitalization and technological changes in the financial sector. So let me first start with the relevance of IT. As Claudio Borio, who recently departed from the BIS, in his nice paper, which is entitled "With Her Inflation Targeting as a Global Monetary Policy Regime," put it, and let me quote him: "IT achieved what it was designed to achieve, an era of price stability. This is no small achievement." End of quote. And I think this whole conference has shown exactly that point. However, when I did a little bit of my own, I wouldn't call it research, what I find is interesting that IT is definitely the most popular regime, monetary regime that we talk about. It's a future. Even when I go to emerging central banks, sometimes they apologize and say, oh, you know, we would like so much to be an inflation targeting regime. In a way, when we grow up, we will be an IT regime, as this is something that every central bank should achieve in its lifetime whenever they're ready. But if you look at statistics, according to some sources, there are 220 roughly central banks in the world. Difficult to find the exact number. Only about 40 of them are actually inflation targeting. And you can see that even banks that do not have inflation targeting regime can be very successful in achieving price stability, and this is their main mandate. So my first point is, it is a good regime, but not necessarily universal for all the countries and of all the time. As a counter argument, I would just remind the audience that there are a couple of countries that introduced inflation targeting but failed. First case is they changed a lot of regime, Argentina. I mean, pun is intended. As we know, it takes two to tango, and definitely with the fiscal issues in Argentina, it was difficult to maintain. But certainly, if you look at Zambia, if you look at Suriname, Turkey, which is mostly political, and I would like to emphasize one country which, again, accidentally, I was working there when they introduced IT, and this is Ghana. Ghana did it and had a major fiscal problem. They tried a couple of times. So my point here is inflation targeting, and it was repeated without preconditions, without strong institution, and especially without, and this is the second point of my remarks, preconditions, it will not automatically deliver results. So the point, I know mostly probably people from Ukraine don't need to hear that, but in emerging economies, you have to be careful. It is not a panacea for all time and all regimes. When it comes to fiscal stance, I like to quote one of the former governors of Bank of England, Sir Mervyn King, who once said, central bankers are, and I quote from memory, central bankers are often accused to be obsessed with inflation. This is completely wrong. We are obsessed with fiscal policy. And I think he is right, because if fiscal is not in order, and Dimitar has nicely put it that we live in an era of increasing fiscal dominance and public debt, that should be very carefully monitored. So with this in mind, I will move to my second topic, and this is the importance of communication. Again, in trying to wake up the audience and to be provocative, maybe because we come from the same region, but I have to, again, agree with Dimitar when he said what has happened in the past with stable prices has not only been the result of great central bankers and inflation targeting. Price stability period, central bankers were very, very, how can I say, clear in saying we are doing a great job. The price stability is because we run great monetary policies. There were a lot of globalization efforts. Some people would put it as it is basically Chinese labor force through their exports that added to these deflationary tendencies, and that contributed to it. Why is it a problem? I believe in symmetry in communication with public. So it is a little bit tricky, to put it mildly, if when prices are stable, you say this is exactly because we did the great job. But when you have supply shocks, and we heard from Martin's previous panel, how central banks are not very good with supply shocks, that you say, oh, this is not our fault, there is nothing we can do about it. I'm not sure it works that way for the public. Economists may say, yes, this is temporary, there is nothing central bank should do, but if you take all the credit when prices are stable, you cannot blame the others if prices are not stable, if inflation goes up. It boils down to what I think Swedish governor mentioned, and this is about communication, my point. We need to be humble about communicating, honest and humble. Do not oversell issues. I mean, be proud of what you have done. And I think it's great what National Bank of Ukraine is doing and other central banks. However, there is a need to be transparent and humble, because as I say, once you are hit with a supply shock, in my view, this is a rather pure excuse to say, we cannot do it, this is temporary. In my view, and I can be quite open with you, I think that the ECB made a big mistake initially, even the chief economist, when they started saying this was a temporary inflation, we don't have to do anything. And then it turns out they had to do something, and they lost credibility. There are even Eurobarometer indicators which show that because of that mistake, they lost credibility. They are regaining it, certainly not to the level that it was before. So be humble, be balanced, and be realistic. That's, I think, very important. When I think about communication policy, I agree with governor, of course, the need for transparency. However, and I will not quote, but which countries, what I have seen in some of the smaller countries in the region, Dimitar may identify them, but I will not mention them. I'm not talking about Macedonia, definitely. There is an oversold of the presence. If you look at the LinkedIn account of those governors, probably every day there are 3 to 5 announcements. Anything that they do, they see the ambassador, they go to the seaside, whatever they like. I think the word is influencers. So there is central banks, especially emerging ones, should be very careful how much they produce, especially on social media, and do things of relevance. Not everything is relevant for the audience. Finally, my third point, and I hope to finish it in 2 minutes so that Nathan will be happy, is that, as has been said, we live in a different and a new world. By this new world, I mean definitely the question of digitalization and non-bank financial institutions. Only at the last annual meetings, IMF, MCM announced, I think there were 2 or 3 blogs, that non-bank financial institutions, for the first time in history, are larger in the world than banking sector. What does it mean for central banks? That means that a lot of financial transactions are first not regulated by them. Second, there are not enough information. When I talk to people, they tell me, well, but if they fail, nothing happens. Well, we are not so sure about the linkages between banks, financial stability, and non-bank financial institutions, especially when it comes to questions, and it has been mentioned already, question of not just crypto assets like Bitcoin, which of course is a speculative asset, but stablecoin, which are growing rapidly, which are increasing dollarization. By the way, I think stablecoins after the Genius Act will be the biggest dollarization of the world economy, bigger than any trade so far. We have just seen the beginning of it, but let's talk next year if I'm right on that or not. So finally, central bank will operate, and I won't go into the detail, we can discuss it, in a different environment. Part of I would even say that there is a trend to debankization. So you go to peer-to-peer exchange, venture capital issues which are not regulated by central bank. Some central bankers I spoke to told me, no, it's not decreasing our strength of the transmission mechanism. If it's not now, I suspect it may relatively soon. And my last sentence will be from I will quote an old article from 1999, Jeffrey Frankel, who published an article in Stanford Annals of Finance, and he said, no single currency regime is right for all countries or at all times. I'm not saying we should ditch inflation targeting, but let me go back to the initial presentation, which I liked, by Governor Pishney, who said, and in the case of Ukraine, this is quite clear, we need to be flexible, and let me quote him, if I got it right, flexibility is the sign of maturity. So thank you so much, and let's discuss.
Excellent. Thank you, Marco, including for keeping to time, although I'm always happy to hear more from you and of course from others. So again, thank you all three for insightful set of comments. I think there's certainly evident that there are a range of issues to consider. Of course, I think from a backward-looking standpoint, I mean, one can point to the success of IT inflation targeting regimes. But of course, it's always not a clean slate, and there are challenges. And certainly what you all have conveyed here is that in a sense, the challenges are sort of dominant, more so than the successes, perhaps. And as we look ahead to a future that is perhaps more uncertain, not that we had certainty before, but certainly maybe more uncertain than before. with more recurrent successive shocks, sometimes difficult to ascertain the temporary versus permanent nature of these shocks, as you alluded to. It behooves central banks to be creative and as you know, to echo Marco, or for that matter to echo Governor Pishney, flexibility may indeed be a key modus operandi here. And so with that, let me I'm going to open the floor to questions. You can ask question is by raising your digital hand, or I guess you can also put it in the Q&A box. But let me maybe a kickstart a question to all three of you, and perhaps taking advantage of that excellent question that Sergei posed to Governor Thedéen. You all were governors, and you all in some capacity continue to advise and consult. What would you consider in terms of a fundamental sort of reform that central banks can take in adopting inflation targeting, but for that matter, maybe any monetary policy regime, especially in the context of where we are today? Fiscal dominance, as you mentioned, the evolution of crypto. I think your point, Marco, about what the IMF has, the study that came out about the size of the non-financial banking sector that is obviously less regulated. I mean, all these issues are paramount, and maybe in that context, what would you consider as sort of a key reform that central bank can take in this context? Maybe starting in reverse order to you, Marco.
Okay, I couldn't find the unmute button. Yeah, thank you for that question. I think this is a great question. And in my view, the biggest reform that banks should do is look inside. By looking inside, I mean they should try to build a strong analytical and professional institution. Regardless of the monetary regime, even if it's a pegged regime, if it's a currency board, if it's a monetary union, and especially if it is an inflation targeting regime, I think you need strong analytical capacities. Strong analytical capacities meaning understanding the economy, understanding changes in the economy in terms of digitalization, things like that. So that would be, in my view, priority number one. And priority number two would be to work on a nice communication strategy, because communication is relevant. There are a lot of things to do, but if you ask me to put 1.5, that would definitely be strong. It doesn't mean just having econometric models. It means having good statistics. It means publishing those statistics, and first and foremost, understanding in depth what is going on in your economy. So I'll stop there.
Okay, great. Thank you. Dimitar?
Yes, I would here agree with what Marco said before, and I think that is very, very indicative and very important element, and that is being humble in terms of not being complacent with the environment. Something like what happened after the pandemic, and Marco described the whole situation. If central banks were more humble at that time, I think they would react earlier, and maybe inflation would not be so persistent to these days as it is. And I would add to that, I liked the discussion in one of the previous panels, and I think Armen from Armenia was talking, being open for changes, not being slave to the framework, but be open-minded and always try to improve the monetary policy framework. So inflation targeting, yes, it is a general framework, but it offers flexibility, as all were talking, and adaptability. So you have to see what is working, what not so well in your environment, in your circumstances, because every country is a case of itself. And how they did it in Armenia, it's really a good example how to evolve to the further level of inflation targeting. They still have inflation targeting, but improved framework, adjusted to their circumstances.
Great, thanks, Dimitar. Jose.
Well, let me, as I understand, today there is a different world, and you're thinking about how to adopt monetary policy regime in the context that we are right now. I don't think that I think that there are new challenges. There is an issue, and you mentioned there is an issue of crypto. I don't think that is a big threat to the monetary system. There may be some spin-off and discussion about the control of monetary policy and discussion about the stable coins. I'm not so sure still. I don't think that is a threat. I think that much more on the side of the rule of law and combating money laundering. And there is an interesting issue you raise, and I think that this is interesting for central banks, and we have to think, I would say, more. It's about and how this collides the fiscal dominance. The idea of fiscal dominance, to put it simply, saying that inflation is determined by the fiscal stance and not by monetary policy. Why? Because price level needs to help to pay government liabilities. That's just a simple way to put it. So now the issue is there is a truly fiscal dominance, or we have had episodes, and so or is an issue that may come and go, but it's not that we live in a world like, for example, Latin America. Historically, there was just fiscal dominance because the central bank was financing the budget. There is an issue about that the inflation outburst that we had was related to fiscal dominance. Why? The answer is the story. My interpretation is very simple. It's basically there was a lot of public debt, there was a lot of fiscal deficit, and inflation helped to pay the bill. But that doesn't mean that there is a permanent fiscal dominance, because then central banks could control inflation, and they are controlling inflation. So I think that that's kind of the scenario that we may live in the future. It's not the old story of money printing central banks, but somewhat related to issues that during some periods, and especially in after we accumulate debt, global financial crisis, then COVID. So at some point, there may be some frictions and difficulties for central bank, but I wouldn't call it like a permanent phenomenon.
Great, thank you. Yeah, indeed. I think it is fair to say that, and I think this is what I'm reading from your response, Jose, is that maybe a little bit more sanguine than others. That indeed, I mean, while these challenges are sort of dominant, obviously these recurring shocks in recent years are very much at play. One can also be feeling okay about the sustainability of these regimes in many countries, right? I mean, so there are obviously variations, but it's not that, or maybe I should say, it is very much the case that the lessons learned from 25 plus years of implementing inflation targeting really helped many emerging market central banks to withstand these shocks in a way that maybe 20 years ago, were we to forecast these sort of shock, that we would be much more concerned about the ability to withstand these shocks. So I think these are important points, and I think it's sort of helpful also to sort of maybe think of it in a more balanced way. So thank you again. Okay, so we have some question. Maxime, your hand is up.
All right, thank you. Thanks to all panelists for such a wonderful discussion and really stimulating. I'll have a lot of things to think about after it. My question is connected to the geopolitical risk and what role of geopolitical risk is for the monetary policy. Because like since 2022, there's been I think we've entered the era of a large geopolitical fragmentation. So the question is, what should be the role of geopolitical factor in the decision making for the central banks? Like for monetary policy, should we just treat it as an external shock, or should it become a more central part, like a core component of monetary policy? And would you consider it just to consider it as a supply shock, or maybe some, a more significant change in the structural policy framework? That's the question to all panelists.
Okay, great question, Maxime. I'm going to let my panelists, who wants to go first?
I can go first. It's interesting because there is always a new thing. For example, say, well, there is a crypto. Should central bank change the framework? I think that the framework is okay. And geopolitical issues are quite important in the global economy today. How we organize, how we trade, how we keep peace. So there are so many issues, geopolitical control, hegemony of one country, other. There are many issues. But perhaps you put it the best way. From the point of view of monetary policy of single country, especially countries that are not systemic. So Chile is a country, not perhaps the US, but even for the US, I would say at the end it's sort of a supply shock, and it's a shock that just a supply is sort of change. It could change the production function. That would be, I think that is, it could change the price of inputs and the way to produce, but there is no an special role for monetary policy in this geopolitics. There is one thing that we may think a little bit more, but again, I don't like. Let me just tell you, my frame general is, this is, I joke as a former central banker to current central bankers. Our role, it seems to be that every time that we talk, we mention some risk. There's always a risk. You will never hear a central banker saying there is no risk. I would say there are a lot of risks, but we know how to handle them. But always there is a tariff from Trump, whatever, and there are always a risk. The world is risky. That's kind of the phrase of a central banker, just to start. It's a default phrase. So when it says that from the central bank point of view, we know how to manage, there are things that perhaps make us think a little bit more. And in the geopolitics, I think that one issue that is being discussed is the financial relationships as part of this geopolitical reorganization. And whether capital flows or investment are also somewhat related to geopolitical factors. Well, it's a shock to capital flows. It is not the size at which it will derail the global economy. So I think that geopolitics is quite important. However, I do not think that is big enough to change central banking. There are risks, and we should take care of the risk.
Okay, great.
Okay, I can follow up. Yeah, basically, because I agree mostly with Jose that first of all, of course, there should not be change in monetary policy regime. However, it can be very dangerous if you ignore geopolitical risks. What I think should be the way I would look at it, I'm just on top of my head, is to speak to people, analytical people, how do geopolitical risk affect the macroeconomic conditions in a country? How do they affect the forecast? So are they going to affect trade flows, imports, exports, supply chains? If a country like my country, depending on tourism, are tourism going to come? So geopolitical risk, in my view, directly affect macroeconomic and micro, but macroeconomic conditions. And then you have to maybe respond in a different way. So keep in mind, how does it affect your macroeconomic conditions? That would be my shortest answer.
Yeah, if I can add here, geopolitical risks are external shock, and certainly central banks cannot have any impact on it. But central banks have to be aware of these developments, of these changes. And I agree that monetary policy the framework is there. It cannot be changed. But certainly environment is changing because these geopolitical risks, fragmentations, trade fragmentations, trade tariffs are changing the environment. And now central banks have to bear this in mind. They have to analyze. They have to find what are the consequences of these changes. First on economic aggregates, and then on monetary policy. If let's say the previous period, 90s, beginning of 2000, we had positive impact from geopolitical developments, and maybe therefore they had, let's say, negative impact on inflation. So the other factors could have even higher, and still we could have reasonable inflation. Now, from geopolitical factors, we have already some level of inflation that we have to take into account. So now the question is, can the monetary policy influence the other factors that affect inflation, and just to compress inflation down, or maybe we should take as a given that the situation has changed, and maybe the inflation target cannot be 2% like it was in the past. But it's a delicate issue. It has to be analyzed. It has to be decided what is the best response to it, whether to try to influence or just to adjust and maybe to raise inflation target to a more acceptable level that would not press central banks to affect economic output, and in order to keep inflation at a level that is already inflated by these geopolitical developments.
Maxime, have your question been answered?
Yes. Thank you very much for your inputs. I was just wondering whether it should be part of the forecast, meaning that if we forecast some geopolitical risk, should monetary policy do some preparation in advance of it? But you've all basically answered that question within your responses. Thank you.
Great. Let's see if I don't know if I see that Alexander Farina, please.
Yes, thank you very much, and thank you very much for sharing your experience. I have a question for all of the panelists. So you have all served as central bank governors, and it's really a privilege to learn from such a unique range of perspectives. So my question will be a little bit related to the previous one, but it also relates to a topic we discussed earlier this year at the National Bank of Ukraine during our annual research conference on economic and financial integration. So over the past decade, we have seen a rapid integration both in trade and in financial markets. And some of you, like Dimitar or Marco, may have related to EU integration process, and Ukraine is now moving rapidly in this direction as well. So, but now we see global fragmentation. So my question would be like that. So do you see that economic and financial fragmentation primarily as a constraint or as a support for monetary policy, both in the past and in the future? And if so, do you think, what do you see the main benefits or the main risks of this fragmentation for central banks?
Excellent question. Certainly one that the IMF has been contending in the recent period. Who wants to take this first?
The IMF. We should know what they want.
The IMF is doing its job in moderating this panel. We have certainly said quite a bit about these issues, but I certainly want to hear from you and your own experiences as governors, but also in other roles. Maybe starting with our European colleagues, Dimitar or Marco.
Yeah. Maybe I will start because I'm monitoring also Ukrainian economy on a regular basis, and euro integration, as Alexander mentioned, is quite important for Ukraine. So here we have a combination of factors. This geopolitical fragmentation would probably have some negative impact on inflation level, and we have to bear that in mind. So if, let's say, in the past geopolitical factors had -1, now they have +1. So in order to reach inflation target, now you have less space for other domestic factors. But in the same time, the situation is specific for every country. Ukraine is going to EU integration path. And this geopolitical fragmentation would mean that Ukraine would be now a reliable partner of European Union. So it would be part of this nearshoring developments. Ukraine would integrate into European supply chains. So from this point of view, Ukrainian economy could benefit. And certainly this benefit would be on economic growth, on employment, and all this might have some impact on prices, because entering the EU market, I guess for Ukraine would mean that Ukraine could have more competitive prices than EU, so will be more competitive on the EU market. But on the other hand, EU products would flow to Ukrainian market, and maybe bigger competition would push prices to, let's say, lower level. So maybe this would compensate to some extent negative implications from geopolitical fragmentation. I mean, this is just a thought exercise. Certainly you have better tools in NBU models to run all these assumptions and to see what could be the general balance of all these factors.
Marco.
Oh, yeah. Okay, I always forget where my mute button is, or unmute. First of all, I'm probably not the right person to talk to, because I'm all for integration, both EU integration, including Eurozone. Croatia joined EU 2013, and 2 years ago we joined the Eurozone, and I personally can see a lot of benefits. I wanted to ask the Swedish governor, but others were, how come they don't join the Eurozone? Because I know they had referendum and political reasons, because they're relatively small open economies. So thank you, Alexander, for your question. I think that geopolitical risk and fragmentation can create problems for monetary policy. And especially for Ukraine, yes, it's not just milk and honey. When you join EU, there are a lot of things. For example, especially with the euro, people in Croatia complained about inflation, that inflation was created by joining. Now, if you follow, this is happening in Bulgaria. As you know, Bulgaria will join in a month. And I'm sure Dimitar, to the neighboring country, can follow what's going on there. However, the benefits, now I'm first talking to EU, of the transfers of funds are very significant for Croatia. So they compensate for FDIs and so on, which helps the economy grow faster. But having the umbrella and I would say all the safety nets from the Eurozone are extremely helpful for banks, including supervision. In spite of what people say, people at the Croatian National Bank are much more busier now when they are members of the Eurozone than they were before. They travel, they exchange views. There are a lot of benefits. So I know in your case it depends a lot on politics. Let's not go there. But if you ask me, I would be all for, as soon as possible, integrating of the Ukrainian economy, both in terms of EU and the Eurozone as well. I'm referring to Sweden now. Thank you.
Right, that was certainly more about integration, less about fragmentation, but good points indeed. Jose, please.
Yeah, no, I think that is a quite interesting, and I realize hearing you that there is a very big difference when you talk from Europe and when you talk from Latin America, because you are living a process of political, economic, financial fragmentation quite important, and that of course have implications not just on the economy, but also on monetary policy and reorganization of things. And I see an economic problem. Rather, I skip a little bit from central banks, but the big issue and it may be the big problem with fragmentation is that increases vulnerability, because basically makes you relate to less actors, and so I think that the big problem is with fragmentation that goes beyond what we can talk about central banks. I think it's much more economic and abilities economy to hedge and to move around the world, but with the fragmentation, what we're seeing a little bit on trade, I don't think that financially will be too big, but this is with a little bit of ignorance coming from a region and a place in which fragmentation, despite many things that may be going on, all the threats about the closed US or tariff, we haven't seen really a fragmentation here, but I understand that this is quite an important economic issue in Europe.
Okay,
Thank
great.
you very much for your answers.
Thank you, Alexander, for the excellent question. Let's see. I am not seeing any additional hands. I think we have time maybe just for one more question. So maybe I'll just take the opportunity to ask you that question. This is going back to exchange rates. Well, I'm not saying going back, but this is where I want to hear your views. I think it's been quite clear from your interventions, but also from the discussion earlier today, how important flexible exchange rates to supporting the implementation of inflation targeting frameworks. And so in that context, what do you make of the prevalence of intermediate exchange rate regimes among many emerging markets countries, and in part, in certain cases, even to the point that while not stated, maybe it is perceived the exchange rate as a nominal anchor. What do you make of that, given obviously the pursuit of IT and the importance of flexibility in the context of successfully implementing those frameworks?
Just let me make one point. If you look at the emerging market crisis over the last 50 years, I don't have the table here, but it's, most of them have been created with anomalies in the exchange rate market.
Right.
So when governments tend to fix or to manage too much the exchange rate, because this is a flexibility. In Chile, we have flexibility, but in the last 20 years, there have been 3 or 4 periods of intervention. An intervention when there is COVID, the global financial. So there is some providing liquidity. It's just basically to making sure that the market does not lose the anchor. It's not much than that. So, but if you see the crisis in Latin America, Mexico 1994, the Asian crisis, always linked to rigidity. And why the rigidity? Because the rigidity basically creates and makes you it's like a trap. You becomes each time as you go on, it's more difficult to allow flexibility. Why? Because when you start managing the exchange rate, firms take care less about about mismatches, and because at the end the government will be there. Prices becomes more dependent on movements of exchange rate. Pass-through are smaller in economies that are flexible. So at the end, you kind of get trapped and you don't want to float. And what do? Increase the interest rate and create a recession in order to control the exchange rate, roughly. I'm looking very simple dynamics. And we have a close country that may be going that. And this is a problem, in my view, with Argentina. Argentina, which has done a tremendous fiscal adjustment, is a country that's can graduate from huge fiscal imbalances. Today, the problem is the exchange rate, that they don't allow to float, that they don't want to float because it will bring inflation, and people that do not want inflation. Fortunately, Argentina has no financial imbalances. But so at the end, I think that being pragmatic in terms of the exchange rate, from time to time, if there is an emergency, to intervene, trying to manage the exchange rate is not that effective. And at the end, flexibility, despite all the uncertainty that can introduce the economy, economies work well, and exchange rate flexibility has shown to be extremely important as a shock absorber in emerging markets. We saw it during the global financial crisis, huge depreciations and no collapse. We saw it during COVID. We see it from time to time, and the economies can accommodate. So I think that the one kind of a big thing for central bankers is to get rid of fear of inflation or fear of flexibility.
Okay, thank you, Jose. Marco?
Well, I would qualify that in a way. Just I know it's late, so we cannot open the discussion. And my in terms of flexibility, I would say it depends. Let me start with my own country, which is a small open economy. We, due to history of extremely high inflation in the former regime Yugoslavia, were highly euroized, what Dimitar mentioned. 90% of financial assets were euroized. Basically, local currency, in spite of some great governors that run the country, never really had functions of money. So we couldn't afford to have large flexibility, large external debt, domestic debt indexed, and I'm sure there are countries which are linked to the dollar. In the 90s, it's interesting that you raised that, Nathan. That was those questions were very, if I remember well, in the 90s, when the terms like fear of floating or floating with a life vest, or should we just in theory be either free float or complete peg, just the extreme working out. I'm all for country-specific flexibility, and I will end with the old saying of, apparently it was addressed to Yogi Berra, and he said something like, in theory, there is no difference between theory and practice, but in practice there is. So don't listen too much to theory, do what's best for your country. Thank you.
All right. Fair quote and observation. Thank you. Dimitar, last words from you for a close?
Yes, maybe because we come from the same region with similar experience with Marco, I tend to agree with him. And I would just add that it depends of the circumstances. If the country has large capital flows, then certainly fixed exchange rate is not on the table. But if it doesn't, then the difference between inflation targeting and some kind of managed float is blurred. For example, in our case, we had nominally managed exchange rate. We had a very narrow band in which we allowed exchange rate to fluctuate, but we never communicated to the public this band. On the other hand, at the same time, we had communication of our 2% inflation as a target. Although we didn't have inflation targeting regime nominally, because we tended to have the same inflation like EU to which we pegged our currency. And yes, I agree. When you have capital flows, then you have to have flexibility of exchange rate because you cannot sustain the pressure. But after you depreciate the currency, then again you come to the same. You have to deal with monetary policy instruments in order to prevent pass-through to the inflation. So maybe the instruments are differing a bit. At the end, you come to the same. You have to manage inflation. And if you allow free depreciation, large depreciation in countries in our region, which I talk about, I don't talk about some other, but our region where capital flows are not so frequent, then I think difference is blurred, and it's important to have good institutional capacity and to stick to low inflation target, but how you will achieve it depends on the circumstances.
Okay, great. Okay, thank you, Dimitar. Thank you to all of our distinguished speakers, and thank you for taking the time to participate in this important panel discussion as part of this very important workshop. We have come to the end of our session, and I want to also thank those who participated in asking questions. I see that Mr. Susneiger is video camera is on. I don't know
So the participants can just have a very small break before the lecture, it would be great.
Great. Thank you.
Dear participants, we are ready to proceed with the next item of our program. It is a great pleasure to welcome Professor Federico Sturzenegger as our distinguished lecturer today. Professor Sturzenegger currently serves as Minister of Deregulation and State Transformation of Argentina, but he also teaches at several universities, and previously he served as a governor of the Central Bank of Argentina. So therefore, he brings a rare combination of this academic excellence and high-level public policy experience, spanning both from central banking to government institutions. So, Professor Sturzenegger, buenos dias. We are very grateful that you accept our invitation, and we very much look forward to your insights on monetary policy and institutions in these challenging times.
Okay, thank you. Thank you so much, Alexander. It's a real pleasure. I think it's the second time that I speak in this forum. I think I mentioned the first time that I spoke that in 1991, I don't know if you had been born by then or not, I worked with Viktor Yushchenko when he was governor of the central bank at the central bank in Ukraine, correct? So it was the moment of the transition from socialism to a market economy. So I think that was a very interesting experience. And also, I'm always struck about the similarities between Argentina and Ukraine and the way people think, the way people approach problems. And actually, your flag could be our flag because we also have wheat and sky. Okay, so I think there are a lot of connections, even though perhaps geographically we're a little bit far apart. Okay. So what I want to do today is I'm going to talk a little bit about the fiscal and monetary policy because this is a conference at the National Bank. But I'm going to give you, if you allow me, kind of a broader perspective of what's happening with the Milei administration, which I think has already captured quite a bit of attention around the world. So I want to give you a little bit what are the main themes of this organization. I think also has interesting implications for many countries, including Ukraine. I mean, if you take Argentina at the end of the 1960s was a country which was richer than Spain. And it set up at that moment a kind of a organization of its economic structure, which was very corporatist. I mean, it was the government was kind of granting privileges to different sectors of the economy, and that's somehow stalled economic growth. And today, our income per capita is only 1/3 that of Spain. So really, it has been a very dismal performance over the last, say, 50 years in Argentina. And sometimes I see a parallel, for example, when you compare Ukraine and Poland, no? It's kind of two countries which at some point they were at the same level of income, and then Argentina lags relative to Spain, Ukraine lags relative to Poland, no? And in fact, in the 10 years before the Milei administration came to power at the end of 2023, by the way, in the Milei inauguration, President Zelensky came to Argentina. 2 million Argentines had left. Okay, and here is not Argentines that are leaving because we have a war or any other upheaval. They were just leaving because the economic perspective of the countries were so dismal. No, so I think at the end of 2023, Argentines realized something had to change, and what had to change had to be pretty dramatic, and I think that's why they voted someone who was so much an outsider as was Javier Milei. And I would say that Javier Milei his government has 5 main themes. And the first one has to do with fiscal policy, and of course the combination between fiscal and monetary policy. He has a very simple fiscal rule, which is to have a surplus. So no sophisticated kind of structural cycle-adjusted equilibrium. It's just always a surplus, because Argentina comes from a history of fiscal excesses, and therefore he says we need to change this in a very dramatic and clear way. And the other thing, I'm gonna do a double click on this in just a minute, is that this fiscal surplus was going to be attained through a reduction in government expenditure, and not at all through an increase in taxation. So we have a metaphor for that, which is the chainsaw on government expenditure. You can see here if you look at my image, you can see that I wear my chainsaw pin. I don't know if you can see that. So we proudly wear a chainsaw as a pin here, and we're in the Ministry of Deregulation and State Reform. So we're kind of the ministry which kind of wields the chainsaw here in Argentina. So I'll talk a little bit about that and how I think what Milei has done in fiscal policy reframes a little bit the discussion on fiscal policy for other countries as well. So I'll get to that in just a second. The second big theme in his agenda is economic freedom. He speaks about making Argentina the freest country in the world, and that's the deregulation part of my ministry. So I'm also going to give you a number of examples of the regulation things that I think have worked very well. And both the fiscal surplus and the economic freedom agenda tie perhaps into what probably synthesizes better than anything else the kind of the economic thing of this government, which is the respect of property rights. And you can't have a working market economy if you don't have if property rights are not respected. And regulation is a way of curtailing your use of your property rights. I mean, you can have an apartment, but then you have rent control that somehow hurts your property right on that property, correct? And if the government is always on the verge of a default or a verge of a collapse, that when the government trying to solve its problem ends up somehow also hurting property rights one way or the other, just through expropriation, through excessive taxation, through defaults, etc. So both the idea of having a sound fiscal policy and having economic freedom both tied and strengthen the idea of an economy which is going to respect property rights, which we think is essential for having a sustainable investment process. Then he has an agenda which is not so much economic, so I'm not going to talk too much about that, but let me just mention them. One is an issue on internal security, and then there's another one which is international alignment. So he has had a very strong alignment with the U.S. and Israel and as main themes. So let me start with the macro things which are closer to the interest of this audience and of a conference of this sort. So let me start with fiscal policy, because I think what has happened in fiscal policy is the most revolutionary thing that we've seen, more than what he has done in terms of monetary policy. So basically what he did is he reduced government expenditure 30% in 1 month. And you may not believe me, but listen, these are the numbers, okay? So to reduce government expenditure by 30% in 1 month, you need to think out of the box, no? So you need to challenge some of the things that you maybe thought could not be touched and say, okay, I'm going to get rid of all this altogether. And he said public works are going to do by the private sector. The government is not going to do it anymore. So he basically shut down to zero. We have a federal government, so he also cut the transfers to provinces immediately. Sorry, I think I muted myself for a second. So the truth of the matter is that the government expenditure was reduced by 30% in 1 month. That's 5% of GDP. And actually there are no episodes of reductions in government expenditure of this sort, except at the end of wars. For example, if you look at the US economy or the Canadian economy in 1946, you'll see that you have a reduction in government expenditure of that size because a war had ended. Okay, but in peacetime, you just by wielding the chainsaw, you don't have really any episode of this magnitude. Okay, and this, as I said, happened very quickly. So the first, I think, would say reframing of the fiscal issue is to try to think out how much can be done. Of course, this is not a problem for Ukraine today. It may be hopefully a problem for Ukraine to think about in more peaceful times. But I think what Javier Milei has challenged is this idea of how much can be done and how fast it can be done. Okay, and recently, for example, there was an election in Bolivia, which is a country close to Argentina, and the president has said that he has recalled the budget, and he's going to return the budget with a 30% cut in government expenditure. And I don't think that before Milei, anybody would have thought anything like that was possible. It's typical to talk to politicians in the region, and they say, well, maybe I can reduce 1% of GDP per year, maybe close, if I have a 4 or 5% budget deficit, close it in the period of 4 years. And then we say, no, why don't you do the 5 points in 1 month? So I think that is something that we didn't think was possible. And I think after Milei, well, maybe it can be possible. Of course, each country is different, and the margins of maneuver may be different. Also, that the sense of crisis in Argentina with which we reach the Milei administration also certainly gives you more leverage to do things. The second, I think, interesting point, and in fact, there's quite a literature on this, is that everybody would have thought, taken almost as a conventional wisdom, that if you do a government cut, if you cut government expenditure 5% of GDP, you're going to go into a recession, okay? And we didn't think that was going to be the case because we don't believe in Keynesian multipliers. When government increases government expenditure, someone has to foot the bill, someone has to put the money. So actually, when you bring down government expenditure, that allows you to reduce taxation of one sort or the other. For example, in the case of Argentina, one of the biggest sources of taxation was money printing, because we have a deficit which was being financed through money printing. So at the end of the previous administration, the inflation was above 200%. And you know that's a tax on the poor. So you reduce the deficit, you reduce money printing, you reduce taxes on the poor, but you can reduce formal taxes as well. So the 5% reduction in government expenditure implied one by one a reduction of 5% in taxes of different sorts, okay? And we said, well, if you reduce taxes on people, why would that be recessionary? That should be expansionary. So that lower government expenditure is going to be compensated with higher private expenditure. You just kind of give people's money, which previously people had to give to the politicians, so the politicians decided how to spend it. We return that money to the people, so people decide how to spend it, okay? And we think that's the better outcome, okay? And so we really distrusted this idea that the fiscal contraction was going to generate a recession. And actually, the result was that in the first year of the Milei administration, which is the year in which this 5% adjustment was implemented, the economy grew 6%. So far from having a recession, we had a big expansion. And then when you go and look at the literature, I mean, there's several papers by Francesco Giavazzi and Alberto Alesina, 2 Italian economists. They have studied fiscal adjustments in Europe. And then when you look at the literature, you say that the result was everything was there already, because they found if you look at their results, what they find is that fiscal adjustments implemented through reduction in government expenditure tend to be expansionary and not recessionary, as opposed to fiscal adjustments done through an increase in taxation. So I think this is kind of good evidence, new evidence, a very strong evidence in support of this Alesina Giavazzi findings, that fiscal contractions can be very expansionary because you have this crowding in of private consumption and private investment. So I think it's kind of a specific example, but perhaps of a very large magnitude where you see that this happen. Maybe when it's large, the magnitude, the crowding effect is more sizable because there's more credibility, but well, anyway, it really kind of supports that view. But the most interesting thing, which I think has emerged from this experience in regards fiscal policy, is the idea or the finding that cutting fiscal expenditure is very popular. It's the best thing you can do from a political point of view, because again, there's also a little bit of a conventional wisdom that some you say, well, I mean, in the previous panel, we had someone from the IMF. No, probably the conventional wisdom is the IMF, or the IMF comes and asks you to do fiscal adjustment to reduce government expenditures because you need to have a sustainability of your debt, but that's going to be politically costly. We say, no, that's a bonus. That's a big advantage. To cut government expenditure is a political plus, not a political minus. And again, I tied it to what I said before. Reducing government expenditure allows you to reduce taxes. So we ask ourselves, how is it that the politician convinced us that it was popular to take our money and give it to them so they spend it for us? But when you think for a second, when people argue that, it's popular to increase government expenditure, they're basically saying, give me your money, I'll spend it for you. And they convinced us that was the right thing for us to do. And we think it's exactly the opposite, no? And so again, when Milei kind of implemented these cuts, there was a lot of debate in Argentina. And I think it really kind of defies basic principles or common knowledge, which says that fiscal adjustments are unpopular. Well, it turns out to be very popular. And in fact, if you do kind of surveys in Argentina and you ask for words that people think positively of, well, chainsaw is the most positive word. And people want a chainsaw, no? Because they were so fed up of paying all this government expenditure, which was going into corrupt expenditure or useless expenditure, and they were paying for it. And so they loved the chainsaw. And just before we started here, my press person was showing me a survey from this morning in Argentina, and the kind of the most urgent demand for people is chainsaw. They want to continue seeing reductions in government expenditure. So perhaps kind of to put it in one sentence is, if you have a problem with political support, cut expenditure. That's the way you're going to bring up your popularity back again, okay? Give people's money back to them. Of course, the politicians may complain and government officials may complain, and all those who were beneficiaries of that government expenditure may complain, but people will love you, okay? So I think this is very interesting. I mean, it's thinking about fiscal adjustments as providing popular support. And for those of you who have studied a little bit the literature on delayed stabilization, there's a very famous paper, also Alesina and Dreisen in this case, which is called Delayed Stabilizations. And basically the basic assumption of this paper was that stabilizations were costly politically, and so the people delayed the stabilization. Well, no, the stabilizations are not costly. That basic assumption is wrong. And that's why you have to front load the fiscal adjustment, and that's going to make you very popular. And in fact, we just had an election a month ago, and the government won by a landslide. And it's very, very interesting because the opposition during the electoral process, the Congress, in which we had a very small representation, we had only something like 10% of the Chamber of Representatives, and I know that politics in Ukraine are pretty rough, okay, also with the Congress and everything, okay, but here also pretty rough, and they issued a number of laws which, for example, increased pensions for disabled people, and the president, during the electoral campaign, vetoed those initiatives. So he was vetoing laws which were creating expenditure and transfers to millions of people. And he said, look, guys, I'm vetoing this because these are laws that the Congress is issuing without generating the resources. So this means deficit. This means going to this long history of Argentina of fiscal deficits. And in spite of millions of people potentially benefiting from those transfers, the government won a landslide victory, had the biggest increase in parliamentarian representations since the return of democracy in Argentina. And okay, so this basically speaks about, as I was mentioning, the popularity of the fiscal adjustment program. Okay, so I think we need to change completely our view on fiscal policy. And I think this is an interesting example to challenge our conventional view on this issue. Okay. On monetary policy, what the government is doing is more conventional. Even though in the campaign, President Milei tinkered with the idea of dollarization, he also rallied people. He said he was going to torch the Central Bank of Argentina. So he was in the campaign, he was inviting people to come with a torch and say, oh, this institute has created so many years of high inflation, so we need to get rid of it. But actually, in the presidency, he has been much more conventional. Today, what we have is an exchange rate band system copied from the Israeli. I don't know if you, throughout the day, you've talked about the Israeli experience. Now it's a little bit kind of way back in the past. But when Israel stabilized its economy in the early 1990s, it's established a band system. And what was interesting about the Israeli system is that the bands widened, kind of, it was like a cone. It was not kind of a parallel or a fixed exchange rate, but it was a cone, which basically opened up over time. So in the case of Israeli, initially kind of the bands contained inflation expectations to some extent, and then as the cone opened up, the Israeli economy migrated very naturally to a floating exchange rate regime. So Argentina has a very wide exchange rate band, and also the bands widen up over time. So I think it's very similar, the process. Of course, since Milei came to government, the central bank has not sent a single peso to the treasury. So monetary policy has become exogenous from the treasury. Inflation, which, when Milei took over, annual inflation was 200%, but actually the inflation in the month of December had been 25%. And wholesale inflation in the last month of the previous government was 50%. So inflation was running at the wholesale level was running at 1.5% per day. Okay, so we're definitely on the verge of hyperinflation. That's when you had the big reduction in government expenditure from one day to the next, almost, it was 1 month. And now inflation is running at 2% per month, and with inflation expectations well anchored, and inflation expectation showing a decline, a significant decline over the next year and a half. So I think pretty much under control the inflation situation. We didn't do the exchange rate bands from the beginning, but we've done that since, let's say, April of this year, and this is what we're working with today, okay? Anyway, so that's what I could say on monetary policy. And I already mentioned the chainsaw. Just one last thing to say on the chainsaw is that we've decreased the payroll in the public sector by around 20% of public employees in this first year and a half of government. So that's kind of a very active chainsaw, at least at the level of the government expenditure. Okay, so let me now move a little bit to the economic freedom agenda. So as you mentioned, Alexander, more kind of it also has to do with the more the institutional thing. But I think this is interesting, and definitely this is going to be something that's going to be in the Ukraine's agenda once the war is over. And the first thing I want to say, and this is for sure the case in Argentina, I'm sure to some extent it's the case in Ukraine. Maybe if we talk Switzerland, it's not so much, but I think in most countries it's a problem. That is, when we think about regulation, we tend to think, as economists, we tend to think in this figure of the central planner trying to solve a problem, not trying to solve a market failure, trying to solve a social problem. So you're trying to regulate to solve something. Well, my experience in real practice, and now as Minister of Deregulation and State Reform, well, really, I've moved from macro to micro. When I was governor of the central bank, I was doing macro. Now I'm doing more micro, correct? Because it's kind of, I'm looking into specific. Let me tell you a little joke, which is that when I was finishing the reform of the navigation code, which was like 1,000 articles, and it deals with a number of different issues which has to do with navigation, from the life path to the authorization process to the electrical equipment. I was working with someone in the Ministry of Security. And when we're finishing, after like 8 months of kind of plowing through this and kind of having all these conversations with the Navy and etc., he says, Federico, I'm convinced now that macroeconomics is for lazy people. I say, why do you say that? Why do you say such a thing? He says, well, because, macroeconomics deals with 3, 4, 5, 10, at most 12 variables, okay? So you guys are talking about money supply, the exchange rate, the interest rate, and it's there, okay? And for the navigation code, we had to deal about with 1,000 variables, no? So I thought that was the funny comment, okay? But honestly, kind of in microeconomics, I'm gonna give you a couple of examples now. Kind of each case is a world on its own. And what I found perhaps so fascinating is that we know a lot about economic theory and microeconomics, and kind of there's a lot of things that you can apply specifically from each case, from game theory, IO, auctions, etc. So it's kind of quite a fun thing. But the most important thing that you have, the benchmark, the starting point, is that I've realized that regulation is not the result of a central planner thinking about how to do good in society, but regulation is mostly the result of some interest group lobbying the government to get a regulation which somehow fences the economy, generates some protections, generates some privileges, okay? And sometimes what I feel by looking at how these interest groups operate, that they very much akin, to the velociraptors in the first Jurassic Park movie. I don't know if you remember the first Jurassic Park movie, there were the velociraptors, and at some point in the movie they say, oh, the velociraptors are testing the fence, So they're kind of hitting the fence to find the weak point on the fence. Well, that's what interest groups do with regulators. They go to one office, if they don't work, they go to another office, they try to find, if one government doesn't work, then they go to another government, they push again. If it doesn't work with the executive, they go to Congress. They're kind of pushing the system all the time until something breaks. They get their privilege. And once they get their privilege, they get rents. And once they have rents, they use those rents to kind of shape the media discussion, social networks, the politicians, congressmen, etc. And then it gets ingrained and you can't get not rid of it anymore. Okay, so for me, the benchmark is all regulation is bad. I understand, I understand that it's an exaggeration, but I think that's much closer to truth than starting from the starting point of thinking that regulation is good. Okay, I think you're going to be much better targeted. You're going to be much more closer to the truth, thinking that regulation is bad. So the basic idea is you need to get rid of as much regulation as you can. You don't want to be dogmatic, but I'm exaggerating a little bit because I think it's useful for pushing the point. But I'll give you a couple of examples. For example, in Argentina is a large country, okay, as is Ukraine. But actually Argentina is larger because if you put Argentina on top of Europe, you would go from Portugal to Estonia, okay, if you cross Argentina like in a diagonal over Europe. So it's very large. Only 47 million people. So very sparsely populated. Yet in Argentina, providing internet through satellites, so satellite internet, of which the most common brand is Starlink. I mean, of course, you have Starlink in Ukraine. That was forbidden in Argentina. I say, why was it forbidden? Why on earth would anybody forbid this product? Well, it was forbidden because there was a large media group in Argentina, which is also the biggest provider of internet. And for them, it was much easier to lobby the government not to provide internet, not to allow satellite internet and not having to compete with satellite internet than, well, it's much easier to pay some money to the government official and that's it, end of the story. It's you don't have to worry about competing, okay? So what Milei did was on his 10th days in office, he basically got rid of that regulation. And today, more than 1 million Argentines, they have access to internet through Starlink or to some satellite internet provider. This is particularly important in the interior of the country where you have people are very far away from, say, urban areas and where it's impossible for fiber optics to get to them. And so it has been really has increased dramatically the amount of integration of the country, at least in terms of communications. So, and this was the only reason this was there was because there was a paper that said it was forbidden and for the wrong reasons, not for the good reasons. And the government just broke up the paper, and then the market, without the government spending a single cent, you could have the infrastructure, you could have the service, and it was fast, it was quick, and okay, that's kind of an example of how regulation really kind of hurts. The other example that I have, which also probably would ring a bell in Ukraine, you also have a very large agricultural sector. We also have a very large agricultural sector. So there's a very tiny industry of agricultural machinery. So these guys had lobbied, so it was forbidden in Argentina to import used machinery, but not use agricultural machinery because that would have been a bit obscene, correct? So it's much better to say, oh, let's forbid all used machinery. So the fact that we're trying to forbid the importation of used agricultural machinery kind of is a little bit kind of hidden because it's not so obvious. And so we got rid of that. That generated a huge increase in the importation of used capital goods, which of course, imagine the country who can never, so you have lots of firms which can suddenly find themselves with access to much cheaper capital. So they've used the opportunity, they're using the opportunity, but we had a tremendous backlash from the agricultural machinery producers. They tried to go to Congress, they tried to overturn the reform, etc. So we've kind of been struggling with them. So we had to put up a fight with them. And the only thing we're saying is let people choose what machinery they want, used or new. We're not saying more than that, correct? So the last example I want to give is one interesting, which is we have a special agricultural product here called yerba mate, which is a little bit of an energizing drink, a little bit like a tea, a kind of a South American tea. I don't know if you've heard about it, yerba mate. And so this is an industry which has thousands of producers, thousands of brands, distributors, big producers, small producers. So very competitive industry, exactly what you want to happen. So what does the government do when you have a competitive industry? Well, it transforms it into a monopoly. So it created a board of these yerba mate producers. It puts everybody on the table, say, what are we going to do? And what are they going to do? They're going to increase the price for the consumers, correct? And I find this very funny because we have long discussions about antitrust policy. And when the government is the biggest violator of the antitrust because he's actually making a competitive market become a monopoly, we kind of look another way, like that's okay. That's okay. But okay, then we go back to discuss antitrust policy when the government is the biggest violator of competition. It's the biggest danger to competition is the privileges and the regulations that the government establishes. So in this case, it's amazing. They just created. So what also President Milei in his 10th day, he eliminated the ability of this institute. He didn't close the institute. He just said the institute cannot meddle with prices anymore. And you know what happened? The domestic price fell 50%. So it fell to half. And so it was pretty, I have to say that it was pretty messy, because the producers are pretty localized in Argentina. So the region where this is being produced, I mean, some people were a bit upset. But now people have moved from looking into the domestic market and they're moving and thinking about the export market. And now both production and exports are at record level as the industry, not having this kind of monopoly rent from selling in the local market has really kind of puts its eyes on the foreign market. And I think the potential and the growth and the eventual growth of the industry is going to be much larger once it kind of has opened up to the world. So these are the kind of another example that we've done, which actually ended up in the cover of Wall Street Journal, is we had rent control law. We eliminated that also at the beginning of the administration, and rentals fell by 30% in real terms. Okay, so that's pretty standard macroeconomic theory. But so the question is not the macroeconomic theory there. The question is, why did these things happen in the first place? No, and then that brings us back to my idea that regulation is mostly the result of interest groups and not so much the result of a benevolent central planner or government officials that you can find at a central bank, which are trying to kind of do things which are good for the economy. Let me just finish with a little some insights on how to build a reform program, because basically, when you think of a system like Argentina, which is so kind of has all these regulations, well, the only way to change the regulation is to change the laws. There's no around that, okay? So 2 years before Milei became president, I decided to start a project where at the time that the new administration was going to come into power, I was going to put on the table 2 piles of paper. One was going to be the laws that had to be repealed, and the other, the laws that had to be changed. By the way, I'm going to show you. I don't know if you see there those 2 piles of papers. Well, those are the 2 piles of papers. I don't know if you managed to see that. Those are the 2 piles of paper that I took to the president-elect and say, here are all the laws that you have to repeal, and these are all the laws that you have to change. And we had written the required changes in the law. And that project took us 2 years. We were seven people, 5 lawyers and 2 economists, which were kind of doing the core work. Some people helped us because eventually you can read one law and correct it yourself. I also was a member of parliament, so I'm not scared about touching laws, because there are 2 things you don't want to know how they're done in the world. Okay, it's sausages and laws. Okay, once you know that, you're not afraid of changing laws, and sometimes many of these laws are so evident that they've been built to protect an interest that it's very easy from an intellectual or an economic point of view to realize what has to be done. But eventually you reach areas that you're not so interested, or you don't know. So you have to find a collaborator in this project. And that was very interesting, because we realized that we couldn't count on the experts on a certain area, because the experts have a lot of human capital already invested in the regulation and the way things are done. Kind of their advantage is knowing about the system, so they don't want to change the system. So we asked someone who was an expert on an area to change and challenge the law, to challenge radically, not to ask ourselves, should all this regulation be there or not? They were very mild. They never kind of were very strong in their reform. So this one, the big law studios, neither, because they also live by selling the services on how to navigate this complex legal structure. So they basically gave us something which was more complicated. So the people who actually helped us do this thing were what I call the victims of the system, the day-to-day lawyer, the day-to-day business person who knew all the tortures that the system was imposing on them and were willing to kind of propose changes to that. So that was the type of people which helped us. And then we had a very, I know I have only a few minutes left, but the other thing which I thought was very interesting is that when we called someone to help us with this, the conversation was something like this. They would tell us, yes, I work on this issue. I'll send you a paper. So imagine environmental laws. We have 40 environmental laws in Argentina. So I would talk with an expert on environmental law, and he would say, I'll send you a paper with what I believe has to be done in environmental issues. And I would say, if you want, you can send me the paper, but I won't read it. I won't read the paper. And says, well, we can do a meeting. We can do a meeting. So I don't do meetings. Okay, I can send you some bullets. I mean, I don't know really what you want. I can send you some bullets, a very executive brief. I'm not going to read it. So he said, what is it that you really want? Well, I said, let's take a law and download it to a Word file and send me the law with track changes and tell me what the changes need to be done on the law, because the product that I need I need a product which is what changes in legislation the president has to sign, or I have to send to Congress, or a diagnostic, a study, a description of the history. All those things are totally useless, okay, at the moment of making the decision. So let's go to what really needs to be there, which is to be the edited versions of the law. That's the only product we're going to accept. And when we reach this point with a conversation, 70% of the people disappeared, because many people are willing to kind of have these great ideas as to how to change the world. But then when you ask them how to fix the world, okay, and the nitty-gritty and the devil is in the details of how to read the law, they were either not willing or unable to do it. But it was a mechanism which for us was very useful to identify who could help us to get this job done without really spending much time in sorting people. No? So at the end of the day, we had the 2 piles, and these 2 piles became, at the beginning of the Milei administration, two pieces of legislation. One is an executive decree, which our constitution allows under circumstances, allows the president to issue decrees which have the kind of the power of legislation. So we did a swiping reform and a swiping the regulation of the economy in this decree, which is on the 10th day of government, but which we could do because we had done the work 2 years in advance. Okay, so I think that was tremendously successful. And then we sent a law to Congress that was discussed for 8 months, and which also had kind of had kind of a second wave of reforms. And if you actually count the number of articles that we have eliminated from laws which entail kind of an obligation, something that people have to do, etc., we are counting 13,000 deregulations and counting every day. So we're actually moving very strong. So I think I'm kind of running. I don't know, Alexander, if you want to open up for questions, etc. But let's just as a synthesis is, this is a government which I think has two main themes in the economic thing, which is the fiscal reform, which I spent some time discussing. I think it provides some challenging thoughts about how to do fiscal policy, and has this very aggressive agenda of economic freedom, which is kind of built on the basis that a lot of the regulation that we have is more vested interest, insiders, restriction to competition than anything that does any good, no? And so hopefully, I mean, maybe not for Ukraine in this particular circumstances that it's living right now, but certainly it's, I think, are very interesting experiences to look at for any kind of country that is searching to develop itself. So let me stop there.
Thank you very much, Federico, for this comprehensive present speech. It's really impressive to hear all achievements that you mentioned. I think we can take one or two questions, and I will take an opportunity to start with the first one. So you mentioned that, well, reforms are important, but you also mentioned that popularity of these reforms is also important. So I would put it a little bit different, that people should support and understand these reforms in order to kind of support this, right? And well, similar stuff we usually see in central banks, right? But we think in these macroeconomic concepts about these macroeconomic trade-offs, where people do not like inflation, right? And they support reducing inflation. But sometimes it takes, you need to take some pill, right, in order to reduce this inflation. And you have this trade-off when the policy itself, the reform is supported, but on the other hand, people will pay something because it's costly. So what is your impression? How should you kind of find this balance between taking the public support for the reform or for your action, for your policy, and for kind of doing actually right things?
Well, I mean, I think it's a great question. I think it's fundamentally different in monetary policy and in fiscal policy, because remember, fiscal policy, they just made us believe that the government spending a lot of money was bad for people. Was good for people. No, but spending a lot of money, the government, is bad for people because people have to pay for it. Okay, so in the case of fiscal policy, my main point is that you don't have this trade-off. We thought we had this trade-off. The literature thinks that it has a trade-off, but in the reality, it doesn't have a trade-off. There's something also which I think is interesting to mention, both for the fiscal and the deregulation, which is different in monetary policy. Let me get to monetary policy in a second, which is communication. I mean, one of the reasons I've been so successful in the deregulation is, and also in fiscal adjustment, is that the president is very active in social networks. Okay, so for example, I say I'm going to deregulate something, and the president immediately retweets that in the social media, and millions of people see that. And when he does that, he somehow makes it very difficult to lobby against that, because people say, oh, I'm going to lobby against this regulation, but the president himself is supporting this. So who am I going to lobby eventually, okay, if the president is supporting this? So I think communication and fiscal policy is very important. The president has taken himself, he calls this the cultural battle, which is what you're saying, is to understand why this needs to be done. And in fact, you know that a few hours ago, the president was sharing in the chat that we have for the cabinet, he was showing us a survey that was done also these recent days about how many people think fiscal surplus should be consolidated, okay? And then basically 70% of Argentines thinks that you need to consolidate the fiscal surplus. So I mean, there's an active communication behind the fiscal policy, and you don't have the trade-off in fiscal policy that you have in monetary policy, because in monetary policy, never expectations are perfect, correct? And so that means that when you're kind of implementing a disinflation, you're kind of somehow having to convince people to lower down their expectations of inflation, and that kind of tension between expectations and your actual monetary policy typically has some output cost in the transition. This is the reason why you have inflation targeting. Inflation targeting is a way to align expectations and allow expectations to come down without an output cost. This is kind of a thing that the marvel, I think, what the reason that that inflation targeting has worked so well, because you have the interest rate, monetary policies endogenous to the demand and money, but then you focused everything on the anchoring of expectations through the inflation targeting. And this is the reason that the disinflation with inflation targeting have been quite successful in terms of output. And I think that explains the success. But you have the tension there. You have the underlying tension. And also, I don't know how it is nowadays, but I don't think the communication of central banks is as aggressive and as present as the president has with fiscal policy. Because, as central bankers, we're kind of much more careful about communication. And maybe this is something that we have to revisit, because when I was governor of the central bank, sometimes I say, well, maybe I should, I communicated in the way, Ben Bernanke used to communicate, or Janet Yellen, with a press conference at a certain time, and everything was very planned. And I say, maybe no, maybe I should have had a much more aggressive and much more active communication strategy. And so I think central bank communication has been fundamentally different from the communication of fiscal policy, and maybe that's an area that has to be revisited, and rethought about. And I think that is so. I think there is a little bit more of this trade-off, which I mentioned did not exist on fiscal policy. I think does exist in monetary policy, as you well mentioned, and this is the focus on expectations. And again, I repeat myself, but I think inflation targeting has done a pretty good job in solving this dilemma that you pose.
No. Thank you very much, Federico. We will take one more question before we move to the concluding remarks. And Volodymyr is raising hand. Volodymyr, please. I hope the question is short, and Federico, please be very.
Yes, I'll make it short. I'll make it short.
Thank you.
Yeah, thank you. Thank you for your lecture, Federico. Actually, I have, as well as all central bankers, we have a question about inflation. So you mentioned that there was huge fiscal consolidation. Central banks stopped the money printing, which realized a quite significant drop in inflation, from these skyrocketing numbers to, as you mentioned, 25%. But probably there is a lot of legacy issues, with all these regulations, and now there should be structural change. For how long and how painful for you to calm down inflation to single digit in case of Argentina?
Yeah, I mean, we tend to think that, inflation is mostly a monetary phenomenon, no? I mean, you have the real economy, you have relative price changes. For example, the government eliminated the significant amount of subsidies that you had, for example, in energy and other public services. I mean, those were kind of mostly gone by now. So you have huge changes in relative prices, but we don't think that there's a theory of inflation on the basis of relative prices. I mean, yeah, the exchange rate can go up, but if monetary policy doesn't move, well, the tradables will go up, the non-tradables will have to come down. I mean, the price of potato can go up. That doesn't mean that because the price of potato goes up, you're going to have more inflation. No, people spend more on potatoes and they'll have to spend less on something else, and those other goods will kind of will grow at a slower rate. Now, the truth of the matter is that the last year, to 2023, the year previous to the government, you had a huge monetary expansion of around between 12 and 13% of GDP. And so then you have the issue of monetary lags. So you stop money printing at the end of 2023, but you have this monetary lags. And we have a big discussion in Argentina, how long and persistent these monetary lags are. The president thinks that these lags are kind of close to 2 years. So he says, well, we've stopped printing money a year ago. Well, by the end of probably by the end of next year, we're going to go into single digit or even international levels, because I mean, there's no money, correct? There's no money. There's no way to sustain a higher level of prices. So he has a very, very monetarist view. and the government is very, very careful. I mean, there's no money printing for the government, so I think we need to converge. I mean, it's just mathematically impossible for anything else to happen, to the extent that you continue with this fiscal policy, correct? And you continue with this monetary policy. But I think it's more a question of, we don't think it's so much the structural, I mean, the structural changes, we don't think it's has to do too much that has to do with, I mean, anything that I deregulate, the price falls 30%. But well, I mean, that price falls, given the amount of money people would spend more in other things, the overall price level is not affected by that. Relative prices are affected by that. But to make a long story short, because Alexander asked me to be short, I would say by the end of next year, if you invite me in a year just to say, tell us 5 minutes, Federico, to tell us how inflation has done this year, I'll come and give the number and then I leave. We should be in international levels, definitely was single digit by the end of next year. That's what we're hoping for.
Thank you very much, Federico. Definitely, we await for you next year, and hopefully online.
Just give me 5 minutes, and we'll do the update.
Well, we really hope that we will organize this event in an on-site proper format, so you can come physically to us for the discussion and for chatting. So thank you very much for this distinguished lecture. We learned a lot from the experience of Argentina, and thank you very much. We appreciate that. And now I want to give the floor to wrap up today's discussion to Sergei Nikolaichuk. Sergei, please, the floor is yours.
Dear colleagues, distinguished speakers and participants, as we conclude today's workshop, I would like to extend my deepest gratitude to all of you for your invaluable contributions throughout this intensive and inspiring day. Once again, we have underscored that the world is confronted with increasingly diverse set of risks, and risks whose likelihood continues to rise globally. However, today also brought positive signals. Both the central banking and academic communities are actively seeking ways to mitigate these risks and provide effective response to shocks. I'm confident that this workshop has helped crystallize our reflections on building resilient policy frameworks, navigating monetary policy under pressures, and charting the path ahead under conditions of elevated uncertainty. Indeed, uncertainty is the word increasingly heard in central banks' reports, government publications, international discussions, and the speeches of global leaders. And Ukraine, perhaps more than the most countries, has learned to operate and adapt under conditions of profound and persistent uncertainty. Over the past 2 decades, our economic environment has been shaped by revolutions, a triple crisis, the beginning of the war in 2014 and the annexation of Crimea, the COVID-19 shock, and of course, Russia's full-scale invasion. And one of the most important lessons we learned out of this period is that the effective monetary policy can actually lower the uncertainty. And this year, we celebrated the 10th anniversary of announcing the inflation targeting regime in Ukraine, which is considered to be one of the most important and successful reforms in Ukraine since the Revolution of Dignity. Over this decade, this framework has proven effective in navigating a number of extraordinary shocks, from domestic and global crises to the unprecedented challenge of the full-scale war. The announcement of inflation targeting regime 10 years ago came on the heels of a perfect storm and was a bold and forward-looking decision. And what ultimately proved decisive was a political will to embrace modern approaches, recognizing that inflation targeting was the only viable path. This decision became a catalyst for far-reaching institutional and operational, analytical, and communication reforms at the central bank, which allowed us to change completely the way how monetary policy has been conducted in Ukraine, gain the credibility, and actually train us for the changes of full-scale war. Today's discussion raised the important question about the core nature of the inflation targeting regime, what it really means in practice. And let me express my view. From my point of view, the essence of inflation targeting lies in effective mix of commitment, transparency, and agility or flexibility. It is about setting a clear nominal anchor that helps firmly anchor expectations and performing all the policies in order to achieve the target on the reasonable policy horizon. Our experience confirms that this clarity plays a crucial role in bringing inflation under control during the repeated shocks. This issue actually got special attention in the keynote address of Governor Thedéen, Inflation Targeting in Sweden, Lessons and Challenges. This is precisely the kind of experience sharing and dialogue that central banks need now more than ever. Let me also take this opportunity to thank the Riksbank for its long-standing and fruitful cooperation with the National Bank of Ukraine. Also, in conditions of elevated uncertainty, central banks have to be flexible and agile. In his opening remarks, NBU Governor Andriy Pyshny noted, our experience clearly demonstrates that monetary paradigms are shaped by challenges and that crisis conditions often become catalysts for their evolution. In times of heightened uncertainty, it is essential to strike the right balance between restraint and responsiveness, between credibility and flexibility, between economic logic and the realities of wartime and a complex geopolitical environment. And as Boris Hoffman highlighted, flexibility is essential, but central banks must avoid overusing it and inadvertently tolerated persistent deviations from target, especially upward ones. Actually, this thought was confirmed by many participants today. Ukraine is now facing an unprecedented shock, and we have had to react swiftly, finding the right balance between clear rules and necessary flexibility, and responding in a way that does not undermine macroeconomic stability. We continue to adhere to the principle that inflation targeting remains the only viable monetary policy framework in the current environment. And our policy has therefore adopted, but it has not deviated from its core principles. I am confident that the experience of the NBU will eventually appear in macroeconomic textbooks, as it represents a real-world example of monetary policy responding to an extraordinary shocks. Turning to the global trends that have emerged from today's discussions, I would like to highlight several points. First, geopolitical tensions remain elevated. It is impossible to know when geopolitical risks will peak. Wars, sanctions, and trade conflicts continue to intensify. All of this has accelerated inflation not only in Ukraine but worldwide. These geopolitical risks bring higher uncertainty, inefficient resource allocation, greater financial instability, and rising government spending and debt. Second, Russia's full-scale war against Ukraine has significantly amplified supply-side shocks. As Martin Sandbu noted, the global economy is now facing a far greater number of supply shocks than previously expected. And this has become a central challenge for central banks. In this context, central banks must clearly understand both the scope and the limits of flexibility in their actions. As Matthew Chavas emphasized in his research, emerging markets economies tend to have more flexible numerical targets, but stricter target horizons, underscoring the importance of finding the right policy balance without overburdening the economy. Third, central bank independence remains fundamental to fulfilling the mandate of price stability. As Erik Thedéen rightly noted, independence cannot be taken for granted. It must be continuously earned. Independence, credibility, and well-anchored inflation expectations are closely linked. This is why improving communication policy is essential. Publishing alternative scenarios, engaging with different audiences, and openly discussing risks. In other words, adhering to the principle, do what you say, and say what you do. Fourth, maintaining financial stability amid heightened uncertainty remains crucial. A robust macroprudential framework is a key line of defense, one that helps contain systemic risks, strengthen the resilience of the financial sector, and support monetary policy in navigating volatility. Probably we may also add here deregulation, as Minister Schwarzenegger correctly emphasized. Fifth, the growing demand for higher public spending increases the risks of fiscal dominance, which could become a significant challenge to central bank independence, or at least to the effective functioning of independent inflation targeting. These internal and external factors for an increasingly complex environment in which central banks must make decisions. And here I fully agree with Erik Thedéen. Monetary policy can never run neither on autopilot nor on AI. Central banks must make a number of choices and dare to change their mind when conditions change. And to be agile, indeed, central banks need such discussions as we had today to find effective mechanisms, improve our monetary frameworks, and strengthen the resilience of the inflation targeting regime in a world of heightened uncertainty. The NBU remains deeply committed to strengthening research and promoting constructive dialogue on these essential issues. Thank you once again for your active engagement and thoughtful contributions. We look forward to continuing our productive exchanges and to gaining new insights at our future events.